Morning, everyone. Welcome. My name is Eric van der Klee. I'm the chair of the Crypto AM Summit. The Crypto AM Summit is a game of two halves. It's going to be me as the chair for the first half, and then you're going to get the amazing Darren Parkin, the editor of Crypto AM, in the second half after lunch. It's a game of two halves and a game of two floors. There is this floor with the content we have here, and then also one floor up in a room called the Milton Suite. Have a look at the agenda. You'll see the content that's happening there. That starts at 10:45. So you can, looking at the agenda, you'll see the different content between the two different rooms. So make sure you choose the ones you want. We need to spread the love between the two floors. Speaking of spread the love, what a year. Can you imagine us having the kind of conversations that we're about to have a year ago? One thing's for sure, if you had any money with FTX, you've certainly learned to spread the love across multiple exchanges, if KEXs are your thing. So I think that the flow that comes from those conversations what's happened in the last year, will definitely flow into today. But Thomas just asked me, Thomas Power, wave your hand, Thomas Power, over here. He asked me an interesting question as we're about to prepare. He said, what do I think the impact will be? Already asking me for opinions. I think that the impact on the industry will only be 50% of what people are fearing. But I do think that the regulatory impact will be considerably higher. And you're going to see those topics discussed. And we've asked for it, frankly, as an industry, and we need to kind of up our game, is my opinion. But don't ask me. I'm not here to give opinions. I'm here to introduce the best people to give you those views and those opinions. Unfortunately, James Aslett, who's the head of education at Binance charity, Binance Academy, has had a family medical emergency, so not able to start. But I want to introduce to you someone that I just met this morning, but I loved my conversation with him. His name is Riz Pabani from Cardano. He is the head of enterprise partnerships at Cardano Foundation. But a little known fact about him, not everybody knows this, is that he used to work for the Bank of England, or he was working on a project in the Bank of England. It was something called the RTGS system, and if those of you that are in finance, you'll know that that means the real-time global settlement system. It's kind of an important thing for a central bank to have. It's the bit of tech that hopefully safely settles between countries. And he was part of the project to help rebuild that. So just so you know, his background and experience is deeply immersed in some pretty serious financial services platforms. But then he took a year off. Well, actually, it took about 18 months off, I think it was, to have a baby boy, which was a fantastic thing to do, which led to him diving down the rabbit hole of crypto, ending up, when he'd finished that particular part of becoming father, so to speak, ending up as the head of partnerships here at the Cardano Foundation. He's going to talk to us about adoption of blockchain. Please welcome Riz Pabani. Give him a big round of applause.
Good morning, everyone. Come on, better than that. Good morning, everyone. Yeah, thank you. So hi, everyone. My name is Rizwan Pabani, as Eric just introduced. I've been working in the financial services industry since 2008. Lehman Brothers was my first job out of university. Having joined in June, the firm was bankrupt by September, resulting in the largest bankruptcy in history and the great financial crisis. Out of this, Satoshi Nakamoto created Bitcoin and famously etched Chancellor on brink of second bailout for banks on its Genesis block. Years would pass while I would continue working for large global banks and implement many of the capital and risk policies that were set to mitigate the fallout from that event. Earlier this year, I started working at the Cardano Foundation as a partnerships manager, focusing on enterprise adoption of the blockchain. After some time studying the blockchain, it dawned on me the problem that Satoshi Nakamoto was trying to solve, and that was to do with trust. And that's really what I'm here to talk to you about today. I want to touch on the institutional trust gap that I see forming, which I think will be ultimately the catalyst for broader blockchain adoption. I'll talk about what blockchains can do to help us create more trust and transparency in our social and financial systems, and whether we are really ready to start trusting blockchain as critical market infrastructure to support healthcare, banking, supply chains, and many other potential use cases. Trust is a funny thing. When it exists in a system no one really notices, it's really the best performance-enhancing drug for business. Whether you're sending out tweets, making payments, or posting on Instagram, it just works and in general is a great experience. However, when trust fails, it's like the oxygen is sucked out of the room. If a business misuses your data to influence you in an adverse way, or all of a sudden you cannot access your money, whether it's on an exchange or a bank in Lebanon, that's an issue. These events, which seem to be happening more and more frequently, are the cause of the trust gap between end users/consumers and centralized enterprise and institutions. How much longer will our current system survive when there is an alternative way of being ultra-transparent with data processing? And will consumers end up just demanding that we be more transparent in our business? For hundreds of years, we've created centralized systems where we put trust in the few. And these few can be selective on who receives these services. And in many cases, large numbers of individuals are excluded. Millions of people today don't have proper identification, which means they can't participate in social and economic systems like paying taxes and in many, access to healthcare and access to banking services. Through blockchain, we can create parallel systems where these people can have access their identity, governance, and value, which we can represent digitally so they can access a whole raft of services which they've been missing out on. We can digitally represent who they are and what they own. We can allow access to governance so they could vote about the future policy that might affect them locally. And we can give them access to loans so that they can support their family and children's education in the future, and ultimately create more businesses and more employment in the world. I believe it's only a matter of time till we see more meaningful adoption of blockchain, where identity, value, and governance can all be processed through blockchains like Cardano. And not just in the developing world, but the developed world too. And I think the demand will ultimately come from the general population demanding more transparency in how businesses are run and how they're making their decisions, and representing some of that on the chain. You may have heard of the blockchain trilemma before. We have security, scalability, and decentralization are the three competing resources of blockchain design. Today, we're working in a very centralized way, and we live in that southern part of the triangle. So all businesses mostly run on centralized servers and services, which, although allows great scale, it is not decentralized and can be subject to some security issues. Satoshi Nakamoto created Bitcoin, which was the first blockchain which allowed unknown market participants to share value through a proof-of-work blockchain. Although it's decentralized and secure, it isn't very scalable and doesn't have the ability to represent much more than value. Ethereum built on Bitcoin's foundations and created a second-generation blockchain where smart contracts were introduced to allow computational processing. However, even Ethereum has some scaling issues in its layer 1 and some security flaws with its use of smart contracts. The Cardano blockchain is a third-generation public permissionless blockchain built on over more than 150 peer-reviewed papers and the experience of Bitcoin and Ethereum. We have a provably secure consensus mechanism, which is proof of stake. Our core nodes are coded in Haskell, which is used in many critical industries like aerospace and defense. We have deterministic fees. So you only pay for the amount of data in your transaction. There's no sort of competing economics there. We have 1,600 kilobytes of data we can store on transactions and NFTs, which allow you to essentially add a payload of metadata into any transaction and NFTs you put on the chain, which are representing other tokenized assets. Our blockchain has been up for over 4 years without any interruptions. Uniquely, I think we have a decentralized treasury which allows the community and enterprises to pitch for proposals for funding, which is ultimately voted by ADA holders, and that's all done on-chain using our governance protocol. We think we've nailed the trilemma, and it can be used for critical market infrastructure to support many different use cases, which we're eager to see launch on the blockchain. In supply chains, we have worked with partners to create tamper-proof QR codes for wine bottles, which link to blockchain records that can store information like location, crop, grape variety, and batch attributes directly on the blockchain. This allows consumers, tax authorities, food standards agencies, and manufacturers all access to the data, which prevents counterfeiting, increases efficiency in the supply chain, and helps retain trust in the system. Another example is in the agricultural industry. We're working with a company that can take a satellite image of a specific location every 6 days. And the company has an algorithm that can process the images and understand what crop is there, whether it's being watered evenly, and when it'll be ready for harvest. And that data can automatically be uploaded onto the blockchain, which allows governments to manage land leasing more effectively. It also allows insurance companies to assess if payouts can be made for crop failure rather than relying on self-reporting, which is how it works in some developing countries today. We can even have farmers report any other ancillary information on the chain too. Another example is a microfinance project which I had the opportunity to work on. That was actually funded through Project Catalyst, our decentralized treasury I mentioned, to evaluate some of the challenges and solutions of blockchain in this space. So we looked at tokenizing capital from investors to track it through from the microbanks to the micro entrepreneurs. We assessed using decentralized identity solutions for micro entrepreneurs so we can attach KYC information directly to the tokenized capital. And finally, even assessing what reporting the micro entrepreneurs could do from their phones, which could also be written directly onto the chain. Attaching it back to the investment so the investors and intermediaries can really get full transparency on what their investments are doing. Through these examples and many more, we want to showcase public permissionless blockchains as critical market infrastructure for real-world adoption. We are constantly looking for enterprises and potential partners who want to evaluate what parts of their business are ripe for blockchain. What do end users and consumers want to be more transparent about? What operating efficiencies can you gain from moving some of your data processing onto the blockchain? Although I genuinely feel like we're very close to seeing much more enterprise adoption, we still haven't seen it just yet. And I want to touch on a little bit why isn't that happening and why maybe we're at that precipice of seeing it happen very shortly. In the past, the enterprises that have deployed on blockchain tend to do so through private permissioned blockchains like Fabric or private implementations of Ethereum. I guess it's a logical next step from very centralized databases. The enterprises that I've seen deploy on public permissionless blockchains tend to do so through a pilot or proof of concept. And this results in a small amount of on-chain activity and usually is quite limited in reach. There has been an adoption challenge due to the narrative around crypto. Cryptocurrencies are essentially to incentivize proof-of-stake nodes to operate. You operate a node because you earn a utility token through transaction fees you get when you mint the next block. However, these utility tokens are far too often being speculated upon, which has damaged the reputation of blockchain. I'm hoping through our efforts at conferences like these, we can change that narrative so these utility tokens can be thought of for being used to pay for transactions, to tokenize assets, and to be staked for node operators in their efforts to secure the chain. I know we've had some awful news recently. I'm not going to use the F word, the three-letter one. But all of the recent events have largely been by centralized institutions and bad actors in these organizations through a failure of transparency and governance. Blockchains, in the meantime, have continued to mint new blocks and support applications that exist on them without taking any notice, really. Even with the Celsius collapse, I understand that they were paying back their DeFi protocols first, as they were over-collateralized and autonomous. You won't be able to take your smart contract liquidity pool to court when you're going through bankruptcy procedures, and they knew that. As these events happen, the ecosystem matures, and we weed out those bad actors, and we grow together. We just had the Cardano Summit in Lausanne over the last 3 days, where I was, where I had the opportunity to connect with many institutions who are working within the existing regulatory frameworks there to offer crypto tokens to their customers. They are creating and operating within compliant frameworks with full KYC to support the investment needs of their clients. And with this, I'm seeing a whole plethora of enterprises coming into the space to support institutional capital, whether it's blockchain consultants who can tell you how to comply with regulations, or custody solutions which can use and reuse tokenized KYC from counterparties. Obviously, the regulatory landscape will evolve, and Cardano, along with a number of other blockchains, are facilitating discussions and responding to papers issued by regulators asking for commentary. I think education is a real important factor here. Trying to educate the regulators on the differences between blockchain features is desperately needed to ensure not all blockchains are treated the same. While at first glance, smart contract blockchains might look very similar, their underlying tokenomics and functionality can be vastly different when you scratch under the surface. In the past, user experience of participating in Web3 wasn't great. However, I'm seeing much more adoption of Web 2.5 solutions, which bridge the gap between those wanting to self-custody and those just wanting to interact with blockchains without bothering with managing hardware, wallets, and the like. Mobile applications are now able to interface and write to chains, making it much more easier and friendlier for blockchain adoption. Blockchain is maturing, blockchain is ready for enterprise, and blockchain is open for business. Thank you.
Just stay there just for a moment. I think Riz is happy to take a couple of questions. Oh, I didn't see the clock. How close were you? Oh, you've got time. Great. You've got time for questions. So if anyone has any questions, this is the opportunity to ask him. Cardano are making significant impact in both society as well as, I think, enterprise. So I think it's a good opportunity to ask you for the inside track, just between us, as to what the ambitions are and that kind of thing. So firstly, anyone have any questions for us at this stage? I know the first, so we've got one over here. By the way, who's got the microphone? Oh, look at that. By the way, this is Corby. Everybody give Corby a big round of applause. Woo, 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 woo. Right in the back, sir, the question. Please say your name and your question.
My name's Phil Blows from the crew. Thanks very much for the speech. What are you most excited about in 2023? All this negativity, give us something to get excited about.
It's actually that the satellite imagery product that I was talking about, that's made me really excited about real use case adoption in 2023. I'm really excited to work with that particular company because it's helping in some developing countries where it's very difficult to have full transparency about what's happening on the farms, what the farmers' needs are, how they're reporting that to their governments, and what do they own. And I feel like some of these guys are really missing out on access to loans. And I think through blockchain, we're going to be able to digitize identity, we're going to be able to digitize their land use records, what are they doing? And then through the satellite imagery company and corporation I'm working with, we're going to be able to create a really, really interesting pilot, which I hope will turn into sort of a full-scale deployment across the country we're working in, to be able to monitor multiple different farms and be able to use satellite imagery technology and algorithms to really write and tokenize each crop or each land that's there and what's growing on it, how is it growing, and that will then ultimately report back into governments to influence policy, but also to the farmers so they can make decision making on their business. and also insurance companies that will be involved in the chain too. So for me, I think it's starting to see some real-world adoption where we're not just doing kind of one pilot or one proof of concept here that ends up with a bit of on-chain activity. I really want to see, full adoption and full use cases being implemented front to back, where people start really trusting the blockchain as critical market infrastructure and not just thinking, it's there, but do we really trust that it's going to be there in 10 years or 20 years?
We have time for one more question. There's a hand raised over here and one at the front. So it's whoever Corby gets to first. Raise your hand again. Raise your hand so you can see. Thank you. Thank you, Corby.
Hi, Johnny Fry. I'm interested, are you seeing any particular jurisdiction or industry that you would say Cardano is having particular success in? Sorry, Thomas, you got your hand up a bit too late there.
Yeah, I think I can talk about what we're doing with the country Georgia. So I mentioned the sort of track and trace solution we implemented there, where we've got these tamper-proof QR codes, which ultimately you can stick on the bottle. And we did that with one vineyard last year, and Buyer's Wine was what it was called. And then towards the end of this year, and next year, we are launching a sort of full rollout of that supply chain solution, where you're able to represent the grape, the location, lots of really cool information. So you literally just take your phone out, you scan the QR code, and it takes you, to a website which you're familiar with. But the underlying infrastructure behind that is the metadata that is stored on chain. And that happens every time you scan or you update the data using the applications that the vineyard's using. And we're in the middle of rolling that out, or starting to roll it out early next year across the Bolnisi wine region. So that's going to be super exciting. And we've developed a very good relationship with the government in Georgia, who are very open to blockchain and seeing it rolled out in other aspects of their country. So that's something I'm super looking forward to see what else we can do there.
Anything that makes it possible to get more and better wine, I'm a very happy supporter of.
Yeah.
Please put your hands together and thank Riz Babani. Thank you very much. Thank you, Riz. Much appreciated. I love that use case, improving the economic opportunities using blockchain as well. In terms of economic opportunities, I'd love to introduce you now to someone who was slated to be the first person on today, but actually wasn't for reasons that become clear. He is a single-handed economic opportunity, certainly for the UK and internationally. The owner and operator of the Crypto AM Summit. Please welcome James Bowater.
Good morning, everybody. Thank you very much for braving the British weather to be here. It's always interesting when I get back from a sunny place like Lausanne, where I was with the Cardano Summit, and it was glorious sunshine. It'd be a little bit cold, and then rain and tubes come to haunt us again. So, but thank you very much for all being here. We have a glittering lineup of esteemed speakers from the whole spectrum of our industry, packed with fascinating keynotes and panels that I'm sure will stimulate your grey cells and garner healthy, constructive debate. 4.5 years ago, as my first crypto winter set in the post-hype cycle of 2017, the idea of Crypto AM was born and the partnership with City AM was forged. It was an incredibly brave move because despite the reputation that it had garnered the wild west of blockchain, crypto, and all the stuff, and the nightmare of the huge pump and dump of Bitcoin that stimulated that, it was essential, in my view, that the technology and all of the associated pieces should be explained to the traditional audience, the traditional finance audience of City AM. And they would welcome the opportunity to learn about blockchain, cryptocurrencies, digital assets, and let's face it, the tokenization of any liquid assets could be a huge boon, especially to the City of London. Then, of course, 3 years ago, we were hit by the lovely global pandemic, and we had to pivot fast. And City AM rose to the challenge amazingly, having to stop our presses for the first time in its 15-year history. We went online, and actually that turned out to be the flourishing moment for Crypto AM. And with the partial, just before the pandemic hit, actually it was the 11th of March, the first Crypto AM Awards took place at Boisdale in Canary Wharf, which actually was where I conceived Crypto AM with Harry Owen, the then Chief Operating Officer. So with the pandemic lifting, the restrictions lifting, suddenly everyone jumped on airplanes, including me, and I haven't been off one ever since. 20 kilos later, it shows, I'm afraid, but that hopefully will change soon. But the market changed as well, because everyone suddenly got this new reinvigorated energy to go out and do stuff. During the pandemic, we saw the advent of DeFi exploding onto the scene. And also we saw a lot of activity in central exchanges as well. And the market just exploded, didn't it? I mean, Bitcoin hit the heady heights of $60,000, and the market cap breached 3 trillion. But this, of course, attracted bad actors. And we've heard from Riz the same. We'll probably hear it again and again and again throughout the conference, the summit even. So basically, what I'd like to say is that, yes, I am going to use the F word. The FTX scandal will be at the forefront of all of our minds. But the key point here is that there will be many destructive growing pains in the blockchain, crypto, DeFi, digital assets, and metaverse worlds. There always will be. All unregulated industries have bad actors, like moths to a flame. Does it stop development and refinement? No, of course not. In fact, it's quite the opposite. What is clear to me, though, is that projects who adopt a slow and steady approach tend to win the race. Patience and persistence serve us well, and education and observation, though, remain at the heart of everything, because those who want to will learn from the mistakes being made around us. The survivors will flourish, providing they keep learning. So before I invite our next speaker to the stage, I'd like to thank the whole Crypto AM and City AM teams for putting this amazing event together. It is our 3rd event, which, despite the pandemic, we've managed to have physical in-person things, and that's great. But of course, it wouldn't be possible without the support of our partners, and there are 19, so I'd like to just focus on the headline partners, if I may, and thank Binance Academy, Jade City, the Cardano Foundation, thank you, David, and of course, the City of London Corporation. Now, the Bowater family and City AM have had a very long and close relationship with Mansion House and its occupant. So I'm therefore completely honoured and delighted to invite to the stage the Right Honourable Lord Mayor of the City of London, Alderman Nicholas Lyons. Can I have a hand of applause?
Well, good morning, everybody. It's a great pleasure to be here. Great location, great event, and an important event. You'll tell from how I'm dressed that crypto probably isn't my main specialism, but I have worked in the city for 40 years for American investment banks. I've chaired a lot of insurance companies and asset management companies. And the city has thrived because it is always changing, and it is always at the forefront of new developments in finance. And that's really why crypto is so important. Now, inevitably, after Riz's presentation, which I found absolutely fascinating, I'm going to take us closer to 30,000 feet. So your summit features 2 days of discussion and debate and networking and workshops, and of course, the very glamorous awards ceremony itself, celebrating success and innovation in crypto and blockchain. These are technologies which are increasingly important to the City of London landscape. And despite those recent headlines, crypto is absolutely creating momentum, and crypto assets are rapidly increasing in popularity. So London needs to keep up to speed with these rapid changes in order to compete with our rival global financial centres. And the City of London Corporation is committed to helping build an innovative, responsible, world-leading digital asset ecosystem here in the UK, a goal which the then Economic Secretary to the Treasury, John Glenn, now Chief Secretary to the Treasury, outlined earlier this year. Crypto is part of the broader fintech revolution which the City of London has embraced. And fintech is worth £6.6 billion to the UK economy. 2021 was a record year for annual fintech investment, exceeding $11.6 billion, which was a 217% increase on 2020. And London alone has a fifth of Europe's fintech unicorns. And crypto is going to have a crucial role, absolutely critical role, in keeping London in pole position. For example, in cross-border payments and settlements, wholesale settlement networks are using distributed ledger technologies to reduce settlement times from days to minutes. In trade finance, networks are setting up common ledgers with traceability to automate document verification, enabling faster financing decisions and lower processing costs. And central bank digital currencies, CBDCs, have the potential to decrease the maintenance that complex financial systems require, to reduce cross-border transaction costs, and provide those who currently use alternative money transfer methods with lower cost options. And these are just some of the opportunities presented by crypto. And our regulators are responding. The Bank of England is looking carefully at how a UK central bank digital currency might work. The Law Commission, important point, is exploring provisional law reform proposals to ensure that the law recognises and protects digital assets. And the Financial Services and Markets Bill is being amended better to define the scope for regulation of crypto assets. So crypto is here to stay, and that is in no small part down to the pioneering efforts of some of the innovators here at this summit and awards ceremony. So I wish you all a very successful summit, and good luck to all those who are up for an award. And I will now leave you in the very capable hands of James and the team. Thank you very much.
Thank you very much indeed. Much appreciated. So encouraging to have such a venerable organization such as the City of London really embracing and supporting the potential and the opportunities of the industry that we so care about. I suppose we shouldn't be surprised. They're probably one of the oldest companies in the world and have seen change, something like 800-year-old. I think that probably makes them the oldest company in the world, and it makes them adaptable. There's not many organizations that are that old and have survived and thrived. And the work they do in helping champion London, the UK, and our industry globally is unparalleled. Now we're going straight on with the content for the next for the agenda. Just to say that don't forget that the Milton Room has a panel starting with the amazing Steffi Babaglio. She's going to be talking about DeFi and interoperability, and her panel, including speakers from, I think it's State Street, and some awesome speakers there. So don't forget to check the agenda for both the Milton Room and this room's content. Now, to this panel, I'm going to introduce the moderator, and I think that most people who are in the industry in the UK will have heard of the inimitable Monty Munford. He has got the ultimate beard of the industry, but he's also definitely somebody who's been quite happy to, dig us in the ribs as an industry and ask some of the tough questions, which we certainly appreciate. But what not a lot of people know about Monty is that he has an insatiable thirst for knowledge. Did you know, we probably didn't know this, he owns over 2,000 20,000 books. Literally, when I see him, I had a beer with him the other day, and he just, straight out of a bookshop, he had another book. I said, "What are you reading?" He said, "The Molecule of More." I don't know what that is. You need to ask him about it afterwards. But what our people don't know is he's also written a book by hand with a Mont Blanc pen in long form. In 1994, he went round the world in 349 days and wrote a book called The Dust Bowls of Maturity. It was a novel. Also, I have no idea what it was like, but you can certainly ask him about it. He is, however, here with us today, hopefully with a furthering his thirst for knowledge, and going to extract some knowledge from some amazing speakers about DeFi, staking, and regulation. Please welcome Monty Munford to the stage.
Morning. Thank you, Eric. About 4 people bought that book, I think. Can you hear me?
Are you lectern or wandering about?
I thought I was wandering about. Does it work?
Yeah, just tell him what number you are.
4. 4?
You need to hold it to your mouth.
4? Morning. Can you hear me? Thanks for the introduction, Eric. That's the first time anyone's mentioned that before. But it's true. I'm probably the last person in the world to ever write a book by hand. I might use that. DeFi, staking and regulation. I think we had some discussions earlier and last night that if this had been a year ago, this would have been a pretty boomy, bouncy type of room. I think there's been a shakeout, as we all know, the F word, the X word, the T word, the C word, whatever you want to use. We're in a different area than we were before. I think that this is the best time ever to be involved in DeFi. I'm the co-founder or the chief evangelist of Sienna Network, which is a DeFi privacy community. I was a victim of a crypto theft about 4 years ago, 163 Ether. It was about 25 grand at the time. I wrote a piece about it for the BBC. It got 1 million views, and now everyone, whenever they lose cryptocurrency, come to me and ask me how do they get it back. It will be on my fucking gravestone, that 163 Ether. 163, probably in Roman numerals, ETH. Not surprisingly, I co-founded, I'm the chief evangelist for a DeFi privacy network, Sienna. Basically, because I got burnt, I came back again, and then realised that if I owed someone in this room £100 and I sent you £100, that would be quite simple. If I sent you £100 of crypto, you can see every single transaction that I've ever made in crypto, and I can see every single transaction that you've made, which is stupid. It leads to front running, people hijacking trades. So that's what we're trying to do at Sienna. We've been around for a couple of years. We're launching new things. Bear market's a great thing. But I would rather not waffle on about what I've done. I'd rather listen to people on this panel about what they're doing and what they intend to do. So I'm not sure how this goes, but I would love my panel to come on stage now, please. Thank you. I think we'll all sit down. I will allow them. There you go. Clearly, we've really rehearsed this panel. Never met anyone this time. Yes, okay, so starting from the far left, sir, if you could just give us a minute of who you are and why you're here and how awesome you are, that'd be great.
Hi, everyone. This is Amit. Just a brief introduction of mine. I lead the DeFi research at Polygon. If you haven't heard about Polygon, we are one of the largest blockchain, even in this bear market, $1 billion cap. But apart from the dollar amount, the community of ours is great. 160 daily active users, 2.5 million transactions flowing in. We are like one of the biggest in DeFi ecosystem. You name the app, we are there. Our vision, Polygon vision, is to bring the Web3 to the masses, and that's we are achieving for. We have recently launched layer 2 scaling solutions, and we are looking forward to building great things in this bear market.
Thank you, Amit. Next one, please.
Hi there, thank you. I'm Michael Masselet. I'm from Pillar Project. Pillar Project is one of those ICO companies from 2017 that's still around. And on top of that, we've recently launched our cross-chain enabler SDK called Etherspot, which any dApp can integrate and go cross-chain automatically. Just like when you go to Uber, when you use Uber in another country, you do not need to know about the FX that is involved from your pounds to the other country's currency. The same way we enable cross-chain communication between all the 15 EVM chains we support and any dApps on them. Thank you.
Thank you, sir.
Hi, I'm Katie Evans, in case you couldn't pick me out from the lineup. I work for Swarm. We are the first regulated DeFi platform. So what that means in reality is all the architecture, all the products and services that we create are based on, that use DeFi infrastructure. But we ourselves are regulated by BaFin in Germany, so we are a regulated company. And that brings a lot of trust, a lot specifically for institutional capital that is waiting to move into DeFi from the sidelines.
Thank you.
I'm Toby Lewis of Metalink Capital and Novum Insights. Metalink is a DeFi fund focused, data-driven, long-short, investing across the industry, and also been running Novum Insights the last 7 years as doing data analytics across the DeFi space.
Thank you.
Hi, my name is Jeff Hancock. I'm co-founder CEO of CoinPass.com. We're a UK-based FCA-registered cryptocurrency exchange. Started in the bear market. Well, I can't remember which one. It's about my 4th or 5th now. As an idea on a bit of paper in 2017 about getting efficient ways of getting in and out of the market in pound sterling. We launched in 2018 while I was at SoftBank as an engineer. We've grown considerably in that time. We offer services to retail, businesses, law firms, accountancy firms, and even now SaaS pensions. And it's really exciting, like, as you say when you come on stage, Monty, this is one of the best times to be in crypto because it does wash out all of the garbage. And the clients that are coming to us now and talking about it are super, super bullish on crypto.
Do you think it does just wash out the garbage?
Yeah.
There is a certain amount of that, but do you think there's any good projects that have been unlucky?
Good projects that have been unlucky.
Or that's a bit of a sweeping thing to say. I mean, I get it.
No, it is. No, I think we're talking about bottom of the bear market kind of sweep out. You know, the whole FTX bit, we're going to talk a lot about that this whole weekend. But I think in any market, there are good projects that just get unlucky, whether it's from a user base, whether it's from a bridge hack, whether it's from treasury. We've seen, I think there's like an endless pit of really good projects that just haven't made it, as well as companies.
Well, I mean, I know about coin. I'm going to move a bit because I can't see everyone.
And I think...
hang on a second, I just want to look at you. You look lovely, all of you. Sorry, just 1 second, Toby. I was going to go to Jeff first about CoinPass. Now, you're one of the ones that made it, right? So you're fully compliant.
Yep.
Now, tell me why you managed or how you managed to become compliant when others didn't, or others that should have been.
Sure. Now, we're not here to blag on regulation, blag on the FCA. We're all friends here.
Please don't blag on about CoinPass.
No, we definitely won't do that yet. No, I'm just saying, like, when it came to, the FCA's approach, in 2017, 2018, crypto, Bitcoin, and blockchain were all the same thing. And then they kind of broke it down a bit. Well, these are exchange tokens, these are payments, these are securities, et cetera, or privacy, et cetera. Stablecoins still were not in the remit. And then we came to 2020 when the framework was created, but it was still kind of within the FCA have a box. So let's put crypto in the box. We kind of really deserve our own regulation that's far more innovative in its approach. So I think why we got through and others didn't, I think is kind of a testament to our core team. We all come from a corporate background. I come from a cybersecurity background. Our COO had spent 24 years in regulatory and compliance and electronic trading for his sins. And I think the way that we approached our user base and sort of the way we onboarded them might seemed a bit maybe overstepping in 2018, but it's completely the norm now. Yeah. So we've never had to recomply a user. We've never had to backtrack any of our positions with the FCA. And I think that longevity of our business has kind of shone through. The kind of questions they were answering and how we were answering it was probably the most important thing.
Yeah, for me, maybe the audience knows better than me. But when you're compliant, you have to be re-compliant every year. You have to go through more, you have to stress test or stuff like that.
Yeah, so I mean, the AML process it started off as AML and then it started to get a bit more adventurous. So what are you going to do about competition over the next 2 years? What is your compression margin? How do you explain this rapid growth? And apparently an answer, because bull run is not good enough. So you have to have a lot of robust processes around what you're doing and how you're doing it and who are the people on the front line. Right. You can have an API integration with your on-feedos, with your Chainalysis, all this kind of stuff, but they still want to know who are the people that are taking care of the business, who are the people that are taking care of these users. And there are going to be at-risk people that fall in some of these scam nets. What are we doing to protect them as well?
And so, Toby, you wanted to say something. I'm sorry to interrupt you earlier.
Yeah, no, I was
Can you
thinking...
lean back a bit, if you don't mind?
Yeah.
I'm going to go off the stage.
I was thinking in terms of your earlier question, in terms of whether all the people who have been caught out during this crisis deserve to be caught out. And it's sort of almost... What I think you've seen is there's huge interconnection across the whole industry. So do we really want, as a crypto industry, Grayscale, for instance, to be in crisis and that sort of real question marks over one of the first ETFs? I guess if it is what's rumored at the moment that perhaps they don't have the reserves backing it, then yes, they do deserve to sort of the whole sort of Gemini, Grayscale, House of Cards that seems potentially to be unraveling. Perhaps we don't want that to go down. I mean, if it does, FTX looks clearly like a Ponzi. Do we think...
In retrospect,
yeah, in retrospect, but yeah, and they covered it up. But it became very apparent that it was a Ponzi, right? So.
Katie, crisis, PR, how are you handling it?
It's been a dream. Yeah. No, do you know what? It actually provided real impetus for Swarm to start talking more about the benefits of DeFi, self-custody, and transparency. A lot of the issues we've seen with FTX and even with Celsius earlier in the year is that these are problems of CeFi, not problems of
Absolutely.
DeFi. So I think, and a lot of what Celsius was doing with rehypothecation of client assets, that is done in traditional finance too. It's just the difference with TradFi is there's a lot more oversight, and in jurisdictions where it's not a light touch regulation. So I think had we had maybe some of those rules in place back then, maybe the sense of contagion or the degree at which we saw things royally blow up a couple of times this year may have been somewhat contained. There is also an argument that had there been more regulation and more institutional capital flowing into this side of the market or this asset class, arguably it could actually have been worse than what we've seen. So I'll let everyone else philosophize on that later. When it comes to crisis PR, though, a lot of people have been turning to us and asking, okay, so what is the answer here? Is it regulation? Is it DeFi? From Swarm, we think it's both. We've been in a privileged position where we do have had regulation for a long time, similar to CoinPass and Jeff. We're just applying it to a different set of rails, which we call DeFi.
So, yeah, okay. So it's, the thing is, I work for a privacy DeFi company, so there's always a big educative thing about privacy and anonymity. Anonymity is bad, privacy is good, but then you have to go through this process of trying to educate people as well as informing them, if you know what I mean. So I think that's a very good point you make about these are CeFi problems and how communicating to someone how brilliant you are or your clients are, and then blaming an old-fashioned technology must be a bit of a job.
Yeah, and also people aren't comfortable with the notion of self-custody just yet.
Yeah.
I think the next wave of crypto, after this crypto winter, is going to see the birth of more of these protocols, more privacy solutions, which aren't tarnished with the tornado cash narrative, for example, and show that actually DeFi needs privacy in the same way that TradFi has had it for so long. Absolutely.
Interesting. Michael, Pillar Project.
Pillar Project.
What is it now? I know what it used to be.
It used to be.
Well, tell us what it used to be, and then tell us what it is going to be and what it is now.
Pillar Project used to be a non-custodial wallet, and it is still a non-custodial wallet. What we have is other products, like EtherSpot, which make non-custodial users much easier for them to use the ecosystem. In fact, based on this, I would say, when we see the crisis that we have, one factor of that crisis is the fact that DeFi is pretty much unusable to the average person. The amount of hoops you have to go through if you have some 200 USDC on Avalanche and you wanted to stake something on Polygon. I have to bridge this, I have to do that, I have to know all those things. I'm just an investor, I'm not a technologist. Why do I have to bother about these things? So to say, oh, everyone that went to CEXs, really they should have gone to DEXs, it is easy to say, but we've not made it easy for people to use these systems. And in a way, we have a share of the fault in this.
Yep.
Why do people go to Binance and FTX and the likes? Because they're easy to use.
Yep.
So what do you expect people to do then?
Yep.
So that's one of the places that we are addressing with Etherspot.
Yep.
To make it easy for one person to go from one vault on one EVM chain to another vault on another EVM chain with just 2 clicks, not knowing the implementation details. So that's the sort of thing that...
But your non-custodial wallet, as I remember, it was almost going to include DNA. Was that kind of sophisticated, or was that just a bit of a gag?
I don't know where the DNA came from. If someone just blurted it out by accident, maybe it was that, but no DNA.
I think nothing's by
I
accident.
think it sounds brilliant. I think you should do it.
Amit, you must know more than anyone on this panel about what's going on. Tell us more, what you've been finding. What have you found this year?
Yeah, so post Celsius, we have an official position in our team, which is called a night watch. So it shows the things unravel pretty quickly in DeFi and in crypto. So for me, for Polygon and for DeFi, actually, it's very important. We should recognize that the DeFi is still at its genesis stage. We haven't reached, millions, a couple of 100,000 users are, on board, are getting onboarded and using a lot of transaction. So if you look at the solutions which DeFi offers, they are actually revolutionary. But also at the same time, they need constant innovation. When people talk about centralized exchanges versus decentralized exchanges, clearly, if you can see post current scenario, we have seen an uptick, a huge uptick in DeFi actually. So sometimes macroeconomics or negative shocks are good for education. This might be retrospectively looks like a negative shock trying to educate people, but you have seen this uptick in the DeFi projects. Also around the regulation and all the DeFi thing happening, I'll again try to connect it with the breadth of the innovation. Sometimes potentially I think you need regulation when the things are maybe sometimes institutional. But if you are innovating at a higher pace, for example, you look at the status of Uniswap, Uniswap V1, Uniswap V2, Uniswap V3, now more things are coming. And we have billions of dollars transacted. In one week, actually, on Polygon, there is a 1 billion trading volume on Uniswap V3. So you can see, these are the things I don't think regulation is required in some of the higher innovation things. Maybe, as you are saying, if there is a institutional capital, you can do so. And bringing all of this into this, a base layer of infrastructure, the blockchain, that's what Polygon comes in, lower transaction, privacy solutions which you are talking about, that are of huge importance. The technology has moved ahead. We have now zero knowledge base privacy solution. I think Polygon has recently released a Polygon ID, a product actually, which is a zero knowledge self-sovereign identity based. So what we are working now is for the technology for the future. We acknowledge there is a privacy is the problem. Scaling and higher transaction cost is a problem. So we allocated last year $1 billion from our treasury, and we have invested that in layer 2 scaling solutions. Literally, the testnet is live. If you can check it out, it's ZK EVM testnet is live. Mainnet is gonna be soon. So these are the revolutionary technology.
But what I think is revolutionary, what you're saying, and I think there's a couple of people nodding on the panel as well, is that you're calling for no regulation because you think that regulation stifles innovation. That's something I used to hear. I'm not hearing it this year. If you could just kind of verify that a bit more.
Yeah. So that's why I said like a regulation. So first of all, the regulation has to make a sense out of it, right? Regulation for the sake of regulation doesn't make sense, right?
That doesn't make sense in any asset class.
Yeah. So exactly. So if you think there has to be a public good associated of it, if you acknowledge that DeFi is bring financial inclusion. Things like lending protocols are gonna lower interest rate for maybe farmers down in Europe, then you definitely want to regulate not in a manner which you are used to regulating the traditional financial market. The regulators also need to change the style of regulating or change the thinking about the regulation. It's not like you can literally cut-paste the same regulation onto the DeFi protocols, and that's what I was saying. And in some of the cases, like if it is maybe a centralized unit, you have a template. You can literally copy-paste the same regulation.
Yeah, okay.
Can I just challenge slightly on that? So you do make a very valid point that, you know, innovation, in order to be incubated, if you will, needs to operate outside of a regulatory parameter. And I think we're seeing like a bifurcation in the market of regulated and unregulated players. To your point about Uniswap, we have actually seen them delist certain assets from the DEX for fear of them being caught up by regulators and classed as securities. So I think it's naive to think that regulation isn't coming, because it is. But it's whether you choose to play in that space. There's a lot of people that will choose to play outside of that space, and that's okay. That's why this technology exists. One thing I will say about, you know, shoehorning into existing regulation and can this technology be done so, we're proof that it can. We found a very favorable regulatory regime in Germany that basically brought crypto assets in line with existing financial products back in 2020. And we're subject to sort of the same reporting requirements, the same standards as any other German financial institution. But we have a few key differences that actually regulators there really like. First and foremost, reporting, we don't actually have to do so much because they can look under the hood themselves. And but it also requires them to have the expertise in-house to be able to go and do that. So I think I'm not a believer in finding a brand new set of regulatory regime just for crypto assets. I think there's things we can borrow from the the traditional side of things. But there will have to be some sort of, bending or making of new rules where we compromise and come together.
Customization of,
Yeah, okay, so I am looking at it in the comms area from your point of view, that there's, the first question I asked was whether you were regulated, so it's front of my mind as well. But isn't there a kind of job here to show the wider CeFi or world or whatever, hey, listen, we're getting regulation in order. But then it's quite a difficult thing that we're saying we're getting it all in order, but there are some ones we're not going to regulate because it stifles innovation. I mean, it's a pretty tough gig.
But there's also an argument that's sometimes with this technology, because of the transparency of it, you actually don't need a lot of the regulation.
Yeah, no,
so a lot of this could actually just be translated and governed by code.
Yeah.
Segregation of client assets, for example.
Yeah.
You can see if they're kept in a wallet, in a separate wallet.
Yeah.
So, post-2008, a lot of regulation was brought in for reasons we all know, are very well aware of, but now we're actually, we can build something different with this technology that actually doesn't necessarily need all these checks and balances because the technology
But again, I agree
that.
totally, but that's still a hard sell. Especially where we are, because people want to be, people at the moment with, F word, C word, whatever, They want to be kind of chilled out about
I think it's only a hard sell because traditional business models have relied on, custodianship, for example, and a lot of regulation focuses on, how to custody assets, what you can do with those assets. We're not used to this new regime where actually you have to change up the business model and to exist or survive in this new world.
I think your clients are lucky to have you, by the way. Jeff, you've been nodding your head, agreeing, or is just tired?
Yeah.
Crypto never sleeps, right? I think it's a bit of both, to Katie's point and to Amit's as well. I mean, we're in a highly technical, highly innovative environment, and I think there's both sides of the fence, but we can still do business together on a technological level. There's going to be the regulated side, custodians, old world, legacy, whatever you want to call it, it doesn't matter. But we can still deal with DeFi protocols that are in that decentralized space. But the problem is, I think what we all agree, is definition. What falls within the boundary, what doesn't.
So what does, or what doesn't?
I think if you're operating and holding customer assets to trade, then yes, you need some form of regulation, some sort of safeguarding. And we've seen numerous people try it, and obviously numerous ones fail, even though they had a regulated body over the top. For the people that are ready to be in that decentralized world, that are ready to be custodied, I think the platforms they want to trade on shouldn't be exempt, but there should be a framework they can operate in for the people that want to take those inherent risks themselves.
Yeah, okay. Toby?
Yeah, no, well, I think it's worth sort of thinking back about the history of crypto generally, right? Like, I think it's boomed in many ways because of a light touch regulatory environment and has been a good real-time experiment in, if you look at the growth of Bitcoin, the growth of Ethereum, they're some of the fastest growing assets of all time. And then you have the ability of the ERC20s and the NFTs to very rapidly spin up new organizations, deal rapidly with the public. And then if you chat with most participants in the crypto markets, obviously if they're holding assets on FTX or Celsius or whatever, they may feel that clearly there isn't enough regulatory oversight, especially of those centralized entities. If you look at how DeFi generally has handled the crisis, yes, you've had the Luna Terra blow up, but if you look at sort of Uniswap, Aave, the building blocks of DeFi,
All the long-term ones.
They've kept on working throughout.
Yeah, I think that's important. Yeah, agree.
So I think it's almost like for on-chain, DeFi, crypto, all of the experiment, all of the good has been in a transparent way. The organizations that have been the biggest single points of failure have been opaque, centralized organizations.
Absolutely.
That have been more like unregulated banks or unregulated exchanges in many ways, operating somewhere in the Caribbean. You know, it's kind of like, it's not, and that's where the problem lies. The technology itself and the building blocks from it are very, very powerful.
Lots of people mentioning No Names Financial Times have been kind of gleeful about what's happened. There's almost this kind of like, fuck you, you had it coming. You know what I mean?
Stop clock tells the right time twice a day,
times
right?
a day.
Like,
but do you think
That's the other F word that we weren't going to mention today.
Absolutely. But I find this kind of, everyone kind of alludes it to you know, the internet in 1998, and there were Amazon share price in 1999 was this, and there was this, and da-da-da-da. But I don't think the similarities aren't that clear, because I remember when the internet, when I was working as a sub-editor for an IT magazine in Soho, there didn't seem to be hatred of the internet, like utter odium towards it, as there is with crypto. And I do find this kind of like, told you so. I think it'd be quite different in a year's time, you know. And I think, and I'm an optimist still, not hold on for dear life. I mean, Amit, we haven't got much time. We'll probably get them overrun if there's any questions. But Amit, what do you think's coming in? Oh, it's a bullshit kind of thing to say, but not 2023. What do you see happening? I mean, don't talk about Polygon all the time this time, please.
What I see, so this is a stage in the undercurrents actually, a lot of noise has been reduced. By noise, I mean from the builder's point of view, from a DeFi protocol build, financial innovation point of view, we see people who are interested, and we see the people of high quality people sticking to the crypto or DeFi domain. So the natural conclusion of that would be in the next year we'll see more innovation happening.
Whereabouts? What area?
So so the area which, so right now so we have seen innovation in DEXs, but in the next year probably we will see the innovation in leverage margin perpetual futures, because one of the reasons this centralized exchanges were pretty famous in margin trading, taking long positions in kind of a perps. So you will see on-chain perpetuals are tough to build. On-chain, you need a lot of mechanism to make it happen.
Cross-chain as well?
So the natural consequence of that would be the liquidity, the current fragmentation of a liquidity would go away, and you will have those cross-chain liquidity bridges, which would be much more reliable in the next year. People would be able to get more money in and out faster and in a cheaper and in a secure way. So those are the
scale.
Yeah.
Better scaling. So I asked you earlier about Pillar Project, as opposed to asking you another question when you spoke about Polygon. So can we change it? What do you think is happening in 2023, Michael?
Usability.
Usability, okay.
Usability for me to use a decentralized service, for me to use some derivatives, I do not have to go to a centralized exchange or to have a limit order in a usable fashion, so that the average person can actually see Web3 as a viable choice.
Yeah, okay.
In fact, talking about the regulatory aspect as well, it would not even surprise me if some of the CEXs tend to have a verifiable mechanism where they use either a Merkle tree sum or a zero knowledge proof for their users to verify that their accounts and their deposits are being held in deposit by that specific, say, Binance or something like that. And I have seen papers alluding to that in the past few days as well. So
interesting. Thank you. Katie, kind of coming up to final words.
Final words. I'll keep it brief. Okay, so 3 things, I think. First one I've already talked about, which is people becoming more comfortable with the notion of self-custody. The third one is around more real-world assets moving on-chain, and sort of this rise of sort of an attestation industry that needs to grow as a means of verifying, yes, this token pertains to this blade of grass or whatever it is that we're tokenizing. And we will need trusted counterparties in the sort of traditional world in which to facilitate trust that the technology is speaking to what's happening in the real world. The third thing is, again, around tokenization, but moving that conversation along to securitization. So looking at existing payment rails in the traditional space and applying those to this nascent asset class, which is crypto. We're doing it with liquid staking, which we've actually issued onto the Polygon chain, looking at how we can wrap that product up, make an index out of it, and then push that out to traditional institutions. So securitization of those tokenized assets.
Thank you. And thank you for using the word bifurcation earlier. I really like that. Toby.
Yeah, no, I think what we'll see gradually is all of the tools of DeFi just get into people's lives more, and in a way that you'll sort of effectively just be able to be compounding certain assets that you're holding, and as you put more and more of what your own personal assets, your properties and whatever on chain, it will creep into your life in a more interesting way, and people will be able to effectively save and earn yield without needing to rely on banks and the like, and have it all acting on the blockchain, right?
Hallelujah to that. Final word, Jeff.
2023, 2024, I think it'll be less about crypto and more about DLT. Seeing, as Katie Nevergood has said, some more real-world assets being on there or tokenization, securitization, where it's going to be. But I think where we are in crypto now, we're at like a level 1, layer 2, right? We've got some cool apps built on top of it. We can speculate, we can self-custody, we can move stuff around. If we take, like your point earlier about, the internet and Amazon, the guy who invented basically the building blocks of the internet, like 40, 45 years ago, whatever it was just for moving data around. It didn't go anywhere specifically. And then we built another layer on top of it, so you could send it to exactly where you wanted that data to go. Where we are now in terms of like Instagram on your phone, sending a selfie to someone on the other side of the world, that's at like a layer 7. So try to anticipate where this market's going to go. 7 layers where we are right now is kind of impossible.
Yeah.
But I think it needs to be more about DLT, making it usable so you don't know you're using a blockchain.
Yeah. Okay. Yeah. All right. Yeah. Can't disagree with that. Eric, we're kind of out of time, I suppose, but a couple of questions would be great because I'm bored of asking them.
Actually, if could I ask one? I do have a question.
Ask a question.
Katie,
I feel like I'm in the firing line.
I just love what you said, right? I'm a great believer, and I want to believe that code will be law, right? I really do. But what you said about segregated accounts, in the CeFi world, there is an army of people that have written punitive regulations to prevent you messing with segregated accounts, right? How will it work in segregated accounts where code protects those segregated accounts from being leaked, etc.? Will the punitive impact be embedded in the code? Is that how it would work?
I'm not sure I understand the question.
Well, if you...
It's pretty complicated, Eric.
Sorry. Well, if you run a segregated account...
I'm not a technologist.
No.
I'm a PR person.
I'm sorry. No, but I loved your point. Let's just explore it. In a segregated account, if you're looking after lots of different people's money, you have to legally keep them separated in a segregated account. It's possible, true, that code could do that on the blockchain. But if people move it, like happened with the F-word company, people move those funds, where will the punishment be to prevent that, or the disincentive? What?
Save the day, Tobe. Come on, baby.
Yeah, no, well, I was just thinking, after FTX, there's been this whole debate around proof of reserves, right? And in theory, you could have those very held clearly, this exchange is holding X, and it has these liabilities, and they're in these wallets, and you can segregate it in that way, right? I don't know.
But then who's going to stop those being moved?
So, if I may, from half technology, half economics kind of a question. So actually, we are working with one of the largest hedge fund to have this permission DeFi kind of a thing. But the hypothesis is that code is law, but how the code will differentiate the rogue and non-rogue player, and it has to differentiate in a way that it doesn't stores the identity, or other person doesn't know the identity. So there are some solutions in which are very advanced KYC kind of a solution. Yeah. By advanced KYC kind of a solution, what I mean is that there would be some issuer who would be able to issue a claim that suppose you are a person who shouldn't trade with more than $1 million of account, and this is the person who shouldn't trade with more than $100 million of, but the identity would be hidden. The code would never know that these are the identities of a person, and the code would have some functionality to enable that. And that this technology is like, it enables, it is the addition of two technology. First is the smart contract and addition of zero knowledge proof generation. So these are the things which people are actually working on, because the main problem with this permission thing is that even if I am the high net worth person, you are a high net worth person, even I don't want you to know who am I. So you don't want, and I also don't want anyone else or even the code to know who am I. So these are like challenging problems, but maybe cryptographers are working round the clock on.
But on this,
is that all right, Eric? Any more difficult questions?
Toby,
I
I wanted to chip in on this because I was thinking about how slashing works in Ethereum staking.
Yeah.
And in some ways there you do have the network policing bad actors. If you try and do an attack on Ethereum, you get slashed. Yeah. So by extension, you can add in more and more self-governing mechanisms using purely code.
Disincentives, right?
Yeah.
Fantastic. That's the way to go.
Okay, I think we're up. I mean, just... Michael, I did actually see... for it, minute. Michael, I saw you go
for it. Go for it.
No, it's all right.
So go for it.
I was going to say, you have to separate the crypto that they keep from the fiat that they keep. The crypto is far easier to police. Even the Merkelized sum, the proposal does exactly that.
Yeah.
In that any user anonymized, they can check if their asset is still being held. And everyone can do the same thing. So the exchange cannot get away with, say, if they have 500 ETH missing, it would show up.
Also, the biggest proof of testing whether your assets are actually in a protocol or not is being able to redeem them.
True.
Okay, I think we're done. Just to kind of try and close off in a beautiful and elegant manner, Eric mentioned the book that I was reading when I saw him. It's called The Molecule of More. And basically, it's not like evolution, but it just says that some people in life want a little bit more out of life, and they generally push things forward. It's really fascinating. It's not that dense. But I would say that all of my panelists are those type of people. Maybe a lot of people in this room are like that. So thank you for your evolution and your molecules, and thank you for a great panel.
Thank you.
Superb. And thank you, Monty, for beautifully moderating that, as ever. While the panel are exiting, I'll let you know that it is now time for the coffee break. We're going to be back at 11, where is it? It says 11:35, 11:40. But also to say that there are a couple of sessions happening upstairs to let you know about. Education, Neurodiversity, Gender Bias, Web 3, moderated by the amazing Bridget Greenwood. And then at 12:15, Hugo Fehler, CEO of the Minima Protocol, is going to tell us about how they are going to fulfill Satoshi's real dream of decentralization. And having worked a little bit with the Minima team, they've got something really interesting. So don't forget, that's 12:15 upstairs. We will return at 11:40. So it's 11:40 back in here with institutional investment. Are the big players fully on board with an amazing lineup of people like Fidelity, Clearbank, Archax, FMFW, Kex, and of course, the amazing Christina Frankopan from Lazard Financial Advisory. See you at 11:40. Seats. The next session is about to begin. If you come in from the lobby, please come on in and grab your seats. Thank you very much. We'll start the next session in a moment. So the next session is about institutional investment. Are the big players fully on board? And now, just as you know, as becoming the tradition, we're just going to share a little bit of information you might not have known about the moderator or the speaker. And today, it is everybody who's in London will have heard of Rob Gaskell, of course. He's one of the biggest supporters of the industry in the UK. He's the founder of Appold. And of course, his background is from institutional asset management in Switzerland, so he's got a terrific background and experience to be able to moderate this panel. But what you probably don't know about Rob is that he was once rowing for England. In fact, in the European finals, I think you were rowing for England. So here, to keep us lengths ahead in the world of crypto, please welcome Rob Gaskell, founder of Appold.
Thank you very much. Thank you very much. So yeah, thank you, Eric, for that. And yeah, I actually rowed for England and Great Britain, which was pretty tough in those days. But I had to give it up because I had to get my life back. So welcome everyone to this panel where we talk about the institutional investment, and the title of this panel is really about, are the big players fully on board? And we're going to talk about this because we think that there are maybe some attitudes changing, but we hope things will settle down, obviously, over the coming months and years, and we'll see increased adoption. So what I want to do first is for the panel to introduce themselves. 1 minute each, please, and I'll start with Charles.
Hi, good morning, everyone. I'm Charles McManus, CEO of Clearbank. We were founded, I was one of the founders 6 years ago, new clearing bank, cloud native, and trying to do all the things that other banks don't do. So we don't lend a cent, we don't do credit, all of our balance sheet is 100% cash at the Bank of England. So it's all about transactions, it's all about innovation, it's about embedded banking, and bringing financial services to all of our B2B customers of EMIs, banks, etc. And in that vein, we are privileged to bank a large part of all the regulated exchanges, from Coinbase to Gemini, to Robinhood, Ziglu, BCB, etc., etc. And we're very keen to play our full role in that space between the on-off ramps, between fiat and essentially digital assets. So I'll stop there in relation to, there'll be more to say later.
Okay, Danish.
Good morning, everyone. My name is Danish Chaudhary. I'm CEO and founder of FMFW.io. It stands for Free the Money, Free the World. It's a spot and margin exchange we launched about a little over 3 years ago as part of the Bitcoin.com family. We serve pretty much most geographies outside of the US and Japan, and work with both retail and institutional clients. My background's in the institutional side of things. I was a PM at BlackRock, so I know how people think about certain digital assets. And yeah, I've been through 4 or 5 different bear markets, so here still, sort of thing.
Good morning, everyone. My name is Richard Evans. I'm here from CEX.io, or you can pronounce it however you wish, as long as you remember who we are. We are in our 10th year. We started as a crypto miner, and we've mined over 500,000 of the Bitcoins in existence. Our organization has pivoted from that to be an ecosystem of services to both retail and institutional investors, spanning trading capabilities, so disintermediating multiple different exchanges for counterparty risk and using our treasury so our clients don't have to use it, to staking both from a non-custodial and custodial side so you can keep your assets in your wallet, and also from a lending perspective, purely on a collateralized basis. So we've managed to avoid the majority of the challenges of the industry. My background is 25 years in traditional finance in a number of US major investment banks, and I now run the institutional business at CEX.io.
Great. Hi, everyone. I'm Christina Frankopan. I'm with Lazard Financial Advisory. I sit in our financial services and technology team. So we advise institutions, major tech majors and fintechs on their M&A, corporate financial and strategy needs. I also work very closely with our venture growth banking team, which advises on fundraisings, purely focused on B2D rounds, and we work with companies on a sector-neutral basis. I think we're the largest globally on a sector-neutral advisory basis, and introduce them to the broader Lazard network. When I'm not with Lazards, I've been advising VCs on blockchain and crypto investments since 2015. Also work closely with technologists on the ground. And from time to time, I'm also a blockchain expert for the EU Commission.
Good morning, everyone. Simon Barnby from Archax. Archax is a fully FCA-regulated digital asset exchange, brokerage and custodian. I mean, my background is from working in traditional financial markets as the whole team at Archax, or the core team anyway. And really, we kind of embarked on this journey to build a digital asset ecosystem that is regulation first, institutional grade in nature, with a strategy of sort of leveraging what's being pioneered in the crypto space and producing and launching products and services that are palatable to the traditional institutional regulated world. We're in the process of going live at the moment.
Hi, Chris Tara. So I work for Fidelity Digital Assets. I'm head of institutional and head of Europe. Fidelity Digital Assets is part of the Fidelity Investments Group. Fidelity Investments has around $8 trillion in assets under administration. And at Fidelity Digital Assets, we provide two services. One is a prime services business, and the other is issuance of asset management products.
Okay, thank you very much, everyone. I'm going to start with probably one of the most important questions, and this related to the panel. So please, all of you, give us an update on the institutional adoption of digital assets that you're seeing, such as any changing patterns of behaviors, expectations, or inquiries. And we will start with Chris and work down.
Sure. I mean, I would say, I guess it depends. You could answer that question in a few different ways depending on the time frame. I'd say certainly over the last several months, one of the things that we've definitely seen in the aftermath of 3AC and more recently in the aftermath of FTX is somewhat of a flight to quality. I think the crypto ecosystem is very diverse, and I think that in periods of stress, people lean into trusted brands. And so, clearly a lot of people have lost money, and it's terrible what's occurred on a number of different fronts. It's bad for the industry overall. Where Fidelity sits within that industry, it's been a net positive for us as a group.
Yeah, I mean, I echo kind of what Chris has said, and I think that flight to quality is definitely what is happening. I mean, Archax, I mean, we're only launching at the moment, but the whole concept behind Archax was to produce an ecosystem that serves the institutional client base. And actually, we've one sort of good example is we've just closed a funding round, our Series A round, and that was led by Aberdeen Asset Management, who are a very conservative, big asset management company. They're now our largest external shareholder and are working with us to tokenize their whole suite of funds. So, the fact that a company like that is getting involved, I think, shows, institutional adoption. And the important thing also is that, they invested in us through crypto winter. We were clearly quite nervous that they may pull out or take a step back because of that. But, they're very visionary. They have a 10-year plan. They said this is just a blip. Thankfully, we closed before the FTX debacle, but I think it shows real institutional adoption and institutions coming in. So.
Yeah, I think it's important to kind of emphasize what adoption really means in this context, because there are, the headline grabbing stuff is what's going on in so-called crypto and, tokenized markets and for the most part looks like speculation. So, there is some institutional interest in adoption for those use cases, which may or may not turn out to be useful and important going down the line, but there's a lot of other areas where institutions are focused. There are, applications for back office utilization of blockchain technologies, or DLT more broadly speaking. And I think, the examples we've just heard speak to, the range of interest. What I'm seeing is that there's a bit of a bifurcation, if you like, between institutions who've invested the time, effort, energy to educate themselves about what this technology actually is or does, or the potential use cases. And those ones are not really changing their strategies. It might be knocked back a little bit at the moment, but they're moving forwards because they understand what they're doing with it. The ones who are kind of crypto curious or crypto skeptical, I think at the moment are going to struggle to catch up or to make that commitment to educate themselves. And I think that we'll see a range of institutions that will be a bit more polarized as we go forwards.
Yeah, I agree with everybody what you've said so far, and the summary is it's varied. How do you define adoption, but also how do you define institutions? If you're a market maker on various different exchanges, whether it's TradFi or crypto, you're very much present in the crypto ecosystem. If you're a major investment bank, you have teams of people who are investigating this space right now, and you have done for a couple of years. I think one of the things that's slightly missing at the moment is we tend to focus internally in terms of what's happened in the crypto space to change adoption. But actually, we've also got to look at the broader macro picture. Interest rates right now relative to where they were 1 and 2 years ago, and the availability of capital is completely changed. And that's changed people's mindset in terms of where should they be allocating money. So if you can get 4.5% external to crypto compared to 2 years ago where you were struggling to get 1% on your deposits, then that's a very fundamentally different situation. So the adoption is changing, not just because of what's happening in crypto, but also what's happening in the broader macro perspective.
Yeah, I'll echo what everybody said before. There's two sides, there's multiple aspects to this. And as of now, there'd be two sides, pre-FTX and post-FTX. From an exchange perspective, pre-FTX, we saw a lot of hedge funds, a lot of institutions coming with us, more on the speculative side of things. And post-FTX, some of those mandates have stopped. Half of the market makers don't really kind of exist anymore. But we've also, from our venture side, we work with large institutions to invest in the space. And those are the guys who are really curious about the technology, the DLT side of things, and actually building solutions that institutions and corporates can use and retail people can use. So that interest is still there. Those mandates are still there, and term sheets are still being honored. But from the speculative side, I think that's kind of slowed down, and flight to quality is now going forward.
Just to say finally, I absolutely agree. We're very much focused on the non-speculative side in relation to use cases that we talked about. Interest rates is a really good one. We've seen tremendous growth as the yield curves are all moving in the UK and in Europe as well. So companies, fintechs like Chip and Raisin and others actually taking off in relation to savings products. However, on the consumer side, obviously volatility creates transactional volume. Unfortunately, it's been the wrong way around as everyone's been selling. So all those exchanges have seen higher volumes, but is it sustainable in relation to that? I think the good part about all of this, as we'll come on to in terms of regulation and where the industry is going, is proper use cases at the highest level of regulation and standards. That's what will change our lives, and the T word, as compared to the F word, put trust back into the system in relation to banking licenses and standards and audits and reserve statements, transparency, and actually people complying and operating sensible businesses in that flight to quality.
Okay, thank you very much. I mean, to sum that up, I think it's very clear that there's still investment going on, although it's much more considered. And the use cases for decentralized ledger technology are still being expanded on, and in DeFi, nothing's stopping. So institutional-wise, I think they're slightly concerned about recent events, but they're moving on, aren't they? And the inquiries I'm getting are really still pushing on and not stopping, or projects aren't stopping. So I think we should just, as Charles mentioned there, regulation, I think we should just touch on this if we can. So are you happy with the direction of regulation specifically in the UK and the recent announcements from the government about the UK becoming a crypto hub? Is the UK falling behind Europe and the US, or could they actually take a lead? And I'll start with Charles on that.
I'd like we've heard a lot of speeches and a lot of hype. I was at UK Finance, for example, the Guildhall a couple of last week, and yet another task force up on tokenization in relation to. So people aren't using the word now stable coins or digital assets or crypto. It's all tokenized deposits is the latest buzzwords out of the FCA in relation to all that. We've been slow. No question about it. I think Europe is actually doing quite a good job. I think there are so many different groups that are going at the moment, from central bank digital currencies, retail or wholesale, tokenized deposits, sort of FCA behind on their approval of crypto licenses. Very, very complex environment out there. We don't need more task forces, we need some execution. We really do, and creating more groups. We know London as the centre in relation to the finance centre and the flow. It's perfectly positioned for this market if we can get it right, and we can get the standards, regulation, etc. Very quickly, though, a bright spot, you'll have seen the Deputy Governor's sort of recent speech in relation to looking at the F word and the debrief. I think it was a very good speech. There were three aspects there arguing for regulation that he summarised in that speech, all of which is all common sense. But very quickly, number one was to stop investors and consumers losing money. So essentially protection in relation to that, where in the pioneering phase, everyone has to lose a load before we finally get it right, which is understandable. Number two, essentially, is financial stability. Well, has there been much impact from this in the real? No, but there's a lot more perhaps we don't know about in terms of banks and others that are affected by what's gone on. And thirdly is the point that we've heard quite a lot of arguing for regulation, which is the technology and all the full starts. There's some great stuff that's really being done on smart contracts, on atomic settlement, encryption, tokenization. Get that use case and bring it to bear for our daily lives with some regulation, and it's going to transform the world. That's very much where we are.
Anyone else want to say anything on that?
Yeah, we'll. Sorry, were you going to? Just from our perspective, we haven't pursued a license in the UK. We have licenses out in Europe and a few other countries, but to us, it's more a matter of understanding the space from a CFI, DeFi space before creating the rules. If the UK and London can do that without painting everything with the same brush and saying, hey, we have traditional finance and those are the same rules that are going to apply to the CFI, DeFi space, that we think is wrong, and that's not something that will help the UK propagate. We sit in offices in the Caribbean and parts of Africa with the ministers, helping them craft the regulation, helping them understand, and I think if the UK takes a similar sort of stance, then it has a chance.
Yeah, I was just going to add. I mean, we started our journey with the FCA, 3 years ago, and then we kind of felt that they were actually quite forward-thinking and they had quite well-formed opinion about crypto and how to regulate it. But then came the Crypto Asset Register, which is a relatively recent thing, and there they have, the way they've implemented it, they've kind of overreached their how they're trying to do it. And I'll give a couple of examples. One, a traditional broker has to get on the register if they want to do crypto. Now they already have anti-money laundering processes in place. Why do they need to do them again? And also it's driving innovation offshore, which is exactly what shouldn't be happening. And, a few examples of that. I mean, blockchain.com, a British crypto unicorn business that's been here for 10 years and was happy here, couldn't get on the register, got frustrated and has moved offshore. BCB have done the same, Copper have done the same. You've got these credible businesses moving offshore. And the most ridiculous thing of all is they continue to sell the same service to the same people in the UK. So we kind of lose the control that the FCA were trying to get. We lose tax and we lose innovation. So at the minute, things are not right. And some of those things really need to change.
Can I just add something to that? One is sort of part of the challenge space, and one is, slightly sunnier way of looking at it. I think another thing that's a major challenge is that, this is a very technically complex space. And, talent retention, for a start, from the policy side is is difficult. And in addition, as one institutional investor, growth investor, said to me the other day, actually we see this in some ways less as a fintech opportunity and more of a deep tech opportunity. So for us to understand actually what's going on at sort of protocol layer and how the technological innovations or privacy tech like ZK Starks and so on work is difficult. And so in some ways, I kind of sympathize with the challenge space. On the sunnier side, I think, London, to your point, is a major fintech innovation space. It just is, and it remains so. And there is commitment to maintain that, and there's recognition that work needs to be done to maintain that. And I would see the kind of blockchain crypto space as a subsection. So notwithstanding the challenges, I think, the fact that there is dialogue, there is commitment, and there are pockets of real excellence in that dialogue space, I think is a positive.
The one thing I would just say is that, the question is like, are we behind? I would say we're unquestionably behind. I mean, if you look at when, the EU did the first consultations for MiCA, that was back in 2018. That will go into full force and effect in mid 24. It's a very long process. It's a 6-year process, and we're only just starting to get to that phase in the UK, I feel, now. I mean, we've had meetings with the FCA, HMT, Bank of England, all in the last 3 or 4 months, and everything we're hearing is very positive, but, the proof is always in the pudding, and we just haven't got any detail yet. And, to Simon's point, I think that there's obvious, things that we could be doing. Do you need to go through that same registration process? And that registration process right now is running to, it's more or less a year. So it's laborious, it's hard work, and we are seeing people move offshore, and I think that is an issue that we need to resolve quickly.
And just adding to that, I think the losers at the end of the day are the retail investors who don't have any protection because the regulators are not overseeing them. I am slightly sympathetic to our regulators here, though, because if you think about the political climate over the last 5 years, it's not exactly been easy. So the leadership from a regulatory perspective starts with the political climate. That's been impossible, I would say, and it's been stop-start. Now's the time. Now's the time. We've got some slightly more stable leadership, and hopefully, you talk about MiCA. MiCA's kind of there in the EU, and ironically, we're no longer part of EU, but we're still talking about it.
Yeah, I think what we need to see, though, is just a strategy around this. I think that if we are going to become a crypto hub and catch up with some of the other jurisdictions around the world, so there isn't a jurisdictional arbitrage happening, we have to build a strategy rather than just stand up and say we are going to be a crypto hub. There is, and put some of those building blocks in place to get us there. That's what some of the lobby groups are trying to work on, and some of the institutions in the digital asset space are doing. So in the interest of time, I'm going to jump to the last question, which leads on nicely, I suppose. What are some of the best ways we can bring confidence back to the market for institutions, and related to all of the topics we've talked about now, from each of you, what do you think is the best way we can bring back some confidence and also take on get the opportunities, working well with the opportunities that can be laid in the space?
I'm happy to start. So firstly, I think the crypto ecosystem likes to invent terms where those terms are not necessary. And there is a language within crypto that makes the TradFi community nervous, right? There's a very standard piece of terminology statement in TradFi: you don't invest in something you don't understand. And crypto is just full of new terminologies for things that are not necessarily required. We use terminology for things that are very similar to TradFi, but they're not the same. APY versus yield, for example, relative to inflation of the blockchain. They're not the same, but they sound the same. So there's this confusion. We talk about the Mango hack, right? It's sensationalist. To me, in TradFi, or having grown up in TradFi, I see that Mango arb, right? The arbitrage that a trader happened to execute, that is something that in the TradFi world, everybody be going, wow, what an amazing trade. Are there any more? And if we can better describe crypto in a language that TradFi understand, then I think that would be a huge step forward. The second thing I think is you've mentioned it earlier, we need just more real world use cases, right? So projects that are coming up where they're like, you know, you read the white paper and you think, what really is this? What is the real world use case? If you want TradFi investment in crypto, we need more real world use cases. And then the third thing, I think, is we seem to have forgotten the G in ESG. The issues that we've seen over the course of this year, I think Terra Luna, very different. When you think about Voyager, risk management, right? You don't lend 43% of your assets to one counterparty. But the rest of it is a failure in corporate governance. Where is that G from the investment base currently right now? And where is that G governance within the crypto ecosystem? There's something very famous within TradFi, it's called the 30% Club, and it forces at least 30% of representation of boards to be women. I'd love to see in crypto at least 30% representation of boards and projects to be from TradFi. Because I think we need that seniority, we need that history, we need that leadership. You look at FTX, it was 0%.
I think yeah, governance is absolutely the big missing thing here. And what surprises me, and you touched on it, is that investors in some of these projects aren't insisting on 30% or aren't insisting on governance. They're just allowing the tech projects to just go ahead and not necessarily put those things in place.
And I think a big part of that is chasing returns, right? And I think the other big thing that has changed, is people looking at returns in the right way, which is risk-adjusted returns. And I'm not talking about risk-adjusted returns relative to volatility and Sharpe ratio and Sortino ratio. I'm talking about risk-adjusted returns relative to counterparty risk, credit risk, trading and settlement risk. If you don't get your money back, it doesn't matter whether you made 30%. If you don't get your principal, you've lost 70%. And that mindset hasn't really been there in the crypto world. It's just all been about non-adjusted returns and the headline number, similar to APY versus yield.
Okay, Dinesh?
Yeah, I mean, I completely agree. I think governance is a big thing. I think it goes both ways, where the institutional side needs to look into our industry and kind of hold us using the same rules that they would otherwise. So, for example, especially in the venture space where we see all the time, you know, the fact that Temasek, Sequoia wrote $100 million checks to FTX without actually doing any due diligence kind of validates this industry, saying, hey, you know, we had a $32 billion unicorn by all these people, so TradFi is in, but none of them did any due diligence. So that, it kind of goes both ways. On the other side, I think from our industry specifically, I think there needs to be a little bit more transparency. You know, Celsius, Voyager, BlockFi, lack of transparency is what kind of eroded confidence. And I think going forward, that needs to, from an institution perspective, from a blockchain or crypto institution perspective, that needs to be heightened, and that clarity needs to be given to anybody who's investing or any retail or anybody of that sort.
Anyone else?
Yeah, I mean, for me, the front line right now is the knitting work that needs to be done between TradFi and DeFi. And I'm really hoping that as we enter this next phase, you know, of ecosystem development, that we don't throw the baby out with the bathwater and do recognize that there are applications of DeFi that are useful and can be married happily with TradFi. You know, unfortunately, that nexus has kind of met recently in what's known as the CeFi space, and the governance failures have happened there. So that's the nexus that needs to be worked on. I mean, just a short example of where I think interesting things are being done. You may or may not be familiar with the SocGen Forge platform, and they've been working with MakerDAO, you know, on productizing, you know, collateralized loans and tokenizing collateralized loans. So linking real-world assets onto on-chain applications. And I think those sorts of things that are moving a little bit beyond experimentation, you know, really platformizing and productizing that interface and doing it in a regulated environment, I think is where the interesting stuff will happen and where the governance risks need to be addressed most urgently.
Yeah, I mean, I reiterate what everyone has said, really, but I think on the regulation side is interesting because, you know, crypto regulation is you know, it's a very early stage. You know, a lot of things still need to be sorted out. And it's challenging also because you've got regulators regulating crypto in different ways in different parts of the world. I mean, here in the UK, you know, crypto spot is unregulated, crypto derivatives are regulated. In Singapore, MAS is the opposite way round. So, you know, as well as having a sort of a regulatory regulatory landscape that's ill-formed at the minute. You know, it's got a long way to go. There's lots of different ways people are regulating it. So regulation is key, but it's a complicated journey still to go on.
Yeah, I mean, I would just say that, well, first of all, it's important to draw the distinction between crypto and sort of tokenized real-world assets. Like, I think that, you know, as institutions look at tokenization, you know, are the events of this summer going to impact those plans at all? No, no whatsoever. And I think that people have looked at tokenization, and I think people have been sort of slightly disappointed because the technology arguably was in place 5 years ago, but you then just have this coordination problem. It's, you know, if you're looking at sort of public market securities, you need the issuers, the banks, the CSDs, the custodians, the regulators. You just need so many people to come over the line at the same time that I think we're far more likely to to find other sort of non-public use cases first. But I think those plans are sort of separate and distinct. As it pertains to crypto assets, I think it's, again, it's important to sort of highlight that this isn't a failure of technology, it's a failure of human nature. And so, I think that as institutions look at new technologies and how they're going to incorporate different asset classes within their businesses, those decisions are made over years. They're not made over days and weeks. And so I think that, will this cause people to take a step back and take stock of the situation and see where the cards fall? Absolutely. Is this an existential crisis from which, crypto will never recover? No, not whatsoever.
Okay, so I'm going to finish with you, Charles. What do you think can be done to bring even greater confidence on top of what's already been said?
Well, I'll pick up a few themes in relation to that. I've been on bank boards virtually all my life and lived through the Barings crisis, where the Barings board hadn't got a clue in terms of the monthly remittances from Mr. Leeson from Singapore, took the money every month but haven't got a clue what risk was. And it changed again in relation to directors on bank boards should know the risks that have been taken. We shot the NatWest 3, who played with Enron and ended up being extradited to the US for greed in relation to SPV structures on Enron. Let's get back to mortgage-backed securities in relation to the US and the whole credit crisis. I lived through that as well in terms of the Lehman's closeout with cardboard boxes. It goes on and on and on, and what are the ingredients in relation to getting to the bad actors? Someone said on an earlier panel, not very eloquently, this is going to get rid of the garbage. Yes, of course. So how do we get the T word back? A number of the things here. I'm a massive fan. I don't like regulation, even though I've been regulated all over the world all my life. It's common sense. In running a business properly, you don't need all the rules and regs. You should have segregation of duties. You should have transparency. You should have 3 lines of defence and internal audit reports and sign-offs. And when a CEO is asked, is it asset-backed and where is your security, you should be able to show the public it's there and it can be audited and it's real. And until we get back to some of that stuff in relation to the good guys like Archax and others that we're actually talking about and trying to raise the standards, the T word for consumers, investors and losing the money just won't be there. So clean up the act and actually get London up there and raise the bar in terms of standards that people can rely. Investors come to London because we've got great legal aspects, we've got great resources, use that in this space and show that we can lead. The final aspect is use cases. So we are, for example, with PEXA, putting the whole UK housing market on a blockchain and getting rid of chains such that real-time everyone can actually settle their housing market in one hit. Pick a time, done, clean up. There's lots of things where we can show the technology use cases to then get to digital assets and all the other things. And I want to push more of those, that people get more familiar and comfortable with the space.
Fantastic. So we've got 2 minutes left, Eric. Have we got time for one question maybe, or?
And please say your name and then your question. Microphone, please. Wait for the microphone, please. That'd be great. Go for it. Keep trying. He'll turn it on.
Hello. My name is
Again, keep trying.
Hello.
Yeah.
Now, I'm Lily Anna Rizor. My question is, well, excellent panel, great moderator as well. You both are discussing cryptocurrencies, the non-security types, and security tokens, or what belongs to the security regulated world together. How do you view, will the industry move more towards security tokens rather than the non-security tokens? Obviously, Simon, I understand your company focuses mainly in security tokens, correct? Like that will fall under the security regulations because securities are securities, whether you put them on the blockchain or whatever technology you choose to.
Yeah, I mean, our focus has been security tokens because they're regulated digital securities, whatever you want to call them. But we handle unregulated assets like crypto, like Bitcoin and ETH as well. And our approach is, okay, we take a regulated approach for unregulated assets. So, you can kind of take best practice from the regulated and traditional world and apply it to the unregulated world. So that's kind of our approach, so that you kind of get the best possible handling of unregulated assets alongside regulated ones.
So the question is, will there be more security tokens versus the current non-security cryptocurrencies from an institutional point of view? Question for everyone. Fidelity, I don't know if that's the plan.
A quick answer to that, if you look at the cryptocurrency market, it peaked at 3 trillion, it's now sort of back down to 1 or more thereabouts. If you look at all assets globally, it's about 1.4 quadrillion. So there's a massive market there that can be tokenized. So I think, in over time, and it's going to take some time for digital securities and security tokens to really get traction, but over time, I think that is the prize.
Sorry, thanks. We've run out of time now, and I just wanted to say a huge thank you to the panel. I think everyone will agree here we got some really good insights on what's going on in the institutional market. So thank you so much, everyone.
Thanks.
And also, if I may, a big thank you to Rob for moderating that one. Much appreciated. Please leave the chairs, leave the microphones. We do need them. But thank you very much, panel. Now, as we clear the stage and prepare for our next speaker, I want you to think about what's happened recently in the last 12 months. We used to call speakers like James Ramsden, who's about to speak, Queen's Counsel. But of course, now we have to call him King's Counsel because the world has changed. So I'd like you to welcome James Ramsden. He is going to be talking about crypto assets, cybercrime, and cross-border enforcement. But, as is traditional, what a lot of people don't know about James is that he's actually a farmer, in addition to being a King's Counsel. He farms in a vineyard in the West Country, and he also uses drones to figure that out. So you found the previous talk quite interesting. Please welcome James Ramsden, KC.
Yeah, sadly we're not big enough for a satellite yet, but we do use a drone, and equally sadly, I have to confess, we haven't produced a single bottle of wine yet, but this time next year, we could be inflicting on the world the first ever Cornish Sauvignon Blanc. So there we go. Back to the day job. I've got my own take on the current crisis, and you might think it's a slightly odd one. You remember that film, We've Got to Talk About Kevin? In fact, the book was scarier than the film. I just got this vision of Barbara and Joe Bankman-Fried sitting around the kitchen table 15 years ago with little Sam bashing around in the bedroom upstairs. And Barbara says to Joe, hey, look, we've really got to talk about Sam. The issue, I'm afraid, is that conversation never took place. And a lot of people are paying the cost of that now. I agree with a lot of what's been said, little unscripted start, from the Lord Mayor to James Bowater to Monty Mumford. There's nothing crypto-centric about the crisis in the sector at the moment. It's old-fashioned lack of governance, lack of oversight, and dishonesty, pure and simple. I remember the Aramasoft fraud. I acted for creditors of Aramasoft back in 2002, a darling of the dot-com boom on the New York Stock Exchange. If you substitute Royce Payardis, its CEO, for Sam Bankman-Fried, you have in profile and concept exactly the same failures and exactly the same dishonesty. The answer? The answer is a simple one. In times like this, just as in the dot-com boom, it's time for smart people of integrity to step up and take back control of the classroom. And that's what the next 2 days is partly all about. Now, I've been asked to make up a little bit of time by Corby, which is a big ask of a lawyer. So I'm going to do that. So this is going to be a little bit breathless. But I'm going to be hanging around for the rest of the day like a stale smell. So if you want to ask some questions, put a bit of context to what I'm going to cover, tap me on the shoulder, and I'll be very happy to talk to you. So that's where we're going to go, and we're going to go relatively quickly. Two key fulcrums which are governing all of our rights and entitlements at the moment in this sector. Obviously the courts, obviously legislators. I'm going to come back to legislators towards the end because, as has been observed in the previous panel, they are a long way behind the curve and we're lacking in detail. But I think we'll get there, and we can't pretend that the current crisis isn't going to affect how we get there and how quickly we get there. So the current emphasis is on the courts, and we have a distinct difference between what we lawyers call the common law courts, where we have case law and we set precedent, we make law in our courts with judges, and the civil law jurisdictions. Most European countries, a good example, the Benelux countries and France, where their parliaments set the law and the judges simply apply it. They don't interpret it and they don't make law. The common law has driven development in crypto because in most cases where significant crypto litigation has resulted in a change of rights and entitlements, it's been in the common law courts, and we'll see that. We also see a huge gathering of expertise, particularly in this jurisdiction, and sadly at the cost of law enforcement agencies, people setting up very effective forensic investigation outfits able to help in the detection and recovery of stolen crypto assets. The English courts in particular have set their stall out to be the jurisdiction of choice for crypto disputes. So straightforward contractual disputes, regulatory disputes, but in particular, the tracing and recovery of stolen or missing crypto. So how do cryptocurrency claims work in that context? They work in the following way. In 2018, I randomly, as it turned out, happened to get the first UK freezing order in relation to crypto assets. And since then, we developed a lot of experience and expertise in both the court orders necessary and the technology that goes with it. What about the court orders? In this jurisdiction, and indeed in most common law jurisdictions, and I include in that all the Eastern Caribbean, Singapore, Canada, Australia, the courts will give freezing orders to somebody who has lost crypto assets. The problem with crypto assets is that you very rarely know who it is you are chasing as a defendant. And over the last 2 years, the English courts, followed by Singapore, followed by the Eastern Caribbean, BVI Cayman, have allowed orders against persons unknown. So you have no idea who your fraudster is, but you know there's been a fraud. That's a development of the law in relation to defamation online, where you essentially don't know who's published something defamatory, so you just get a takedown notice against persons unknown. This has become hugely important because that was the big roadblock to most interim applications. And how does that work in practice? That's where your forensic expertise comes in, because what you will find, even with the most sophisticated fraud, is that somewhere along the evidential chain, there is an identity tag which will crop up. With an exchange, it should be there in their KYC. It very often isn't. in transactions where identity has been disguised, there will come a point in our experience where the fraudster will have to interact with fiat or the non-tech world in some guise or another. And it may be something as innocuous as an SMS message, a WhatsApp, or Telegram message, which allows you to tag their identity, or at least tag the identity of somebody through whom you can trace their origin. So the English courts, and indeed the common law courts generally, are now pretty well versed in this kind of claim. And they are quite commonly granted now, including persons unknown orders, and they have been very, very effective in tackling the problem. What is developing now is better KYC at various stages of the process, particularly with trading platforms and cryptocurrency exchanges. 4 years ago, I did a big injunction in the Cayman Islands for one of the leading crypto exchanges. At the time, they were accepting KYC, which was no more than their client taking a selfie of themselves holding up their local ID card or driving license. You couldn't read it, you could just about make out the photograph on it, but that was it. That has changed out of all recognition now, and that is making life a lot easier. So, where does the law made by courts help us especially? And this is probably the most important aspect. For the last 2 years, in this jurisdiction, the English courts, that is, not the legislators, not Parliament, but the courts, have decided that crypto assets should have the status of property, such as this dais. So not securities, as is the US view, not currency, as is the view in some civil law jurisdictions in Europe, but property. That is hugely significant, and we'll come to how that's possibly going to be refined in legislation in this jurisdiction and elsewhere in due course. But for the time being, that is the nuclear weapon. Because if somebody takes your property, you have what we lawyers like to call a proprietary right to trace it. So you don't just have a claim for damages, you can follow that property through any of the assets your fraudster has. So if they bought something with it, or they have hidden it somewhere, you have an entitlement to that property. They hold it on what we call a constructive trust. Effectively, they are custodian of that asset until the court decides how much of it should come back to you. And very importantly, if you go to court and get a freezing order in this jurisdiction, in Singapore, New Zealand or BVI, now Cayman Islands too, ordinarily, if you're just freezing someone's cash, they can use that frozen cash to pay their lawyers because you don't own that cash, you just have an entitlement to damages. If it's a crypto freezer, then that is your property, and they can't use any part of that to pay their lawyers. And I have to say, that's a game changer in most cases, because they want to come and talk to you rather sooner than they might otherwise do. Now, we'll come to regulation shortly, but it is likely that this aspect of the common law, the law developed by judges principally in this jurisdiction, is going to form part of the Law Commission, the UK Law Commission's proposal to the UK Parliament. And rather than simply designate crypto assets as property as they are now, which conceptually causes some people some issues, what is more likely is that English law, and I suspect the rest of the common law world, will adopt a bespoke, specific category of asset, which will be crypto assets. But, crucially, the protections that follow from it being property, namely your right to trace it, your right to recover assets if that crypto has been used to purchase a car, piece of art, smart watch, whatever. Your right to get that asset, sell it, and recover your money is likely to be retained. And, well, we'll see. Jurisdiction. This is the next most important flag. The nature of crypto trades has made the conventional assessment of where you're entitled to go to court extremely difficult. Ordinarily, you look at, in this jurisdiction, whether the contract under which you're suing was made here, whether the asset that you are arguing over exists physically in this jurisdiction. Other common law jurisdictions have variations of that, whereby you look generally at the nexus of the dispute and the parties with that jurisdiction, but huge uncertainty. Once again, the English common law courts in the last 2 years have sharpened up that problem very effectively. And once again, it looks like the Law Commission are going to follow the common law, whereby jurisdiction, your entitlement to go to a court in a particular country, will be fixed by where you are, you, the owner of the crypto asset, even before you've established ownership of it, as it happens. So if you claim to own it, you have a right to sue wherever you happen to be. And that doesn't mean domicile, doesn't mean residence, doesn't mean tax domicile. It's where you happen to be operating as a matter of practicality. And that is a hugely important potential change to the law. In this respect, the civil procedure rules, the rules that we are governed by in this jurisdiction, were very recently changed, about 5 weeks ago. And they also allow now anybody to go to court here in England and Wales, and we think this is going to be followed again in the other common law jurisdictions, to obtain disclosure orders in advance of actually issuing any proceedings at all, which can be served outside the jurisdiction. Previously, you could only do that within the jurisdiction, so your target had to be here in the UK. That has changed, crucially. So I can go to the High Court tomorrow, I can tell a judge that my client thinks he or she's been defrauded. We think we know who the defendant is, or maybe we don't. Actually, we have no idea, but we know where they might be, or we know where they might be sheltering, or how they might be sheltering. And the court can make a disclosure order, which I can then send to lawyers in the BVI, Singapore, the Bahamas, topically. And I can get that information, and I can use that to frame my claim. And in harness with that, not just because of crypto litigation and crypto's designation as property, the rules have also changed to allow similar powers of serving disclosure orders outside the jurisdiction in circumstances where you're making a trust claim. Now, it doesn't mean to say that's a written trust. You could be what we call a constructive trust. Somebody steals your property, it's your property. English law says they hold it as your constructive trustee, as your custodian, until your rights are resolved. Recognition and enforcement. So everything goes swimmingly. You get your enforcement, you get your disclosure order, you sue, you get a judgment. One of the big difficulties that we have confronted is enforcing. And I think we're going to see this in FTX, frankly, because who knows where that's going to be litigated, whether in New York, whether in the Bahamas, whether elsewhere. Get a judgment, fine, but then go and try and enforce it. Recognition and enforcement of judgments is particularly difficult. But again, the English courts, I'm happy to say, are at the forefront of resolving this. And particularly in reciprocity. So most foreign jurisdictions will say, that's fine, we'll enforce English judgments, but you've got to enforce ours as well. And up until recently, English courts had a real difficulty doing that with jurisdictions that were not common law jurisdictions such as ours, and particular Sharia-based legal systems. That has changed, and that has changed very importantly. About 12 months ago, the English Commercial Court here in London recognized for the first time a Sharia judgment from the onshore court in the UAE. Now, there's something called the DIFC, most of you are familiar with it, which is their offshore jurisdiction. I think, the first recognition action for a DIFC judgment here in England, but actually that was pretty uncontroversial because it's, in all but name, an English system, and no one is squeamish about procedure or natural justice, but a Sharia law system is very, very different. As a consequence of that, and this has real relevance to crypto litigation, the UAE has effectively said, we've now got reciprocity, not just within the DIFC, but onshore in the UAE, That has huge implications because the UAE has become and will continue to be a big center for crypto trading. Third-party responsibility. Particular hobby horse of mine, not least because I'm acting for the defendants in the claim brought by Tulip Trading, which is the corporate alter ego for our friend Craig Wright. And he's suing 16 core developers who were the core program writers for the Bitcoin network. And he's suing them because he was the victim, he says, of a hack in which he lost $4.5 billion worth of Bitcoin, alleged to be part of Satoshi's originally mined cache of Bitcoin. Setting all that to one side, he says he can't identify the hacker, and he's not showing very much inclination to do that. Instead, he's gone to the core developers to say, you've got the tools and the expertise to reverse this hack. You can fork, and you should do that because you owe me a duty as somebody who uses the network. You owe me a duty to do that as a matter of English law. Now, most of these developers are sitting in LA, a couple in Switzerland. They don't want to come to this jurisdiction and have to answer that claim. Now, earlier this year, we defeated that claim. The English court said, no, core developers do not owe those duties at all. But actually, 2 weeks today, we're in the Court of Appeal, where a different result could flow. And that could be accidental for this sector, because where does that end? What duties would exchanges have? This is quite apart from regulatory obligation. This is common law duties of care, basic duty of care. And Wright says fiduciary duties, duties of good faith. Where would that end for third parties? That is an area of the law which is going to be developed very critically in the next 6 to 9 months, not just in that case, which could end up in the Supreme Court, in my view, but by regulation, because the Law Commission are looking at that very fact. How do we do that? My view is that if you start imposing duties on core developers, all of whom act voluntarily, as we all know, in running the system, you're going to chase this back into the shadows, because who will want to sit there placing their program on GitHub, as these guys do, and then run the risk of facing a multi-billion-dollar claim in some jurisdiction you've got no connection with? It's pretty unattractive. So watch this space on third-party responsibility. Then we come to regulation, which I wasn't going to cover off, but I think it is important in light of what's been happening. The regulators are looking very closely at who owes what are effectively custodian or trustee duties. Now, they won't use that language in the legislation, but that is in practice what they're going to look at. And they're going to look very, very carefully at mis-selling. That, I think, comes out of Terra Luna much more than FTX. But mis-selling and custodian duties are going to be at the heart of regulation. And there is no doubt that the current market slide and the current crisis is going to have a direct impact on that. Now, in what way? So, let's start with the EU. As was observed in the previous panel, the EU are moving at glacial pace on this. And I think that's going to slow up because of what's happening, because they'll want to stop in EU style, take stock again, issue some more consultations, and then come back with some detail. As usual, the European Commission publish a huge explanatory document with any proposed legislation, and I took one for the team last Sunday, actually sat down in my office and read it from end to end. And I think there are actually 3 key parts to it. What the EU is proposing is that they will regulate crypto assets at 3 levels. And the first is crypto assets that are valued by reference to an official currency. Now, they say that's not valued, but stabilized is their language. So something that's stabilized by reference to an official currency, a denominated currency, I presume they mean. The second is an asset that's stabilized by what they call asset referencing, now that could be that it's referenced to another asset, a tangible asset, or some kind of right, some kind of contractual right, which has real-world value. I think that's what they're driving at. And the third is none of the above. All other crypto assets, they just left them out there. Now, what that paper, if you strip out all the Euro speak, appears to say is that the approach to regulating those three different categories is going to be vastly different. And it's something that everybody in this sector has got to keep an incredibly close eye on. Because that third category is the category that is going to give most cause for regulatory concern. And in typical Euro style, they want to suck all of this into the establishment, into the financial establishment, into the existing infrastructure. And it's that third category that are going to kick back and push back on that. So watch this space. The UK, sorry, actually, before I leave the EU, one other very important point. One of the things that paper has hidden away in, I don't know, page 700, is the proposal to stop what they refer to as the illicit transfer of crypto assets within European states. And I have to say, even though we're outside the European Union, practical terms, that will apply to us as well, as will a lot of European laws going forward. And what they're proposing is to adopt the existing, what is known as a travel rule in relation to financial instruments. So that would require any financial instrument crossing a border to be accompanied by a full suite of information in relation to the source of it, its origins, and who its ultimate beneficiary is. Now that may sound simple to trot out, but that is a huge amount of information in a number of respects and pretty onerous. And for many in this sector, deeply unattractive. Let's be candid. So what about the UK? As the last panel mentioned, two critical pieces of legislation are now in bill stage. And they are being shaped by what I've already referred to, the Law Commission's report, which was published actually only about 3 weeks ago, but Parliament and the drafters have had it for a lot longer than that. The first is the Financial Services and Markets Bill. And the second, and actually in my view more important, is the Economic Crime and Corporate Transparency Bill. And the clue to the second one is that second part of its title. It's supposed to do exactly what it says on the tin. And looking at that legislation, and again, we do have quite a lot of detail, unlike in Europe, it would be pretty difficult for an FTX to occur if it's enacted as it is presently in draft. Now, what that's going to do is give both civil courts and, importantly, the criminal courts a lot of powers they don't have at the moment in relation to crypto assets. So, for example, much extended search and seizure powers. So I can go to the High Court and I can freeze assets, but I can't go and get a cold wallet, for example. There are orders for delivery up, but very, very difficult to get. These can be got at the beginning of an investigation. So they can freeze assets. They can also, in the language of the statute, get authority from the court to recreate crypto asset wallets and transfer assets into a law enforcement controlled wallet. And they say they have the technology which they believe will allow them to do that. On the civil side, a lot of that is replicated. But there are additional powers that they are looking at, and they are really refinements by statute to the common law jurisdiction I've described. Really effective, real-time powers to go to court, track your defendant, even if you don't know who the hell it is, get orders for disclosure, close the net. And once again, the civil courts are going to be allowed to order techniques to reconstitute wallets or reverse transactions in a way that actually a lot of people familiar with the technology would say is simply not possible, but the courts we're going to have the power to do that in order to put victims of fraud back in the position they should be in. Now, where does that all leave us? legislation versus private sector. At the moment, I have to say, the common law world, and I'm proud to say this jurisdiction, is leading the way, absolutely leading the way. Because we designated crypto as property, it gives claimants a lot of power. That's not the case in the US at the moment. They're agonizing over whether to characterize crypto as security, as property, or something else. Probably go the way we're going to go and say it's a specific asset class with its own rights and obligations. But the courts are leading the way. I think that regulation is going to catch up. It's going to be slow. Previous panel thought maybe 2024 for MiCA. I think that's probably right. Huge amount of political pressure. Interesting to hear what the Lord Mayor said this morning. The senior civil judge in this jurisdiction, Jeffrey Voss, is a huge fan of making this jurisdiction the jurisdiction of choice for crypto disputes and crypto transactions. And my advice, in the meantime, pending this legislation, is you give yourself the best chance of getting, firstly, a coherent decision on transactional disputes, but much more importantly, an effective remedy when it comes to loss by fraud or dishonesty or any kind of lesser wrongdoing. You give yourself a much better chance if you make sure that your dealings in relation to your crypto assets are governed by English law. And you can do that wherever you are in the world. You can designate English law as the chosen law of the transaction. And if your counterparty says no, they want the Cook Islands or somewhere bizarre, just say no to them. Stick with English law. Because at the moment, English law is the most effective at protecting these assets. That could change. I think there's going to be an arms race. Singapore is in the game, the UAE, as I've mentioned, and the US. Let's never forget the US and long-arm jurisdiction. But I think we've got a fighting chance of keeping this jurisdiction, legally, as well as financially and technologically, the leading jurisdiction. And I'll finish on this slightly more optimistic note. I'm with James Bowater, absolutely. With his characteristic energy and enthusiasm and optimism, I'm an optimist. And normally lawyers are here to spot the problems and to identify the downside. Yeah, there are downsides. And good people need to step up, smart people need to step up. But I'm hugely optimistic for this sector because for me, it is very similar in profile to what happened with the dot-com boom in 2000. I know people say that's not true, but actually, as a fraud specialist, the dishonesty that led to a lot of the collapses in the early 2000s, a Remosoft paradigm example, are exactly the same. The failures were the same. They weren't crypto-centric. They were the old problems: lack of governance, lack of oversight, dishonesty, pure and simple. So it's a wrap. I don't know whether I've come in on time.
Thank you, by the way. Please put your hands together and thank James Banton. James, I don't think I want you to go far. I'd like you to stay there because you're actually going to join the next panel. And so you'll have a chance to ask some questions, I think, during that. So loiter, please, with intent at the end of that stage. So thank you very much for that. By the way, what an awesome talk, and giving us the confidence that the UK is very much leading some of this work. And actually even better that there's organizations, professional firms like the Australia Group, who actually we can go to. The benefit now is that when you go to a firm like this, you're not paying to teach them. It's always a bonus that, so wonderful to hear that, so thank you. So now, the next panel is not unrelated, in fact, highly relevant to that, which is about KYC and the challenges of identity verification. The moderator for that is, of course, the inimitable Johnny Fry, who's the CEO of Team Blockchain. Those of you in London know Team Blockchain is a huge contributor to the space, both in expertise as well as content. There must be about 4.5 million people that hear their content regularly, and so it's certainly they care about the topic. But what a lot of people don't know about Johnny Fry is that he loves sailing competitively. And in fact, his claim to fame, I'm not sure it's a claim to fame, but it's a claim anyway, and it really happened, is he was rammed by a Thames barge called Kitty during one of the Isle of Wight races. So here to lead us through the stormy seas of KYC identity verification, please welcome Johnny Fry.
Thanks very much. You could tell Eric was lying because his lips were moving when he started being nice to me, but we'll come on to that in a minute. Yeah, if I can ask Pam John, I appreciate we're a little bit tight for time, so we're going to make this reasonably snappy. And delighted we got the KC turned from a QC recently, so all good stuff. I always get a bit confused, being dyslexic, between KYC and KYJ, so apologies if I put the J rather than the C into the conversation. Can I start? We've had a quick introduction from yourself, James, in terms of your background, but can you just really quickly run through, start with yourself, James, as to what are you doing? And I know a number of people know yourself, but it'd be quite helpful. Thank you.
Think you've forgotten my name. It's Jason. So anyway, I've been in the crypto industry 4 years. I founded Venray, which now does capital raising, business development and sales for crypto firms and crypto funds. For the past 9 months, I've been the chairman of the club committee at Crypto Club Global. We, 5 months ago, acquired Black's Club, which is the UK's first private members club for the crypto community. And last but not least, I'm now the head of crypto sales at ID Now, a KYC solutions technology company.
Brilliant. Hannah. No, just keep speaking, it'll come, so to speak. You might have the duff one.
Or am I one? Yeah, why not? Thank you.
I bet you said that to all the girls, Jason.
Okay, hi everyone. So I'm Anna. I've been in the industry since 2016. For the last 3 years as COO of, well, we were Bitcoin.com exchange. Danish has introduced FMFW.io already, so I won't repeat. But yeah, we're pleased to have been 3 years going there. And we serve over 1.3 million customers, including retail and institutional.
Brilliant, thank you.
Hi, I'm Jeanette. I'm from WorldPay from FIS. If you're not familiar with FIS, we're probably the world's largest fintech no one knows about. We process about 50% of the world's fiat, banking, capital markets, merchant services. How we're relevant to crypto is we're the on and off ramp for the top, used to be 5 exchanges. One exchange was not our client, and that was kind of a blessing. And then I'm also on the vice chair of the Crypto Club Global as well with Jason. Been in crypto since about 2014. Singapore, 6 years, and that's where I actually advised a couple companies actually on KYC and identity.
Good afternoon, everyone. I'm Andrew Price. I'm the Chief Compliance Officer of Zodium Markets. We're an institutional-only digital asset brokerage and exchange backed by Standard Chartered Bank. I think we're the only FCA-registered brokerage and exchange which is owned by a bank. And my background, I was previously an FCA supervisor and at Revolut.
Thank you. Blimey, surrounded by a compliance officer and a KC. James, can I start with you? Let's be honest, KYC hasn't really worked in the real world. We've seen hundreds of billions of dollars, pounds, yen, Swiss franc of claims because the banks that are so-called traditional and we can all rely on, they keep getting wrong. Do we need KYC?
Well, you know what, it might sound counterintuitive, especially coming from a lawyer, but I think with crypto, arguably not, because in many of the cases we've done where we've traced illicitly stolen assets, we haven't been tracing somebody who's using their real identity. By definition, most fraudsters don't. So you just have to have an identity, and actually, as I referred to earlier, some kind of evidence forensic tag that means you can get them. You can find out where they are. You can find out where they're banking or where their telephone account is, and that gets your assets back. So I think in this sector, actually much less important than in conventional banking.
Blimey, Andrew, how do you feel about that? No KYC, but we've got to have identity. Does that ring anything with you?
To be honest, yes, I kind of completely agree. Actually, I think.
Don't agree. Come on, let's have an argument.
I'm sorry, but I think identity is one of the key issues in this space. Now, actually, in the blockchain space and in crypto, the technology available for tracing, for example, is far better than in the fiat world. And so, the fact that we can trace is great, but then it's how you link that to someone's identity rather than the KYC. And I think that's one of the key issues in this space. And I think there's a lot of developments where, in the tracing space, there's we've got a number of different providers, and I think there's a long, even further to go in the technology, where you'll be able to link up identity further with tools like Chainalysis, elliptic TRM, etc., to actually help that and actually make the the crypto space safer than the fiat world more generally.
You've got to agree we need KYC, surely, Jason. What do you?
Of course, yeah, 100%. Ultimately, it's about governance, right? In order to actually understand your business, you need to understand who your customers are. If you don't do KYC, you could be accepting terrorist funds, you could be accepting sanctioned funds or funds from sanctioned entities. You just don't know. You're flying blind. So I think it would be unwise for any business to not do KYC. And also, you are falling foul of regulatory requirements as of right now if you don't do it. So, it's not a new thing, and there's a reason why most exchanges already have very established KYC solutions and KYC processes. And we have big emerging trends as to, why we have that. So very important to have it. And yes, there are perhaps innovation that could be done to make it a bit less arduous on users and the user journey. And there are on-chain solutions that are being worked on and developed as we speak. And ID Now is very much leading the way in some of these discussions and developments. But as of now, we need to observe the regulatory frameworks that are in place, and we need to observe anti-money laundering requirements if you want to have a successful business.
Anna, what's your thought? Do we just need proper ID so our learned friends can track and trace, or do we really need KYC as well?
Well, yeah, I have to agree with the pair of you. Of course, we need KYC as an exchange for all the reasons that you've just mentioned. I do think, for the reasons you've mentioned, we need a much greater focus on holistically approaching, like monitoring wallets, as you spoke of, and cross-chain analysis so that we can identify bad actors in that way, because, as you say, and when we do have our in-house compliance and transaction monitoring teams reviewing ID, there's a lot of fakes going around, so, and it's a manual process, but then who are they really? So yeah, a mixture of all of that, I would say.
Yeah, but Anna, without being, I've been regulated all my life, so we have to, a bit like Charles McManus from Clearbank said, I'm not a great lover of regulation, but if you have it in theory, it makes things better. But the reality is 99.9% of the world population, they're not nefarious actors. They're not drug running, pimping children and all the rest of it. And yet we're all subject to huge amount of regulation, which costs us as consumers a fortune. So are we putting, if you like, almost the sort of, the cart before the horse? Is it really that important from your experience and perspective?
Well, it's been said before, I'm sure we'll continue to say it, over-regulation is obviously a problem. It's going to be a huge problem for the industry. We do need to find a way to operate and navigate through the space. And yeah, so we have to play ball.
Well, it's almost Hobson's choice. We've kind of got to do it, whether we like it or not.
I think it's about industry leaders collaborating with the regulators, as we regularly all trying to do, and trying to help them understand how to do this properly, because if, a bit like whack-a-mole, if we just hit down on the risk somewhere, the risk is just going to pop up elsewhere, and that's just going to keep happening. It happens in the traditional finance sector. That isn't going to stop, so it is just an ongoing process.
Okay. Jeanette, any thoughts spring to mind on this conundrum?
It's interesting because I think you have the degens who then say we shouldn't have KYC, right? And then bringing some conflict into this. And then obviously the traditional businesses, which I work for, which then it's absolutely necessary. I think what's important is when we look at the premise of the technology of blockchain, crypto, and everything, it was a lot about decentralization, but then it's also financial inclusion, right? So, stats I was reading somewhere in Consensus, like 1.1 billion people still don't have identity, right? So we can then bring those people into the ecosystem as well if we were able to then provide KYC. That was just...
Okay, so are you saying that probably ID is probably more important than KYC, so
Yeah.
it can be more inclusive?
Yeah, and I also think like what's interesting is the concept of DID, right, for Web3.
Sorry, DID.
DID.
Yep.
Yeah, so I mean, that's something that, hopefully, like Jason said, there's going to be different platforms and technologies that make it much more streamlined, right, and not so difficult.
Okay, so Sandra, slightly different question. Are KYC and DeFi, is that a contradiction?
That's a good question.
No, it was your question,
yeah,
but
yes,
I'm interested in the answer.
I mean, yes. I mean, I think at the moment, the DeFi space is very anonymized. I mean, this is the problem. Regulators are not currently looking that far ahead, and they're forcing, they're using regulations on intermediaries. But in the DeFi space, you don't have an intermediary to apply your money laundering regulations, to apply your CDD requirements and KYC. And I think what you'll see in the DeFi space is a split between those where you will be applying KYC and ID verification, and on the other side you will see DeFi projects where there's no identity, no KYC, etc. So it's interesting because I don't see a particularly strong approach from any regulators around the DeFi space at the moment either. So.
Well, I suppose that leads me then to yourself, James. In terms of DeFi, I know that wasn't the subject of your conversation, but any thoughts on that? How that's going to impact if it is truly decentralized? And there's some number of key advantages for the traditional markets. And I know, certainly the derivatives sector have been looking at some of this. But any thoughts on the importance of identity then, as opposed to KYC in that DeFi space?
Yeah, I have to say, I think that the two key aspects to KYC are obviously identity at the outset, but then ongoing monitoring. So part of knowing your client is knowing not just who they are, but what they're up to. And one of the most effective regulatory cases I've been involved in was where the client was the person they thought the client was, but actually it was the pattern of transactions on their account which revealed that they were almost certainly a proxy acting for a bad actor. So they were a fairly innocuous individual who didn't have huge wealth, but actually the transactions they were engaged in bore no relation to their profile. So it was at that stage that the issue arose in relation to compliance and KYC. And actually the DeFi sector, the way the technology works, made the evidence of that easily obtainable and pretty unimpeachable, actually. So I would say to an extent the DeFi sector has an advantage to that extent over the conventional financial sector because once you're in the system, once you're trading, what you've done is there, it's indelible. And that, I think that's one of the reasons I was optimistic, as I said earlier. I think actually fundamentally the system should work.
Okay, so Jason, I'll come back to yourself in terms of doing KYC. Do you see the need for greater, if you like, self-sovereign identity as a possible solution to help with KYC, and then I can share what information that I need to share rather than all of the information?
Well, and this is particularly interesting for the DeFi space, and one of the things I'm particularly interested is in tokenizing identity and being able to use that as your passport in the DeFi space. You're not going to get institutions embarking on DeFi without understanding, their understanding who they're transacting with. And there needs to be a solution to that. And as of now, I think a tokenized digital identity would fit the bill sufficiently well for DeFi in order for people to understand what's going on in DeFi, but in a relatively controlled manner. Yes, you're never going to be able to control the entire DeFi space like you can't entirely control the internet. But for those actors which want to interact with good actors as opposed to bad actors, there has to be a mechanism of doing that, and that is very much a work in progress, but I think that would be the future of DeFi. Yeah.
Do you know, have you got any thoughts on, if you like, how that could have possibly be implemented then to help KYC? Well, in terms of digital identification, do you see that as almost that could sort of bypass the normal procedures and policies that we have in KYC in terms of passports and utility bills and stuff like that?
Yeah, well, I think it's just going to play hand in hand, right? So basically, I mean, the whole premise, I think, again, of blockchain is to kind of replicate the traditional internet onto Web3. So, I mean, the DIDs will be like different tokens as well, like per passport ID, whatever product you're trying to attach that DID to, right?
Okay, and Anna, it's to me it's a little bit bizarre because blockchain, we write about it week in, week out about what is blockchain and how does it work, and the word that always seems to come back when we talk to people is that word called transparency, and yet KYC to some people, they need transparency to be able to prove who they are, but other people don't want to be transparent because they want to keep their information confidential for various. It may be for trading purposes. It may just be that's how they feel. How does that conundrum get sort of settled? Because surely you've got a technology that almost make KYC and identity irrelevant because, you know, it's for all to see.
Well, certainly how we manage that, of course, and how other exchanges seem to manage it, there's thresholds, there's transaction thresholds, and, you know, AML teams that will flag a whole range of monitoring systems, so the threshold is different for every individual. There's lots of metrics, how that gets organised. Yeah, so that's how we manage it as an exchange.
Okay, but that's interesting because it used to be the situation if you were dealing, memory serves correct, I think it was 10,000 euros, you didn't need to worry about KYC. Now it seems you have to do KYC sort of on all sorts of transactions, and you have the crazy situation in Europe. You can't spend more than 1,000 euros in France or in Spain in cash. It's illegal. You're not allowed to do it. So in theory, if you're going to do transactions, you've got to use your credit or debit card or your digital wallet. But it just seems, surely it would make it a lot easier if we just brought the thresholds up to a meaningful amount. And if a retail investor wants to get involved, do they need to go through the hassle of KYC? Because it's not an easy process.
Absolutely, and of course the travel rule's been mentioned already. We're gearing up to be fully compliant with that for our European clients. Again, it is about speaking to regulators and trying to help them understand why this is just so limiting.
Right. And Jason, I'm interested, one of the challenges I know with KYC is that, I'll just pick Schroders as an example, and if I've done my KYC with Schroders, and then I want to go and do a deal with Investec or M&G, or, you know, I want to open a bank account with Barclays, we can't take that KYC passport across.
Yeah, I mean, there are data protection considerations and...
but I could give my permission.
You could, and, you know, that would be one, you know, hurdle to cross in your specific example. But yes, in most cases, the actual technology that would be required in order to perhaps safely port your information with your permission to a different entity, it just simply doesn't exist in the market. But with you know, crypto asset technologies, this is a possibility to do. You can tokenize identity and then with your permission use those same KYC issued tokens to a different entity, and hey presto, you wouldn't need to go through the same process. But with the right solution, it's not particularly difficult to be KYC'd. I mean, you can just get your driving license or passport and then take your selfie. You know, at ID Now, we can do this in 10 seconds. So it's not something that takes a great deal of time. But yes, you know, potentially in the future, we will have tokenized identity, and that will allow us to port that information without having to redo KYC.
Okay. I'm mindful of time, and I'm keeping... It sounds like some of you are already eating lunch, which is a bit rotten, because I'm starving, but there you go. Are there any questions anyone has in particular? Because I'm mindful we've got a
Johnny, I was going to add to that. I actually spoke with a startup out of San Francisco that is actually doing exactly that. So once you KYC on one exchange or any entity that's a client of theirs, it'll port through. It's called Unum ID. Sorry for a plug for another ID company.
You heard it here first.
And they'll take that KYC,
So
even though it's the responsibility of the, if you like, the new exchange in theory to be able to go through the same process and procedures and prove it.
Yeah.
Okay.
It's almost like applied for KYC.
Right. Yeah. Okay. Well, thank you. Heard it here first. Has anyone got any other questions they'd like to quickly raise? I know everyone's going to be here rest of the day and most of tomorrow, but has anyone got any other questions they'd like to ask any of us, or are you going to... What about it?
I just want to find out how the panel are using open banking in terms of identity processes.
Okay, so thanks, John. So the question was open banking and how is ID being used? Mr. Compliance Officer, do you want to have a crack?
Well, I mean, as an institutional-only exchange, we actually don't use open banking because we don't have any retail clients, but sorry about that.
That's okay. Any thoughts, James, with respect to open banking and ID?
No, I only get involved when the brown stuff has already hit the fan. So these guys are going to be much better placed to answer that question. Okay,
Jason, have you got anything you'd like to add?
I mean, you know, our bread and butter is actually working with banking institutions, fintechs, and crypto businesses. But we don't actively pursue that line, so it's not something I can really add on.
Okay, I'm not going to put anyone else on the spot, but I think it's a very good question, and I think it's something the regulators need to give some, because at the moment you cannot delegate your, if you like, regulatory activities, and one of them is to carry out KYC. So if you could actually agree on a common set of standards, big if, but if you're a regulated entity and you've actually gone through some fairly, as Jason said, it's not that difficult to go through KYC. You should be able to say, we have gone through it, and from an open banking point of view, it should be able to passport across. But there doesn't seem any real signs of that at the moment, but I think it's very much watch this space. And I think some of the things that you're talking about, the Law Commission, and I'll just finish with one little example. Very interestingly, last week, talking to the head of regulation, the Hong Kong markets, and they were saying, despite the fact that it's an imperialist type of structure, we believe that common law, English law, is something we need to adopt, both from a regulatory point of view and also from a governance point of view in a wider aspect. So we may well see Hong Kong and maybe possibly China following that suit. So the sooner we can get some clarification, because it's very difficult for regulators aren't here to make the law. And I think we sometimes forget about that. They're to basically not even interpret, but enforce it. So we need to actually have some better definitions on KYC, identity, and dare I say the assets in this sector, so that the regulators can then do the job. Because at the moment we're just getting regulatory creep, which I'm not convinced, having spoken to them, that's what they really want. But perhaps more of that this afternoon. Oh, good. I'm glad you. Bloody hell, that's good. Okay, well, thank you very much indeed, and thank you for coming along to the event. Eric.
And thank you, Johnny Fry. Thank you very much, panel. Much appreciated. Well, that wraps up this morning. This afternoon, I will be replaced, as I mentioned, it's a game of two halves, by the inimitable Darren Parkin, the editor of Crypto.am. For now, though, please do enjoy lunch and be back here at 2 o'clock for How to Make Money in the Market Every Time with Matty Greenspan. Thank you very much.
He's over there. Yeah. Ladies and gentlemen, welcome back. Don't get your expectations up. Before we begin with this afternoon session, I'd just like to acknowledge what an amazing morning session we've had, not just in this room, but upstairs as well. So remember to ensure that you check in there at some point as well. And before we bring the wonderful Matty Greenspan up, I just want to say a word of thanks to a tremendous fellow who is an absolute pro and is brilliant at this kind of thing that I'm going to absolutely cock up. Mr. Eric van der Clay, everyone. Legend, absolute legend. That's a bloody old photo. That could be my child. Right, our first guest this afternoon is someone I've known for a few years, actually, but only last night met in person for the first time, despite exchanges online, video calls, and all that sort of thing. And one of the most incredible conversations we had last night was when someone in our group announced they were going to the bathroom. They actually stood up and said, "Oh, I've got to go to the bog." Matty's face was just like, "What? What are you saying?" And I spent the next 5 minutes offering different British colloquialisms of how we describe the toilet. It took up almost 5 minutes of my time. It was like Eskimos with all their different words for snow. So I hope you've got something there that you can take back with you when you've left. So, ladies and gentlemen, Mr. Matty Greenspan.
Hey everyone, how's it going? Awesome. So, sorry? Tell us how to make money. All right. That's what we'll do. So my name is Matty Greenspan. I'm the founder and CEO of Quantum Economics. I'm registered financial certified in Cyprus and co-author of the book, The Complete Guide to FinTech Investing. I've been at eToro as a senior market analyst for about 7 years, which is where I got my start, but I've been in paper trading since I was 14 years old. Basically, don't let the title fool you. I don't think that we're going to say anything revolutionary today. Just maybe a few points to keep in mind, stuff that I've learned over the years, and kind of the general principles of investing. This is what happens, right? This is what happens to traders. Basically, I've seen personally as a retention manager and various online brokers, probably more than 10,000 people come into the markets with stars in their eyes. I'm going to make $1 million today, and their total deposit amount maybe $200 or $300. Like, how are you going to do that? Most of the time, they end up like this dude. I've ended up like this dude several times, and I'll tell you why. But look at him. Poor guy. He's got 2 screens and nothing. All the technology in the world isn't going to help. Technical analysis is, I think, the study of charts. I've had a sordid relationship with technical analysis because you can't really derive anything that's going to happen in the future from something that's happened in the past. And when you're looking at a chart like this, it really is past data. And my financial certifiers in SciSec basically make me put a disclaimer on every single time that I use a chart in my analysis. It says, past performance does not indicate future results. That said, there's 4 magical words that'll make you money in the market every time. Buy low, sell high, right? And as long as you can do that consistently, you should be okay. And the charts can help you do that. If you look at the chart of Bitcoin right now, you can see 69,000, very high, right? And right where we are right now is 16,000, maybe not extremely low, but relatively low, right? So that's where they'll help you, but I've seen so many people that come in and try to sell you signals or try to sell you charting courses and stuff like this. I wouldn't buy into it. Algorithmic trading is also interesting for institutions, right? For the person at home trying to find a bot, it's a lot of fun, but I wouldn't say is necessarily a path to sustainable income. This is the number one thing to that makes the difference between a successful investor and a trader who loses money, right? How long is your time frame? Because we're in a brutal bear market right now, right? And, but bear markets are very temporary, right? That over time, you'll see many cycles of bull market and bear market. And what I've noticed is that everybody who trades short term, almost everybody, 99% are going to lose money. And everybody who invests long term, 99% are going to make money. And this is something that I've noticed throughout my career. The reason for this, of course, is that fiat money is designed to depreciate in value over time. Financial assets, on the other hand, they'll give you a piece of a company or a project that over time is going to grow in value. And this is really the main point, number one. Number two is diversification, right? And we can tell mathematically that diversification actually reduces risk. This is known as the efficiency frontier. And on the bottom, we have the risk spectrum. And we have on the right-hand side the return, right? And asset A, also known as the zero risk asset, right? It means that you're investing in something that supposedly has zero risk, like a bond, for example. But don't get me started on lending money to the governments. I don't think that that's a great idea. But in traditional finance, it helps us to understand the concept. And then asset B is going to be your high risk, right? They tend to think about it as stocks, but as we know, crypto is 1,000 times more risky than most established companies anyways. So by mixing the two, the low risk and the high risk, you get to the minimum variance portfolio, but then you find your efficiency frontier. So look at asset A, right, which is zero risk, and look at the return compared to that on the efficiency frontier with zero added risk. It's the same amount of risk as just holding as just holding the bond, but actually you're making much more money by mixing and matching. And VCs do this also, maybe a little bit on steroids, right? Where they'll come in and fund 50 companies. And if just one of those companies turns out to be Twitter or Facebook or Amazon, they've got it made. They don't care about the other 49 at that point. That's a very, this is a very, I would say, extreme example of this. They call it the spray and pray. But I think that, for the investor at home to understand that, you don't go all in on one thing, but rather mix and match as many different sectors as you can get, as many different types of investments you can get in your portfolio, the better off you're going to be. And number three is leverage. How many people have traded with leverage before? How many people have got wrecked before? No hands went down. Yeah, that's what leverage does. I noticed this early on in my career as well. Anytime somebody adds leverage, you're adding so much risk. And a lot of brokers are pretty free with the leverage too, right? Because when a broker offers you leverage, your position size is suddenly multiplied. And when your position size is multiplied, they're getting a percentage cut of that, so they're actually making more money if you're using leverage. But what ends up happening is they're giving you enough rope to hang yourself. And I trade with leverage every once in a while, even to today, especially when the markets are moving and things are volatile. But I do know in my mind that this is akin to gambling, right? I was in Vegas last month. I put some money on the table. I'm happy with that. I know that I'm going to lose it. It's okay. So anytime that you're trading with leverage, understand that your money's at risk. And then the fourth thing that you need to do in order to be a successful investor, and this is a bit more difficult, is research. And we've all heard DYOR, do your own research. But basically, if you're not doing research, you're just following the crowd, right? You're hearing the hype, and by the time things start happening in the news, and by the time you're reading about it in the papers, believe me, you're already too late to the party. You're the mark at that point, right? If you see, okay, Elon Musk bought Twitter, going to go buy Twitter stock? I don't think so. He's already put that money in, right? And it's the same with any type of asset that you're going to see in the news. The more it's in the news, the more you're probably late to the party. Bitcoin, when you see too many news articles about Bitcoin and how it's going through the roof and everything like that, you're probably late in the cycle. You want to wait until the hype dies down, the price comes down, similar to where we're at right now, and that's your time to start scaling in. The reason I have this slide up, we all know the story of the ugly duckling, right? There was the ugly duckling who was in a bunch of very pretty ducklings, and then he grew up to be a swan. And everybody wants to get that swan, right? Everybody wants to find that swan. But the truth is, in real life, which is not a fairy tale, that swan is extremely hard to find. There was a story, a children's book that I read when I was very young, and I passed it on to my kids, called The Stinky Cheese Man and Other Fairly Stupid Tales. I don't know if anybody here has read it, but basically it has a lot of parodies on classic fairy tales. And in their version of the ugly duck, there was the ugly duck. He was born, and he said, hey, I don't care. I'm going to grow up to be a swan. Everybody can think what they want about me. But then in the end, he actually grew up to be a very ugly duck. And this is a lot of the time, a lot of crypto assets are like that. Probably to the tune of 97%. ICOs, IDOs, whatever you like, new projects, they are startups. And startups have a very, very high rate of failure, right? Just like we said, the VC wants to invest in 50 projects, so maybe he'll catch one. Maybe he won't. And cryptocurrencies a lot of the time are like that. So this is why it takes research, right? And you can come in and you have to ask the difficult questions. I'm in a very comfortable position, fortunately, where I can usually talk to the founder themselves and start grilling them. Tell me about your token economics. Tell me about your inflation. Where's the supply? Where's the demand, right? And without asking these type of hard-hitting questions, right, you're gonna end up following the crowd again and finding the wrong assets. This is why you really need to dive deep into it for yourself in order to come to these discoveries. And on that note, of course, Quantum Economics is our firm. We have Jason Dean over here. He's our chief Bitcoin analyst. I think actually the first analyst that joined Quantum Economics with us. That was nearly 3 years ago. We have 40 analysts on board right now, movers and shakers in the industry. Very diversified group, geographically, racial, ethnicity, and gender, of course. But more importantly is the knowledge base, and everybody that we add on our team has industry knowledge that we wouldn't be otherwise able to access. And you can see on our website all the 40 members on our teams page. It's quantumeconomics.io. And you can see also the projects that we're working with. We're working with more than a dozen projects at the moment, some of whom we're advising, helping them grow, showing them kind of the way, and helping with user experience and with publicity. We have a very large audience altogether because we have movers and shakers and social influencers and such. Cumulative following of around 3 million. And then the most interesting ones, I think, are the ones that start in-house, right? Which are, we're researching a topic, Bitcoin mining, for example. We're just looking at it from, there was a lot of FUD in the media saying Bitcoin is bad for the environment. And then we said, hey, no, here's the facts, here's the data, here's the statistics. And then something interesting happened. China kicked out all of their miners, and the hash rate started to plummet. And we're like, wait, this is an opportunity. And we were able to over-raise on our seed round, even during the bear market, which I thought was quite well, even because the VCs had already shut their doors by this point. Last November, when Bitcoin was at 69K, I had, in a single month, I had 12 VCs go, hey, Mati, what are you working on? I want to fund it, right? 3 months later, the price is at 40K, and they're like, I don't know. And then 2 months after that, they're already like, game over for us. I actually have one friend, unfortunately. I mean, he had to, all of his projects didn't work out, and he had to fire everybody, so it kind of sucked. But what I can tell you is, despite what happened with FTX recently, the VCs are starting right now to talk about investments again. I was in Las Vegas last month at Coin Agenda with Michael Turpin, and that was the first time in an entire year when I heard people talking about investing again. And there was actual real life, honest to goodness pitch battle, which I hadn't seen in a long time. And right now they're talking about partnerships, investments again. So this is, I think we're coming around. But always it needs to start with research. And we have another project that we're working on called Layered Cake, which is really taking advantage of the bear market because we have several projects that we were working with, that we were in touch with, that were about to go bust. Like they just couldn't cover the overhead anymore. And we're acquiring those assets for pennies on the dollar, in some cases even free, to roll them up into a unified DeFi experience. Because if we learned one thing from FTX, right, it's that central parties are not trustable. And if we want to move forward as an industry, it has to be on-chain, it has to be verifiable. Otherwise, it just doesn't work, and it's just not crypto. Even if it says crypto on the tin, they're lying. In any case, thank you very much. Again, my name is Matti Greenspan, quantumeconomics.io. Sign up for the newsletter, and reach me on LinkedIn or Twitter if you have any questions or ideas for collaboration. I'm always very happy to hear them.
Thank you very much, Matty Greenspan. And it took me all that time to notice you were wearing a bow tie with a cardigan. I've never seen that. Right, straight on to the next panel. Actually, the first panel of the day, isn't it? We're going to bring Johnny Fry up, who I want to congratulate for, well, earlier today, we had Monty Mumford, who dropped the first F-bomb of the summit. So he won the prize for that. Johnny Fry is about to win the prize for the longest title for a panel. And I shan't read it out. It's too much for my little brain. It'll be up on the screen in a minute. Johnny, please come up. And by the way, if you're taking any pictures and posting it on social media, if you're on Twitter, please use the hashtag, which we will have up later. It's hashtag CAMSA, C-A-M-S-A 2022. Ladies and gentlemen, Johnny Fry.
A very long title, but no panel members, which is a bit embarrassing, isn't it? Corby? Where is she when you need her? Is JP here? Oh, sorry, please, come on up, panel. I didn't realize you had to have a special invite, but you know who you are. Okay, so whilst the panel's assembling, this is really trying to look at and trying to make some sort of sense out of where the markets are at the moment. And, you know, where are family offices, where are private equity funds, where are VC funds? You know, what are they looking to invest in and kind of why? So, please, guys, take a... Thank you. Okay, so I'd just like to just start off with, if you could introduce yourself. Lord Holmes, you're known to most people here, but it might be helpful just to give a quick background as to why you have a Lord in the house, so to speak.
Hi, afternoon everybody. I'm Chris Holmes in the House of Lords, special interest, all things technology. And I would hope, but I can't guarantee it, that I'm the first person to have brought a dog on stage.
Well, I don't know. You didn't see some of the panels earlier on, but that's probably another story. Okay, so coming down towards me, if you can introduce, sort of, as Cilla Black you say, who are you, where'd you come from?
Hi, Jean-Paul Territ-Kiborn. I'm a partner at Deca4 Advisory out of Dubai.
Thank you.
Hey everyone, I'm Toby Norfolk-Thompson. I'm the Chief Investment Officer for Matrixport, non-Asian business. And for those not familiar with Matrixport, we are we're a prime broker and lender and a high net worth deposit platform in Asia.
Brilliant. Vijay?
Vijay Angela, I'm the CEO and founder of Inspira Wealth. We're a digital wealth and asset management firm. Like many people came to the space, trying to bridge the gap between traditional finance and digital assets.
Thank you. Okay, so I'd like to kick off on a sort of theme that was had this morning, Lord Holmes, in terms of, you know, what role do you think the regulator needs to take in the light of what we've seen over the last, certainly the last couple of months?
Absolutely, and it doesn't matter where you come from on this, there's a key role for the regulator. We need the regulator to take it, and we need it to happen much sooner rather than later. For me, this year particularly has been, if not dominated, certainly taken up with so many people coming to speak to me, wanting to establish, wanting to start and scale in the UK, but ending up going somewhere else for reasons that I and others can absolutely understand. We need the regulator to step up and shape up. It's in everybody's best interest. We have an opportunity with the Financial Services and Markets Bill that's currently in the Commons. It's coming up our way, probably at the beginning of the new year. And hopefully through that, we can have a central bank, a Treasury Department and a regulator really fit for the future to enable all the right elements to be balanced, not least competitiveness and consumer protection.
But do you see any evidence from the sort of off-the-record conversations that you've had with the regulator and obviously within government? Is there are they just dismissing it? Because there's a lot of frustration that the UK's lost any potential lead it did have.
They're not dismissing, and I completely share the frustration. I think what we need to do now is really ensure that we take, if not last, we need to take late mover advantage to learn from the lessons of, the EU, and MiCA shows many of the elements. If you think about unhosted wallets becoming self-hosted wallets, just as one small example, there's lessons to be learned, but in the great words of the most excellent advertising campaign possibly of all times from our good friends at Nike, it really is time to just do it.
Yeah, well said, well said. John Paul, what are your thoughts on terms of, the role the regulator, is it holding back, or is crypto kind of a rounding error and we should be focused on perhaps the digitization of real assets?
So there's multiple angles to this. So first of all, the distinction between the security tokens, of course, and other types of digital assets. Security tokens are already fairly regulated, so it's following the existing system in a way, just giving other advantages. But in the other forms of digital assets, it's very important to have regulation. The FTX debacle is an example, but it's also important not to have over-regulation. And we are seeing, and you mentioned this in a previous panel, we are seeing over-regulation that is hampering business, that is making it anti-democratic in the sense that it gives access only to certain people, not to everybody. And the whole point of initially of the decentralized system is to be able to allow everybody, or a democratic way of people managing their own finances. So it's always important to maintain that balance, and perhaps because there might be a very large community within the crypto sector that could actually assist the regulators into not making the same mistakes we've had for the banking system, where, as you said, the 99.99% of us who are not doing anything wrong are being treated like criminals because, for that 0.01%. Yeah.
Toby, Chief Investment Officer, you're a bright lad.
Well,
on a good day. Should we really be that fussed about crypto? There's 100 trillion of assets in the asset management industry. Shouldn't the focus be on that as opposed to worrying about the ups and downs of crypto?
I mean, I spent 20 years in investment banking prior to moving into digital assets, and as an institutional lender, I would say there's huge appetite for more regulation. I mean, talking UK specifically, obviously there's plenty of regulation in different countries around the world, but from the UK's perspective, certainly we built our firm with the risk and control structures in mind that will be required for a traditional prime broker, traditional lender, and yes, I think it's very important. I think also the events of the last few weeks will make people look more carefully at who their counterparties are, and think about what external validation and verification there is about the processes there. So yes, definitely.
But do your clients ask about the regulation, or do they accept that at the moment it's broadly? We're struggling in terms of, from a legal point of view, to define what crypto assets are, but are your clients asking about regulation? Do they ask questions about custody and boring stuff like, systematic risk and...
Absolutely, and I mean, particularly within the sort of the fixed income and market neutral fund community, where we're essentially looking to maximize yield whilst minimizing market risk. Really, the risks you are taking are custody, security, counterparty risk, and also control risk. So not just my counterparty defaults, but my counterparty, has a legal problem and I can't access my assets. So yeah, I mean, I would say, I spend all day, every day talking to hedge funds and family offices very actively trading digital assets, and a lot of those conversations are about the real minutiae of custody, of security, control, what countries organizations are regulated in and how things will play out. And obviously I've been very deeply involved in the mechanics of that over the last few weeks.
Okay, and the sort of, the hedge funds, the high net worth investors, the family offices, what's their attitude, would you say, in the last couple of weeks to crypto? Are they now seeing this as a buying opportunity, or are they a little bit like someone said earlier on, the FT are kind of laughing and saying, well, told you so, now let's move on to, or back to, perhaps the quill, pen and bowler hat, and we'll go back to sort of jolly good days of clipping coupons on bonds?
I think that for the investors that have been actively involved in digital asset markets, they undoubtedly the incredibly rapid collapse of FTX has come as a shock to almost everybody in the market. And one doesn't have a crystal ball, but I think people are being reminded of themes around and drawing parallels to their experiences from traditional markets, where either exchanges have defaulted or there have been cascade collateral problems. And I think now, I think there's a solid ecosystem and hedge fund industry focused on digital assets, and I don't think that's going away. But it's an opportunity to look carefully at the structure of the market and ensure that things are safer.
Okay, Vijay, you're probably the best dressed man here today. You obviously stepped off your private jet. Where are your clients looking to invest?
It's an interesting question, actually. There's a lot of hesitancy at the moment, as you can imagine. Sorry, there's a lot of hesitancy at the moment, as you can imagine. Every aspect and every asset class is under strain. Ultra-high inflation, stock market's under stress, real estate's under stress, commodities under stress, and then you have the implosion or the beginning of what many skeptics would say with the implosion of the crypto markets. There's a lot of capital still around, sitting on the sidelines. It is getting chewed up by inflation, and they are looking for places to go, but they're incredibly hesitant on where to go right now. Regulation is...
That's across all asset classes?
Across all asset classes. I mean, crypto is by far the one that they're least likely to go into right this instant by any stretch of the imagination. Regulation is a very hot topic. I think we've touched on some of the topics with the other panelists here on regulation, but what we failed to discuss is the behavior of people in the markets themselves. When we look at regulation, it's not just about forcing custody, it's the behavior on the exchanges themselves. So when I look at the crypto exchanges, and having been involved in the exchange world for a long time, we partnered with Deutsche Börse, Eurex, Life, LSE on projects and businesses. The exact behavior that's currently regulated out of those worlds post-GFC is exactly the behavior that we're seeing on the crypto markets. Pump and dump, wash trades, in-house market makers. All of those activities undermine the credibility and actually undermine the capability of people to trade in a clear, concise fashion on a crypto exchange. So I think those sort of regulations are the ones that we need to see coming into crypto exchanges. The other issue is that certainly for the UK, in something that Chris mentioned earlier, is we are falling behind dramatically. We're one of the firms that did decamp from the UK. We moved to Switzerland and Singapore. It is quite sad that we felt, after I've been involved with every regulatory reform here in the UK since the early 90s and late 80s, that we had to move elsewhere. And I think one of the issues has been that the regulators were deer in headlights when this thing turned up. It exploded onto the scene. Then, all that free cash during COVID ramped it up again. The issue we've had is that the combination of all the regulatory implementation for post-GFC has meant that compliance qualified individuals are in high demand, and the regulator has not been able to keep up with the quality of staff. And the feedback we've had is there's been a fear of authorizing or registering firms in the UK at high numbers. They won't have the staff to monitor those firms, even at the low level of regulatory oversight they were going to place, which is purely AML. So I think there needs to be stronger funding, and hopefully what Chris said will give us that for the FCA to catch up and develop the support network. There needs to be a better framework to protect the investors. One of our colleagues mentioned that we have to be decentralized and democratized. 99.9% of us need access to markets. The issue we have is the fundamental rule of a regulator is to protect the innocent and the naive. Caveat emptor isn't necessarily the rule in that situation. So regulation is there to protect us from ourselves. One of the situations with regulation which I find fascinating is hearing people like CZ saying, oh, we need more support. When you play inside the rules on a pitch, you're going to get the support of the umpire and the referee, which is why the governments came to rescue us with the GFC. When you thumb your nose at the rules, you're left to your own devices, which is why there's going to be very little support in that situation for us at the moment.
Okay, so we're not meant to mention FTX or FT, whatever it is, but if we went back a year ago, Lord Holmes, we weren't allowed to mention the B word, Brexit. And we've got clients, particularly in Holland, I'm not sure why Holland, and they refer to as, they get it quite a little bit wrong, so they refer to as the Emerald Island. I thought that was a bit further west. But nevertheless, Singapore on the Thames, you've gone to Singapore. Do you think that the UK can be flexible, but yet move quickly to make the UK a centre to be reckoned with, if not the centre, for these digital assets?
It's interesting, as you say, that Singapore on Thames has become a thing, as if there's something terrible and something that we can all be sniffy about Singapore somehow. And I think there's a lot to look at Singapore. There's a lot to consider very carefully about what Singapore do, how they go about it. I'm not suggesting it's a lift and drop, but I think the narrative to sort of besmirch Singapore is somewhat extraordinary and probably worth, everyone in this room I'm sure knows, that in reality, FTX, what we're learning so far, wasn't really to do with a exotic, a frivolous, a ridiculous class of investment. It was far, far more to do with the internal structures, operationalization of what they're about. And that could have quite easily been resolved. Similarly, it's interesting on the VC side, what we're seeing this year, and you've got to listen carefully for this, everybody, because the VCs have now introduced a new word into the lexicon this year, so I'm going to say it slowly and carefully so you get it. VCs are now talking about revenue. I know.
Wow.
And worse, recurring revenue. Not necessarily a bad thing, but in short, to the point, whichever side of the B anybody was on, literally, basically, actually, we are where we are. We have to face forward. There is no point trying to rear view mirror this, and there is stuff we can do, and it's about getting the right level of connection, alignment, understanding the US approach, understanding the EU approach, understanding what we can do to align, understanding where our key advantages are. So even in the midst of all this, I think we, as always, should look for reasons to be cheerful and positive approaches that we can take, because fundamentally, we have to.
Okay, well, thank you. It's that old-fashioned word, revenue, and possibly even profits would be quite nice, wouldn't it? But, Jean-Paul, where are investors looking to invest? And I don't want to just keep focused just on crypto. What's the competition for money that might have gone into crypto? What are they looking at? Or is cash just king and they're happy to sit on it?
Well, I mean, from personal experience, of course, because we're dealing in the world of crypto, we started foreseeing that something like FTX or other things would happen anyway at some point, simply by looking at what happened in 99, 2000 in the internet bubble. There were great companies that went down. I mean, the shares of Google and Amazon, everybody else's went down at that point, but then they're still around. So we knew something like that would happen. So 2 years ago, we started setting up, I'm giving this as an example, started setting up a fund that would actually invest in blockchain and crypto-related companies that follow proper business models. So that have revenue, that have eventually profits, that have real projects behind it, and not just just some crazy ideas. That might have sounded boring 2 years ago, and now investors are looking at that sort of investment. So a fund where
is that buying equity or is it buying their tokens? Which
they're buying certificates in the Swiss Stock Exchange, but the fund invests in these, we can call it gold standards of crypto businesses, things that make sense. So definitely VCs are looking into that now. They started looking into that already a year ago, but let's say now more than ever, this makes sense. And just like Lord Holmes just mentioned, revenue is becoming a keyword.
Okay, and Vijay, is where else could people invest if it wasn't crypto, equities? We've got high interest rates, or interest rates going up. I don't think they're high particularly now. We could go up a lot more. Where else do you think they could look investing?
This is going to sound like I paid you a phenomenal amount of money to ask that very question on the panel.
No adverts.
Too late. Unfortunately, I hadn't planned on mentioning this today, but I will anyway. So we actually looked at, in 2018, I was involved in the crypto market, doing an ICO in Asia, and we were approached by GSAM, Goldman Sachs Asset Management, who had an infrastructure business that wanted to do an ICO, a very high-quality infrastructure business in Singapore, and they said, can you come and talk them out of it? I'm not a big fan of utility tokens unless there is a really genuine, solid utility case for it with genuine user advantages.
Which there's not many.
5, 6, something. So we were actually approached by that infrastructure project to say, look, is there something else we can do where we can use it something a little bit like crypto? And our question was, well, what is it that's attracting you to an ICO? I said, well, we don't get diluted. We don't take on any debt, so we haven't got a principal issue and haven't got interest payments regularly. And I said, and the other advantage I'm sure you see is you've got no obligation to your investors whatsoever. And they said, yeah, is there anything we can use similar to that? So I got together with my team and we went away and we came up with something. And it's not actually new. It's a reinvention of a variety of different products. And in 2019, we went to market with what we're calling the gross revenue share security. So we took film, music, US municipal bonds, infrastructure bonds, and we took a combination of non-voting B share structures, variable rate perpetual bonds, and structured a model where people could raise capital using a securitization of their revenue. It's not new. What we structured is slightly different and slightly new. We're actually...
Well, hang on. So is that going back to Lord Holmes? People are looking to invest
revenue.
in that funny thing called revenue?
Exactly. So we actually in 2019, we had 21 companies sign up, started to go out and get interest, and obviously COVID hit. And we then went about restructuring our business to what we wanted to do and creating Inspira Wealth with all our regulatory licenses and the business plans we had. And obviously with the explosion in the crypto market, and during that time, it's very hard to tell people change of behavior when it's suddenly going up through record highs. Earlier this year, we were actually in the House of Lords working with a project that's backed by another colleague of Chris's. And during that time, we've been talking to a bunch of VCs. And we'd already seen VCs, as has been mentioned, they starting to close up shop, trying to conserve the capital they had, looking for something else to do. They hadn't quite switched on the fact they're going to have to change their behavior quite dramatically. If you're going to invest, you need something that you're investing in, something tangible. You can't... I'm going to use the word, I'm afraid that crypto on the whole is a Ponzi scheme. It relies on fresh capital continually coming in to push up the price so you can exit, reinvest the capital. There's nothing supporting that market. There are, don't get me wrong, there's a large number of very, very good projects out there. There are utility tokens out there. I think gas fee tokens are, have a genuine value. So we then started speaking to them, and we said, all right, look, maybe it's time to dust this revenue share security off, which we've now done, and started bringing this to market. It's not something we sort of went out, oh, well, look, we've got to change the market. We were heavily involved in utility tokens as well, but we felt the idea that you could either only do utility tokens or equity or debt was anathema. If we're going to innovate, let's innovate. But let's innovate in a way that's an advantage to the businesses, to the investors, and protects them. The idea here was a simplification of analysis of a business. Is it going to make money? Great, I'm going to make money out of making it money. I've got an investment in the value of the business going up because the revenue goes up. It's got to manage its own cost base. That's one solution we presented. We want people to come out and present additional solutions in the regulated space. We want to see innovation. We want to see these companies supported. It's quite interesting. We're getting a bunch of VCs going, oh, we've got all these businesses we've invested in. Can we bring them to you and see if we can raise capital through this method you're using now? We've partnered with funds.
Hang on, this sounds a hell of a lot of an advert to me.
It is. I'll give you the 50 quid afterwards.
No problem at all. I think James is actually already taken it over there, actually. You bought a new jacket. Yeah. But that's well, it's a new jacket. Come on, look at it. Is he there?
He's right
there.
He
is there.
Good to know Top Man is still in business.
Well, I don't know. I thought it was CNA because he's been internationally travelling, but that's a different issue, I suppose. Toby, revenue, an old-fashioned thing. Is that sort of gone by the way of the sort of a number of other old-fashioned things in the city, or do you think there is a place within the digital arena for things like that?
Of course. I mean, it's essential, isn't it? And I think, you know, it definitely echo your thoughts, Lord Holmes. When you read a pitch book result and it's telling you number of Twitter reposts, number of clicks on whatever, and like, where's the money? Like, how much money have you actually made?
Show me the money.
Sort of deep in the doc. Yeah, absolutely. I mean, you know, as we move into, you know, more of a prolonged global bear market, then people are going to be more focused on the more tangible aspects. And I think, you know, with my fixed income hat on, we're in a very interesting situation now with, you know, very high global inflation, very bearish sentiment on global equities, which therefore encourages people to look into fixed income, which should be good, increase the fixed income pie. Against that, you know, and obviously we're at the sharp end of this as, you know, a deposit platform, as, you know, as US Treasury yields and other government bonds and mortgage bonds, agencies, etc., yields rise, then, you know, why would you even bother to read about crypto paying you 6% when you can earn 5.5% just buying, you know, something very vanilla? So that, you know, that is an issue, undoubtedly. And I actually think emerging market credit, if you look at the sort of yields on offer in Brazil and India and so on and so forth, is also extremely interesting. So, you know, with my crypto hat on, we are looking at, you know, structured products which are able to pay yields which you know, which are commiserate for the risk. But that rising rate environment, I think, is the sort of the elephant in the room there.
I must say, I've always struggled though. People talk about fixed interest being low risk. When we got an inflation environment, interest going up, my sense is that bonds don't tend to do well. But
well, it's all about your. I mean, it's all about your as a sort of battle-hardened bond trader. It's all about your duration, isn't it? Like,
steady. Okay, we've got time for one question. Has anyone got a question they'd like to ask? Anyone on the panel here? No? Okay, well, thank you very much. And sorry, is there
somebody over there?
Has someone got the hand up? No? Okay, we better move on because I know we've got a packed agenda, but thank you very much, all of you, for coming on today, and thank you for listening to us this afternoon.
Thank you.
Thank you, Johnny. That was a fascinating panel and one of great quality, which I'm sure you agree, if you've been here all day, the panels we've had are absolutely dripping with quality. It's a wonderful thing to see. It's blown me away a little bit, actually. Now, I'm about to introduce someone up here who is part of a project that has also blown me away. It's something I've been looking at very closely for the last few months, Jade City. You'll probably see out there, there's a stand dedicated to Jade City. If you get the chance, please go and look at it. Hear what they're doing. Pick it up, touch it. It's indestructible, practically. Handle it, look at it. It is the most beautiful thing. And see what they can do. See what Jade City can do with this product. You can actually have it inlaid into the dashboard of your car. Now, I think that might be a bit overkill in my Ford C-Max, but I think it would triple it, mate. However, I'm going to hand you over to the Chief Operating Officer of Jade City, Mr. William Rolson-Saul.
Hi, everyone. Good to see you all here today. I think this is going to be a slightly strange presentation because obviously everything we're talking about is just crypto, and blockchain. But I've actually got to explain to you what Jade is before we do this. And before I explain to you what Jade is, I might just introduce myself. So I've had quite a strange career. When I was 18 years old, my dad thought it would be a fun idea to send me off to Tajikistan to work on a gold mine with the idea that I'd go to university after that. Much to his dismay, I actually enjoyed it a lot. And so I stayed for the next 13 years. And I built 3 gold mines and 3 coal mines. And so my whole life became building mines. So that was me. Tajikistan, I don't know if any of you have ever been there, but it's quite a strange country, 96% mountains and right on the Afghan border. And that was my life, living up in the mountains, mining. So I lived and breathed mining until one day, somebody was even dumber than me and they bought my mine. And I got out. And that was in 2013. And I thought, okay, well, that's mining. That's the end of mining for me. I went into the education space, built a private school in India, and never looked back. And then in 2020, I'd invested in crypto before 2020, but in 2020, I decided that blockchain was going to be my new path in life. So I just wanted to give you that as a bit of an introduction, because now you see me standing up here talking about mining and crypto. And it took a lot to bring me back. Okay. There we go. All right. So first thing, so today I'm going to talk to you about something called jadeite. You will have all heard of jade before. If I say to any of you, do you know what jade is? You'll say, yeah, it's a green stone. It's quite popular in Asia. So the word jade, okay, actually refers to two different stones. Jade can mean nephrite jade, and it can mean jadeite jade, okay? And jadeite jade is the jade that we're talking about today. And the reason this is important is because jadeite jade is more expensive than nephrite jade. And jadeite jade only comes from one place in the world. In general, only comes from one place in the world, which is Burma. Okay? Now, jadeite jade and nephrite jade together, which were jade, has a trading history in China of somewhere between 6,000 and 8,000 years. Okay? It's one of the toughest materials, natural materials on the planet. If diamond is a hardness of 10, jade has a hardness of about 8. And to put that into comparison to something else, marble has a hardness of about 3.5. So in the ancient times, having your arrowheads or your tools made out of jade allowed you to be a powerful and wealthy person. And therefore, jade was always associated with wealth and therefore good luck. And gradually, rather than making arrowheads, people started to make belt buckles and started to carve jade into carvings. This was particularly in China, and the Chinese emperor, it was so sort of revered jade that as a jade carver, if you dared to sign your name on a piece of jade after you'd carved it, that was a beheadable offense. Okay, so this is something deeply ingrained in a culture for thousands and thousands of years. People ask me all the time, what's jade used for? Well, it's an ornamental thing generally. It's jewelry, it's carvings, and it also has a lot of it's to do with like good luck. A lot of people in China essentially carry a piece of jade around in their pocket for luck. So if you look at it like that, jadeite is a wonderful thing. And then people ask me, well, how much does this jade stuff cost? Well, this is a difficult question because it's literally from a very small amount to a very large amount. In my research of jade, I've seen the worst stuff go for a couple of dollars a kilo, and the best stuff, which is this one, there was a single necklace sold for $27 million. Okay, so that is only in terms of per carat, dollars per carat. There's only been one item made out of diamonds that surpassed that in terms of value. Okay, so jadeite is a very valuable thing. That's where the good news generally stops when it comes to the present jadeite market as it stands today. Nearly all of the jadeite in the world comes from one country. It comes from Myanmar or Burma, depending on what you call it. And it's mined in an awful way. It comes from an area that's 25 kilometers long in the north of Burma. This area is controlled by the Burmese army together with Chinese mining companies. And they basically exploit literally hundreds of thousands of people. And the reason they exploit all these people is because the only way they can find this jade is by searching through these riverbeds, which they're digging up, for these pebbles, essentially just pebbles of jade. Okay? And this is a very labor-intensive process. To keep the workers digging, they pay them in heroin. To keep them coming back to work, to keep them addicted to work. It's that terrible. There are landslides all the time. Hundreds of people die each year. And then once they eventually find this jade, about 65 to 80% of it is shipped on the black market over to China. Okay? So it's literally a delightful industry. I'm sure all of you have heard or seen the movie Blood Diamond. We know what blood diamonds are. That's a small percentage of the diamond market is a blood diamond, are blood diamonds. All the jadeite market is blood jade. Okay? So it's a tricky industry. Anyway, despite all of this, it's very hard to say what the size of the market is because it's not exactly transparent, but somewhere between $6 billion and even up to $30 billion of money comes into Burma each year to buy jadeite and take it over to China. Okay? This, potentially at the upper end of the scale, could represent up to 50% of the GDP of Burma. From there, it goes into China, and it's turned into products, and those products are a market of somewhere between $50 to $100 billion a year. It's a massive industry, okay? But with a very, let's say, unhappy beginning. So, so coming back to my story, I was doing an education event with James with the Crypto AM Academy, and over lunch I was talking about my mining, and James said to me, "Oh my God, you know about mining? I need to talk to you about something. I need to talk to you about a jade project." And I was like, "James, honestly, firstly, I don't know anything about jade, and mining is my past." He goes, "No, you must have a look at it." And so probably 2 weeks later, James had sent me the documents. He calls me up and says, "Have you read it yet?" And I said, "Well, no, but I will. I'll do it right now. I promise. I'll do it right now." So, I mean, I've looked at hundreds of mining projects in my life. I've reviewed them for people. It's a bit like the crypto industry. Most of them are not very good. So anyway, I started to read the document, and two things struck me. One is the project was owned by Kevin Fu. Kevin Fu had been a non-executive director of my company. He's sitting in this room somewhere. He's a legend. I don't want to make him blush, but he is a legend in the mining industry. He's built some very successful mining companies and sold them, particularly in Central Asia. And he had worked with me in the past. He had been a director of my company. And as I started to read the geological documents, I realized one thing. This was essentially the richest mine I'd ever heard of in my life, let alone had the opportunity to be involved with. And a very simple way is to compare it. For all my sins, I was a coal miner. I used to be a coal miner, at least. And when I was a coal miner, when we mined a ton of coal, you could sell a ton of coal. It was pretty easy. And you got about $100 for that. I was also a gold miner. And when I mined gold, I'd mine a ton of gold ore, and I'd get about 2 grams of gold out of that, 2 parts per million. And I'd sell 2 grams of gold, and that'd get me about $100. I'm now a jade miner, or in business with a jade miner. They mine 1 ton of jade, that's 50 grand. It's about that simple, okay? That was enough for me to break all the promises I'd made to myself and to other people that I'd never go back into the mining industry, and I was all back in 100%, okay? I wanted to explore this. Now, James had come to me with Kevin and said, we want to look at doing this not as a conventional mining operation, but we want to look at doing this in the blockchain space, because this is a very unique mine. This mine is in Kazakhstan. It's the biggest deposit of jadeite in the world. So it's not in Burma, and it's the biggest deposit of jadeite in the world, okay? It has enough already proven up to supply the entire world market for 7 years. It is absolutely enormous. And it's not in a riverbed in lots of little pebbles. It's one solid piece of jade, just like slicing up a massive loaf of bread or an iceberg. Think of it as an iceberg, okay? Loaf of bread's probably a bad example. Okay, so that's what brought me back. Okay, now given that we're not in Burma and we've got this thing that we can mine very efficiently and in a very friendly way to the environment, we felt that this was an opportunity to do something very different, okay, in terms of to really change this industry. We could have jadeite that was ethically sourced, that was not blood jade. That was one. We could have jadeite where we could prove the provenance of it. And what we wanted to do also is because although everything's great, we got lots of jadeite, we are dealing with a product that comes from Kazakhstan. If you ask the average jade buyer to buy jade, they'll say fine. If you tell them it comes from Kazakhstan, that's going to be a problem. They're not going to necessarily understand that jade can come from elsewhere, or jadeite can come from elsewhere, apart from Burma. So we have a marketing challenge, okay? And in order to deal with that marketing challenge, we wanted to create a community of people on a trustless trading platform that could take part, essentially, in NFT ownership of our jade, which I'll come on to, which is Jade City. The other advantage we got is the average piece of jade you get in Burma is about this big, okay? Ours is one big piece. With a piece this big, you can make some rings, you can make some bracelets, you can make stuff like that. With our jade, you can make your boardroom table. You can make anything pretty much of any size. You could have a bathtub, okay? So there's a whole new market there. So we got two issues. One, we need to get over the fact that it's jade that doesn't come from Burma. And two, we've got so much of it. We need to look at a way to grow the market. You know, if you've got 7 years of supply for the entire world coming from one mine, you can't just put that on the market, right? You need to grow the market in order to get that distributed. Okay, so this is when we came up with the concept called Jade City, which is what I'm talking about, what I want to talk with you about today. So the idea behind Jade City is we want to allow the community to essentially take part in the value chain of the mining and the processing of the jade. And by this, I mean essentially community members can come in, they could stake their stable coins, those stable coins will be put to use, essentially to mine, and they will, after a fixed period of time, call it 12 months, they receive their money back, which will be from the sale of the jade itself, and the rewards that they will receive in tokenized jade, okay? And the way that we've set this up with our offtake agreement from the mine, we have enough jade supply for a $75 million staking pool for 8 years, okay? This is a form of DeFi that essentially is asset-backed and sustainable. We have the jade, okay? So that's one thing that it will allow you to do. Also, in this, I'm not going to call it a metaverse per se, because people will think of a three-dimensional world where everybody's chatting to each other. In this virtual platform, there will also be online shops. There will be a way that you will hold the jade. You will be able to buy blocks of jade. You'll be able to buy products of jade. You'll be able to invest in jade. And most of you will think, well, why would I invest in jade? People might invest in gold, or they might invest in silver, or they might invest in something like this. If you just Google jadeite and news, you'll see that in August, there was a big article in the FT, Chinese investors moving out of the property market into the jadeite market, okay? This is a massive thing, and this is, for an increasing number of people in the world, this is an investment asset. But it's a difficult asset to own because you don't know whether you're getting the real stuff, it's hard to store, it's hard to get delivery. But if we can have the physical jade stored in one place, which is our vault in Dubai, and then NFTs that are essentially the receipt of ownership of that jade being traded anywhere in the world, this allows people to get more involved in the market. Okay, so in the tokenized jade from staking, we're predicting that we can probably pay between 20 to 25% ROI in tokenized jade, which is obviously pretty attractive. In terms of the trade of jade, people often say to me, well, surely jade is sold in markets or it's physically traded in shops. In China last year, $38 billion worth of jade was traded online, okay? So it's not a massive step to say that people could trade their jade as NFTs, which is essentially online, and a safer way of doing it. The other thing that we're going to allow people to do is not only take part in the mining, but to take part in the processing. This here picture these pictures here in the bottom right, that's a backlit 1 square meter coffee table made out of jade. The top of that coffee table is cut 1.5 millimeters thick. This literally does not exist. And in certain countries, offering somebody the chance to own a jadeite coffee table is like saying to one of us, do you want to have a diamond coffee table? It's quite an amazing thing. From 1 cubic meter of jade, which weighs 3 tons, we can make a couple of hundred of these, okay? And these are worth between 15 and 20 grand each. Now, what we're going to be offering in Jade City is we're going to be fractionalizing, essentially, entire cubic meters of jade, so you will be able to own a slice of that, and you will be able to take part, essentially, in financing the production of that from a raw piece of jade, which is, let's say, worth $100 a kilo, into the finished table, which is worth $500 to $600 a kilo, and you can take part through fractionalization. You can take part in the uplift of that value, and everything will be done on-chain. So this is another thing we're going to be offering. So the question is like, for all these benefits, for all these staking rewards, to take part in this fractionalization in Jade City, how do you do it? Well, we can't offer it to everybody. There's a limit to the pool that we want to create. We need the thing to last for a certain period of time. So in order to do it, you need citizenship. These pictures here, this is from the mythical ancient tribe of the Jadites. If you look in your bags, there's actually a competition, and there's 25 Jadites up for grabs that people can win, or essentially a mint pass to mint Jadites. Each Jadeite has something called a heartstone. If you look around James's neck, he's wearing a heartstone today. Okay? When we come to minting these Jadites, and there will be 10,000 of them, each one will be backed by a physical heartstone. Yet you won't be able to see what your heartstone is unless you kill your character. So you'll always have that dilemma. You have your character, which allows you to get access to all these wonderful things, but maybe you get upset with your particular Jadeite. You do always have the option of murder and stealing their heart, and then you can get an NFT of their heartstone. You'll see what you get. Not all heartstones will be the same, but they will be worth at least what you paid for the NFT in mint. And then if you actually want your heartstone, you can burn that NFT and get delivery. Okay, so it's a pretty cool thing. Not all Jadites are equal. There is a hierarchy. So when this random mint comes along, you could be the royal family or the imperial guard at the top, or you could be like me, a lowly miner at the bottom. All of the different categories have different benefits, but the top categories actually get to basically share out the city's profits, okay? Which is pretty cool, because the city will make a significant amount of money. This is NFTs, whether it's the NFTs of the Jade or whether it's the NFTs of the Jadeites. I've been, preaching to people for years about how cool I think NFTs how cool I think they are. But the one thing, you often see is so many NFTs out there, they claim to have some utility, but they don't, okay? Owning a Jadeite citizen is real utility. You will be able to earn from it, one. And if you hate it, you can kill it, and you can get your heartstone, and you can take the Jade home, and you're still going to win, okay? So that's pretty cool. Please come and see us later on. We've got a stand outside. We've got some of the examples of what Jade looks like. We've got a cube there that's 1 kilo, so you can get a feeling of essentially like what a kilo of Jade looks like. We've got panels that are backlit, so you can see what it looks like when the Jade's cut 1.5 millimeters and has lights put behind it. We've got a whole lot of stuff going on. And just the last thing I want to say in order to quantify it, the rewards in terms of physical Jade that we are going to be handing out to our citizens over the next 8 years is worth about $150 million. So it's not small, okay? That's just the staking rewards. On top of that, there's all the other benefits which will be handed out to the citizens, the various discounts and this and that, which will be worth probably the same again. With that, I'll leave it. Thanks. Oh, questions. Sorry. We do questions? Do I need? Oh, you've got a question.
What is the website if people want to look more into Jadeite and Jade City?
Okay. So the website for Jade City is jadecity.io. And there is the company that is partnered with Jade City, and that's jadevault.io. So either of those companies you can see. Come and talk. We've got an entire team here, everybody wearing these hats, and then there's a few secret agents who are not wearing the hats. But there's lots of people to talk to about the project. If you want to get involved, it's just super easy. Just come and have a chat. Any more questions? No? Good. Cool. All right, I'm off.
Nice touch with the lights, Mr. Bowater. Nice Jade light situation. So yeah, no, seriously, if you do get the chance, please go to their stand. It really is a mind-blowing project. And I mean, the website alone is a thing of beauty. I've already said to James, we need to hijack whoever made that website. It is so beautiful, and any project we get involved in, I want those people to do it. So we've just heard what makes jadeite so wonderfully valuable. Next, we're going to hear what makes crypto, and Corby's doing a weird signal at me that means we're not actually going to do this. What is it, love? Tell me.
5-minute comfort break and then resume, because one of our speakers is on his way.
Right, okay. I've got a comedy routine lined up for such an occasion. I'm going to bore you with mother-in-law jokes for 5 minutes. I'm not, that's stupid. No one would ever put you through that. Right, apparently, we've got a panelist who is running a little late, so we'll take a 5-minute comfort break.
Perfect timing.
Perfect timing, yes.
Right. As I was saying, we heard what makes jadeite valuable, and next we're going to hear what exactly makes crypto valuable. I'd like to invite up on stage, if you can all pretend it's 3:15, Anastasia, who is going to be your moderator and host for this session. Take it away.
Thank you so much. Thank you to everyone here who thinks that crypto's value is more important than muffins and coffee. First of all, I'm Anastasia Kinski, and I am head of programs at Global Digital Finance, which is a members association focused on the adoption of best practice standards for crypto and digital assets. So we are working in a very interesting time right now, particularly from the perspective of governance and standards. But I am delighted to be welcomed here on stage with some fantastic speakers who are going to introduce themselves very quickly because we have 30 minutes to go through what is quite a big topic. So Sven, starting with you.
Hi, Sven Werner. I work for State Street, depending how you count, largest or second largest global custodian, and responsible for our digital custody product.
Thank you so much, Marcus.
Hi, I'm Marcus Hughes, Chief Risk Officer at BitMEX. Prior to that, I ran Coinbase's European business.
I'm Oliver von Landsberg-Sadi, founder and CEO of BCB Group. We provide payments accounts and FX for the crypto industry.
Matty.
Hey, sorry, can we get 10 more minutes on the clock, please? Hi, my name is Matti Greenspan. I'm the founder and CEO of Quantum Economics.
I'm Toby Gilbert. I'm the CEO of CoinWeb. We are a layer 2 cross-computation platform, so infrastructure builders in the space.
Thank you so much. And that really was quick. So we'll go straight to Marcus with, Marcus, what makes crypto valuable?
Yeah, I mean, I think this session is incredibly timely when you look at the kind of chaos that we've had in the markets over the last few weeks. And I think it's a lot of people are posing the kind of fundamental question as to what is the utility value of crypto. And unfortunately, you get bad actors in the ecosystem inevitably lead to that kind of very simplistic conclusion that, well, this must all be a complete waste of time, there's no inherent value and so on, which I think is unfortunate, but hopefully it's a phase that we can kind of push through. So my view is that, for the average person, they hear Bitcoin, they think of Bitcoin speculation, they think of volatility, get rich quick. There are very often unfair associations with money laundering and so on. Sure, there's bad actors, as I say, in every industry. For me, what we need to do as an industry is make the case for why crypto has an inherent use case, use value for it, whether that might be for simplifying cross-border transfers, for simplifying payments, for enhancing the ability to interact in ecosystems, whatever that might be. These are the specific use cases that we need to call out. And I think often a lot of that gets lost in the general noise around, look at these dodgy actors and all the bad stuff that they've done.
Certainly from the perspective of noise and what we'll see in most mainstream media, that will be focused on the retail space, where, of course, there's been a huge focus on consumer protection. But Sven, you come from an institution from the traditional finance perspective of the value of crypto and what crypto does. Can you tell us a bit about what you think that main utility is?
Yes, and in a way, it's almost like from a traditional custody perspective, it's almost like a really strange question, because we custody two things in a banking concept. It could be like a gold bar, but then what you do is you actually have possession of a thing, because you can't sort of get away from the fact that property law, in a sense, requires there to be an object in some shape or form. The other thing is it's a financial instrument, which means it gives you rights. By being a shareholder, the only thing that the share has value is because, legally speaking, you have certain rights. And so Bitcoin, in that sense, or any of crypto, doesn't have an issue, or therefore it is, in a way, it's like air. And you cannot, in a traditional thinking, you cannot custody something that is not a thing, an object, from that perspective. So for me, the value is not so much about, like, this is in any way for portfolio managers side, like, that people want to buy this, what the projections are. But the way how the market is organized and what you can learn from this in terms of the traditional financial industry, talking about digital assets, tokenization, if you want to learn how to do this, well, then is where you can look into this. And so for me, this is where the value really for all of us is, whether you believe in Bitcoin or not. It is, can you actually understand the market structure that is making this market work, and what can we learn from this? And from that, it's really, you moved all the emotions and debate about good thing, bad thing, in terms of, it is the technology that is relevant, whether you believe in Bitcoin or not. And that's really how I would look at it.
Certainly is, and it is for many of us like air that we breathe. Oliver, your views then on that market structure and what we sort of refer to as embedded finance, and where where digital assets in particular are making their biggest impact.
Wasn't ready for the embedded finance bit, although it is a critical bit of infrastructure. But
Ignore
I think
it,
the angle I'd
ignore
really like to take is beginning with the punchline and then working through the setup. The punchline for me is, oh, by the way, you're probably expecting this panel to come up with a lot of metaverse, NFT, crypto jargon, but I think there's something a lot more interesting happening here, and that's the decentralization of progress. So one of the building blocks that Bitcoin attempted to create was decentralizing money. It is making the bank in your pocket, not a centralized entity. But the cool thing that happened then was a decentralization of engineering. When Ethereum popped up and Vitalik spotted an opportunity to make money smarter, we got into the space in which you're not hiring an army of 100 engineers to build something cool. You're incentivizing engineers with the tokens of the network to build that network. And now we've got a vast library of all sorts of cool things, not just on Ethereum. But if you put those two things together, the way we've decentralized progress in money, decentralized progress in engineering, we come to a space which is growing fast, it's failing fast, and it's doing things a lot better than TradFi did it, and that's the decentralization of finance. This is where we get to the DeFi meat of the real progress, and this is where markets are much more efficient. In a proper DeFi, FTX is not DeFi. FTX is CeFi shit. Okay, so we're talking about Aave, Compound, Uniswap. These are places that are transparent on the blockchain. You're not locking assets on there. It's in your wallet. You're delegating your stake. It's creating markets which are light years ahead of anything we've seen in TradFi, created by this decentralized army of engineers and incentivized by this decentralized system of money.
I don't want to go exactly one by one down you, but Matty, just before I go to Toby on that decentralization and the role of interoperability there, the view on incentives is quite important. What is your view on that? We have a brilliant talk from you a little bit earlier on that talked about the economics here, token economics, etc. Give us your thoughts on the value being built there.
In a word, what gives crypto its value is community, right? We're moving from top-down governance to networking. And networks, they work very different, and everybody kind of has a say, everybody has a voice. And even though some of those people who are in this for the fast money, where are they now, right? But think about, some of the conferences that are happening around the world, dozens every day. And essentially what we've created is a new network and a much larger one, a network of networks with all of the different cryptocurrencies that are involved. And this is what gives it value, just like the dollar has value from the work the people do, and the work hours contribute to that value. So too, in the cryptocurrencies is where it derives its value, is the time and the effort and the energy is the value that's created.
Toby, on that point of community, we come from the two different sides of where there's community collaboration. GDF from the kind of let's determine what the best practices are, what conduct is going to look like in this space, and CoinWeb particularly from that technical aspect of weaving everyone together and answering to the challenges of interoperability. How does that play a role in how this ecosystem is growing, how we make sure that everyone is talking together, and what are the challenges that you see there?
Well, I think the first question to answer is the original one that you posed, which is what makes crypto valuable, which is just at a high level, is defined provable supply. So you know exactly what's there, where it is in the market at any one point in time. And that layer of transparency delivers trust. in the first instance. Getting down into kind of the granularity, is all crypto valuable? Absolutely not. And then you have to then dissect different use cases and say, well, is crypto valuable for this use case as a payment token, for example, or for a loyalty token over a loyalty point? Is it useful as an NFT for a monkey? Potentially not. So I think you have to look at all the different use cases to actually understand.
I think the free market might disagree with you, sir.
I don't think it would today, potentially.
Hey, they're still going for $500,000.
I'm not sure we have the time to tap into the art market and the different things to consider there, but we do have time certainly to look into this idea of trust and utility, particularly from what Oliver said there on growing fast, failing fast, and the role that plays on efficiency in the market. It also is probably a very difficult thing to hear if you are a risk-adverse person. Sven, from the perspective of banks and traditional finance, we've seen a lot of people move into this space, grapple with the standards and regulations that they may or may not have to meet. What are your thoughts on how the community goes forward now, particularly in light of the last couple of weeks?
There's an excellent question, because banking in a sense is purely a trust-based model, and it's obviously very different how crypto thinks about this, but basically we interact with regulated entities, so the fact that I can send money to another bank is because I rely on the idea that this bank is also held subject to the same rules and regulations that we are, and so I can in a way de-risk my operations by finding other people I can trust, and they're trustworthy because of regulation. So what crypto then does is the same thing, but instead of saying command and control and somebody decides whether, whatever your political agenda is, I replace this with another control mechanism, which is more sort of an economic incentive-based, whatever you want to call this. And is this a bad thing? Well, not really, because we are having these concepts today in regulated financial markets, and maybe lost a little bit the sense of this. If you think about it, what is an exchange? It's a members club, and they make rules, and if you don't like it, you trade another exchange. So these concepts have been there all the time, but now you actually say, in a way, maybe it's a change in the thinking of this is actually a good thing, and we can do more of it, as opposed to saying, what is the last bit of flexibility in the market that would take this away? But there is a fundamental problem that you said, is understanding where do banks, particularly when they're now starting to enter this space, where can we bring value? Do I have the better engineers than any of the fintechs? Probably not. Do I somehow have some magic secret sauce that makes all the problems go away? No. But what we do is, we are, in that sense, very process-oriented. It's what are the risks? I have a risk taxonomy. I can identify what it is, who should be responsible to monitor it, and therefore I can, if you want, dissect a very complex problem into small little pieces. And we bring this transparency, and therefore also regulators will be very clear, as well as our clients. When I give you that business and State Street, you're holding my crypto, what are the risks that I still own? What are the risks you own? What is the market risk? And that is, if you want, the solution that we need to bring, but requires a bit of boring task of describing, documenting everything. And that is very, very hard to get the people with the right knowledge to engage, unless they see the value in what you're doing, is you're allowing this market to grow, as opposed to seeing this as a bad thing.
It's interesting, because sometimes you look at crypto products, DeFi products, and you think, do you know what? These risks look very, very similar to the traditional financial space. And sometimes actually they are completely different animals in the forest. And it's very difficult to work out which voices you're listening to and what language is being used to cover up reinventing the wheel. Oliver, what are your thoughts on that as someone who sits in between the fiat and the crypto space?
Sven made some great points about the transparency aspects and the taxonomy of it, and you can't measure it if you can't manage it if you can't measure it, but it's also hard to measure it if you can't name it. So creating standard benchmarks that are recognized across regulatory jurisdictions is how we get to a better place of measuring those risks and then managing them. But there is still a big education gap in what risk looks like in this crypto space. In the FTX contagion, in the fallout, we've seen a rush to proof of reserve all centralized exchanges are rushing to show their wallets to demonstrate that they're not spending their clients' money. Now, it's a lot harder for banks to do that, a completely different model. There, the regulators bind them to an auditable balance sheet. But on the other end of the spectrum, again, truly decentralized finance doesn't need that proof of reserve because it's there, it's observable, it's clear. Those nuances, especially between what proof of reserve means from the bank end of the spectrum through centralized crypto exchange to decentralized crypto exchange, those nuances are lost on many regulators in this. We need to work on that.
Marcus, what are your views there on the role of proof of reserve, and then also what is the role of regulation in creating that value, as opposed to the utility that you mentioned at the beginning?
Yeah, so I think going back to the points that have already been made, we need to demonstrate, how does crypto make things easier or better or more accessible, right? That's fundamentally how we demonstrate utility. The question of trust, of course, is key. Regulation really is about trust and ensuring that people are operating to standards that are recognized and accepted. I've spent a lot of time in conversations with regulators over the last few years as part of license applications, as part of broader outreach, and I think they've come a long way. If we look back a few years, the concept of crypto assets and how they work was pretty alien, and you were really looking at very, very basic level conversations around this is what hot and cold storage is, and this is how we manage client funds versus corporate inventory and so on. And the conversation has definitely moved on from there. I think part of the problem is that regulation hasn't probably moved at the pace it's needed to move at. And I think you've had some countries such as Germany decided to, and Singapore have decided to kind of go out with at least a basic framework, acknowledging that it'll be an iterative process, and over time that will have to be built up. And they've tended to focus in on key areas of concern, which is usually KYC and client due diligence, protection of customer assets, marketing, I know is a hot topic in many countries, and so Singapore and other markets have really toughened up on marketing recently, but they haven't been able to do everything. And it'll just be a case of kind of, how long will it take to get to, a regime that kind of addresses these issues. I think also what you have today is a lot of kind of cross-border businesses. You have businesses serving customers in the UK without any registration requirement locally, which seems a little unusual if you think about it. Whereas other countries such as Germany would say, if you're serving German customers, you need to be locally regulated and you need to be onshore. So I think these kind of slight inconsistencies in approach are one of the problems that I think will get addressed. I can see a lot more focus of regulators looking to assert their authority, and also just building out, the basic principles of a regulatory framework. Let's not let perfect be the enemy of good. And for me, that's the next step. A lot of this stuff was predictable, that we'd have some, maybe not the FTX scandal, but something similar, bad actors doing things the wrong way. And, one could pose the question, would it have been better if you'd at least had a basic framework that would have been built on over time? So.
It's difficult to see, and particularly that iterative context. I mean, you mentioned cross-border there. Yes, it is different, but also, back to our initial point of where is the risk different and where is the risk exactly the same? Well, digital assets are borderless. This is an internet native service. So how can we change our approaches to regulation to reflect that? I think is a really tricky one. Toby, what are your thoughts particularly? I mean, we mentioned Singapore there. You're based out in Singapore. The regulatory perspective is not the only one on that cross-border concept, or do you think actually that is the key question at the moment?
I think regulators at this moment in time are quite reactionary to events that are occurring in their jurisdiction. Singapore were crypto-friendly until the Terra and 3 Arrows debacle. They are now actively withdrawing any applications that pertain to the crypto regulation in Singapore is effectively an EMI, and then they tag on a token consent to that. So anyone that has been engaged in an application for an SPI or the major license, then the MAS are now pushing back on them, saying, sorry, you've got to withdraw from this. And that's all based on events that have just occurred over the past 6 months. So it does feel, instead of regulators coming out and setting out their stall as such and laying out the frameworks clearly for companies and projects to be able to operate in. They're more reactionary to events, and until they can get on the front foot and set that framework out clearly, then we're going to continuously see this chopping and changing action.
In terms of keeping that that attention, though, and keeping that focus on this space, we're in a very different position to where we were with the last crypto winter, the last ICO crash, lots of bad actors again, and what we were left with is, I hope, some adults at the table. Matty, what is your view there on how we have demonstrated some of the utility, and we have moved the dial on adoption and who's using this beyond speculative trading? What's your view on how that will shape the next few months?
Well, yeah, there has to be utility, but vis-a-vis regulation, the problem with regulation is that it always starts local and then it expands to global. And for the first time in history, we have an asset class that starts out global and then comes local, so it's completely the opposite. But one of the awesome things, and bringing us back to the topic of this panel, is that gives crypto its value is that we don't need their permission. If they say one thing, we can go the other way. It's designed, built in, baked into the cake, that we can just simply operate independent of any kind of governments or banks.
Can I just say one thing?
Sure.
And I hear this all the time, this drives me nuts, because I agree with you as long as you stay within crypto. But as soon as you want to cash out, then the regulator comes. And so far, you're right, but you're also wrong in that sense, because that is fully controlled within the states, and we can't isolate ourselves from this problem unless you were to make assumption that you can buy all goods in Bitcoin, and you can also pay all your suppliers in Bitcoin. And until you reach that state,
and they do.
You can't, yeah, maybe for certain kind of business, but if you, I don't know, if you buy, if you organize an event and you want to pay the hotel, unless they were to take...
I have 40 contractors on quantum economics. 100% of them prefer to get paid in Bitcoin. Most of our clients prefer to pay us in Bitcoin. We have no issues with that.
I think you might be about 20 years ahead of your time, because in 20 years we'll have the kind of regulatory frameworks that are built into the code and that are transparent and aren't run by short-term views or local views. So I think, but the only way to get to that 20-year future where who cares about centralized government regulation when it's all already transparent and written in code is as friends with.
Well, the world is going global, so the banks and the regulators have two options: get on board or get left behind.
So
that's it.
Exactly. And to bring it back to our first question, what makes crypto valuable? I think what Sven's saying is interesting. If you are staying within the crypto space and you want to be paid in Bitcoin, then that's one thing. But is that the key value that we can point to as a utility? Which is, actually, if you'd rather stay away from the British pound, you can. Or
no, it's not always. Everybody has their own reasons for wanting to get paid in Bitcoin, right? For example, somebody that I'm working with in Ghana or Kuala Lumpur, I can't send them a bank transaction. It's not possible. They don't have PayPal. So for these people, for example, these are the easiest cases. This is why Africa, South America are simply going to leapfrog into the crypto world. For the United States, it might take a little bit longer, and especially with some of the regulatory hurdles that have been thrown at them, it can take very long. But for some people, in many countries, you don't need to explain to them the value here. It's already inherent. They already understand it.
I think that puts us in a really good position. We're coming up to 5 minutes of our session left, and I would like some concluding thoughts then on what that utility point is, because we've got various different versions of this. We've even mentioned NFTs. But if I could just go down the panel and have your concluding thoughts on if the value comes from utility, what is the top utility for you? And if you can give a specific market use case, then great.
For me, it's very simple. It's something that Olivier said. It's cryptographic proof. What is like proof of ownership worth? You send me a digital signature. It means nothing because the second later you may have lost your keys. So, but I no longer need to believe anyone. I don't care about a statement or record. I can prove for myself and can check whether the transaction that I expect to be in a database is actually there. That changes everything, because the one thing that I don't want to trust on, whether an asset exists or not, I don't have to trust on anyone. But therefore, we can then build trustworthy business relationships. That thinking, that technology is so fundamental to how we can organize markets that are actually more robust, safer, by learning from crypto, which is a funny thing saying from a banker, but I'm very convinced this to be the case.
So industry-wide change. Marcus?
So the use case that I'd like to point to would be, more developing economies today, where often you have very, very volatile currencies locally. You have people with no access to the traditional financial system, no bank accounts, but many of them have smartphones, and often they're running on older versions of Android or whatever it might be. These are people who previously would have had no access to any form of financial interaction, and now they have access through the power of crypto, through an app on their phone. This is a huge proportion of the world's population, and I think that if you need to point to a use case as of today, I think that's a great one to point to. And of course, I think there'll be many more to come. But I think often we forget, being in the bubble that we're in, that there are many out there that don't have the benefit of being able to, have retail banking and move money around easily as we do.
Thank you, Oliver.
In my kind of decentralized progress narrative, I think decentralized social progress is an essential element. But what makes crypto valuable, I hope is a question that we're not asking in 5 years. I hope it's as obvious as what makes the internet valuable. But for me, I think in terms of utility, which is the question, the core of this is, number one, move money faster, better. The original use case for Bitcoin. Number two, build things better, more transparently, more quickly. This is the the 2015, 2016 smart contract movement, which has exploded. And then the third, utility, which I think has immediate applicability in quite fragmented and broken secondary markets and general financial system run by investment banks, is decentralized finance, making those markets more efficient by connecting them better, by making them more transparent, by offering better risk management tools. And that's quite ironic given the chronic lack of risk management in this year. But yeah, risk management and DeFi in general.
Thank you, Matty.
Yeah, Marcus and I had a sidebar before asking about, we were just talking about when tokens are actually needed. And in my head, the answer really is there an ecosystem? And if you're asking me for specific examples of where there's utility, I mean, obviously we know about Bitcoin and Ethereum, and the utility there is very clear. But I mean, excuse the plug, but I'll just go to my clients on the advisory side. I'm advising woobits.com, which is building a social network on Web3. But actually, they tell me, look, we don't need a token. We work on Polygon, we work on Ethereum, and this is very serious. They don't need a token because they're able to integrate others. Lunarcrush.com has their own token where they do social media metrics, so you can see any token, its entire engagement history on social media. And they use their token to incentivize new users. But also you can use their token, if you stake tokens on their platform, you get further access to data, so you can get it up the levels. So Bloomberg Terminal, for example, that you pay $2-3 grand a month. With these guys, you're holding the token, so you're not paying them anything. It's your tokens, but you're holding it on the platform. That creates the demand on. And then another client I'm advising is called Supremacy Game. And of course, when we get to games, you don't even need to ask that question anymore. The utility is inherent. You're building an ecosystem. There's an entire in-game economics that are going on. You need to have a native token in order to deal with that.
Thank goodness for gaming and the innovation that comes from it. Toby.
I think fractional ownership of assets is a very strong use case, especially when they're larger illiquid assets. You can give access to a larger, wider audience to then deliver liquidity into the property, I would say, is right there at the top of the list. Real world use case that we're developing, we're BMW's blockchain partner. Today, we're launching for them Thailand and then Australia next. We are doing a cross-chain loyalty token for them for greater customer engagement, and the value retention in a token over a loyalty point is very, very clear. So we'll be rolling that out in Q1 of next year, and we've gone through that process of designing it, pretty much from scratch with them, and looking at the pros and cons of what is the difference between a loyalty point and a token with defined supply that retains its value, and that's a considerable delta that we're bridging.
Certainly. Do we have time for questions? We do have time for questions. Does anyone want to pose? No. Well, I hope what we've done here is map out for you the various elements. You can see there's, lots of value from the retail perspective, lots of value from the infrastructure perspective, and certainly knitting together markets in a new way, regardless of whether you're coming from wholesale or not. So thank you very much to my brilliant panelists. I hope you've enjoyed them very much. And I'll hand back for the next panel. Thank you.
Thank you very much, Anastasia. Wow, those cakes must have been quite something. Thank you, and also thank you to the cake dodgers in the room who remained for that. Another fascinating panel populated by fascinating and interesting quality people, which seems to be the theme running through all our panels today and also through tomorrow. I'm now going to welcome back on stage the marvellous Johnny Fry to talk about the future of money. Johnny Fry.
Thank you. Say again? No, it's fine. It's fine. Okay, so thanks very much indeed. I'm delighted. Hopefully, you're going to be a bit more provocative this panel. I've asked my panel members not to all agree, so let's see what happens. I'd like to start off with Jasmine. I'm going to fight central bank digital currencies till I die. So
Yeah,
you're
absolutely.
clearly not a fan.
I am not a fan, I know, and it's something I've actually talked about quite a lot. I am a fan of crypto, not all of them by any means. I am a very interested observer and user of crypto, but central bank digital currencies, I think, are the work of the devil, and it's something that I consider very much an antithesis to crypto. Fundamentally, as we know, crypto is decentralized. I mean, there are arguments about, different cryptos not being decentralized, but my view of crypto and what I like about it, that, the way it sticks it to the man, as it were, is by being decentralized. And by its very nature, of course, a central bank digital currency is centralized. It gives total control, potentially, not necessarily, but potentially, and it is the potential that I'm particularly concerned about. It potentially gives total control to central bank, central government, basically, so that the central government knows what you're earning, how you're earning it, where you're earning it. They can tax you at source. And then using lovely, clever things that come out of crypto, programmable money, these smart contracts, it can do all sorts with that lovely digital currency and tell you what you can and can't spend on, and then disappear that money if there is a bit of a problem with the economy. And I think currently it's being seen by governments and central banks and economists around the world as the kind of savior of governments that over the last few decades have destroyed our money, destroyed fundamentally, ripped the heart out of our currencies and out of our economies. And I think it's seen as the savior of that, because if you bring in central bank digital currencies, you can cover over, it will cover over a multitude of sins. So, yeah, sitting on the fence, that's my view.
Very much so, yeah. Max, what do you reckon? So the future of money clearly doesn't sound to be like it's a central bank digital currency. Would you agree or disagree? And it can't say yes or no.
I would certainly agree with that, but I would also add a couple of points, actually. So at the Cobden Centre, we're actually an Austrian school think tank funded by a member of parliament. So we've done quite a lot of work over the years in this area. We organised the blockchain summit in the European Parliament in 2016, where we had the IMF and the World Bank and other groups attending. So we've seen this build up over time. I started running the Cobden Centre in 2014. And one of the key areas then that's additional to what you just heard about is also interest rates. So in modern monetary policy, a lot of the control that central banks exert over the economy is through interest rates. And that, in fact, this year I published a book with our founder, Member of Parliament Steve Baker, called Are We in the Largest Bubble in History? And it uses his experience of the Treasury Select Committee, questioning Mark Carney and the governors of the Bank of England, to essentially show that for the last generation, every time there's been a recession, central banks have set interest rates lower and lower and lower and created larger and larger debt bubbles. And so a lot of this talk about central bank digital currencies, underpinning that has been a discussion of the control of interest rates. So for instance, the chief economist at the Bank of England in 2015, it was Andy Haldane, and one of the first speeches he gave on this was about being able to implement negative interest rates. So one of the key things here is now they're raising interest rates, this is going to burst the bubble that's been created over the last few years. So in 2007, global aggregate debt was about $150 trillion. After whatever it is, 12, 13 years of 0% interest rates, that's almost doubled to getting onto $300 trillion global aggregate debt. So now that even larger bubble is bursting, I suspect really the only place I have to go is negative interest rates, and the way to implement that is with a central bank digital currency. So it will be all of the dystopian aspects that you've just heard about, but on top of that, potentially negative interest rates programmed into the money itself.
Well, you're a real happy chappy, aren't you? So they're going to know what I'm spending on, and every pound I put in, they're not going to give me the pound back at the end of the day. Oh, what joy. Jana, you work with, you've been looking at central bank digital currencies, and you're an advocate of the technology, but there is a caveat. Can you perhaps give us your thoughts on central bank digital currencies as a potential future for money?
Yes, sure. This is going to be a fun panel, I can tell. So as a bit of background, I'm here today representing the Digital Pound Foundation, and we stand for the development of a diverse and effective ecosystem for these new forms of digital money in the UK. And so that probably says a bit about my stance. I'm neither entirely pro-CBDC nor entirely pro-privately issued solutions. We're not considering cryptocurrency on the same spectrum at the moment. So it's really, neither one nor the other should be supreme. It's really about, having in the future an ecosystem in which these different forms of digital money play potentially different roles as well. So, I think from my esteemed panelists, we've heard some pretty dark things about CBDC. And, yes, these are entirely possible. Whether they're probable, and I won't lump them all together. I mean, I think, some of the points that Jasmine raised are very valid, and certainly we have seen a lot of that sort of thing happen.
Not allowed to agree with her.
I'm using the classic tactic of agreeing with my opponent's argument and then going on to the disagreement, Johnny. Thanks for ruining that. So certainly, yes. I mean, we have seen elements of that kind of dystopian model implemented in China, but in most more democratic jurisdictions, such as the UK, let's not get into that argument right now, but there's a huge question around adoption and acceptance, and a central bank digital currency would only be widely adopted and accepted if it exhibited characteristics that engendered trust in the public. And that means it is unlikely that a solution would be introduced that enabled widespread government surveillance of our transactions. It's unlikely that it would not allow for some degree of privacy in, certain levels of transactions. And these are all topics that are being explored and discussed through the Bank of England's engagement and technology forums. In terms of Max's arguments on the monetary policy side of things, again, I mean, I would agree that those are entirely possible. I think, though, that the outcomes there, so yes, the CBDC is probably more useful as a means of affecting monetary policy than our current monetary instruments today. But the extent to which we would see such extreme scenarios would most likely depend on the government that we elected in and how they chose to enact monetary policy. So, and in a democracy, that would be, you know, what we would expect as the norm. So I think in both those scenarios, we're unlikely to see that scenario. But that's it. I should get on to what I do see as the benefit of central bank digital currency. So we've seen the introduction of all these, you know, hypothetical and some existing stable coins and things like that. And obviously Libra was the one that scared, you know, the unmentionables out of central banks globally back in 2018 when it was announced, 2019 when it was announced. And central banks, I think until then, had been tentatively exploring the concepts of digital native money issuance. But this really kind of goaded them into action. And for most developed nations, such as the UK, if you look at what a central bank can bring, what a CBDC can bring us in benefits, it's not more efficiency in our payment systems. We already have pretty efficient payment systems. But it's the competitive and the innovative aspects that we need to look at. And it's CBDC as a platform for innovation that we need to look at as well. And what other jurisdictions will be able to do in 10 or 20 years with their digital currency that we won't be able to do, and what that means for the future of our fintechs industry, our financial services industry, and things like that. And again, a CBDC is not necessarily the solution to all of this. It's also about an ecosystem that's supportive of stable coins and other forms of new digital money as well. Sorry, I went on there a lot.
You've drawn for breath, which is good news. Okay, but you mentioned Max. You mentioned the IMF. You look at the Bank of International Settlement. You know, majority of the Bank of International Settlement members are pursuing central bank digital currency projects. Why, Jasmine? Why are they so keen on these CBDCs?
Well, as Jenna has pointed out, there is a competitive element, and we're all wanting to keep up with the Joneses, you know, all around the country, all around the world. But I think, you know, one of the reasons, and again, another reason why I'm very unhappy about it, is the flexibility of central bank digital currencies. Now, as I say, I'm not a Luddite. I am interested in crypto. But what bothers me about both crypto and CBDCs particularly is the flexibility, well, actually, with some of them anyway, that you don't get, for example, and this is just an example, with a gold-backed or some other asset-backed currency. Now, you know, there are disadvantages, I know, to something that is asset-backed, like gold. But what I'm concerned about is that we need to bring back some sort of solidity, stability, and honesty, morality to our systems of money, our economy, our currency. And when you have CBDCs, essentially, you can the central bank or the government can do pretty much what it likes with it. Now, on the one hand, when you have flexibility like that, you potentially can increase, at least in the short term, you can increase economic activity, as we have seen with the printing of money. I mean, that, you know, money printing has created lots of flexibility and short term, quite a lot of wealth. But it comes with a price, and we're coming to the point now where we're paying the price of that flexibility. Whereas when you have something that is asset-backed, then you have some sort of morality, something that keeps the government, the central bank in order, and it keeps the people in order as well. So that's one aspect. And another thing that does concern me from what Jenna says is that, you know, that we say it's unlikely that Britain, for example, would go down the road of China and have some sort of surveillance culture. But then it depends how you do it. I mean, we have the most, in London, we have the most cameras, you know, video cameras on people anywhere in the world apart from China. In the top 10 countries or towns, cities in the world that have the most surveillance, London, I think, is number 6. All the rest are Chinese places. Now, if you said to British people, we want to put cameras on you 24/7 so we watch everything you do, people would go, no, you're not going to do that. But if you say, we've got a lot of terrorists and we've got a lot of murderers around, so we need to know where they are, people go, oh, yeah, you're right, yeah. So there's always a way to put it. I mean, same with, vaccination and everything. Oh, you could give it to other people if you don't get vaccinated, and then it's proved that that's actually not true. But it's got people going, oh, we've got to do this out of fear. So when you set the potential there, if you have people who are good at marketing it, you can get people to accept all kinds of evil.
Okay. Max, do we need to change? The title of this panel was "A Future of Money." What's wrong with fiat? Not the car, but cash. Why do we need to change it?
I mean, the current system is extraordinarily bad, really. In fact, Mervyn King said of all of the different ways that there's been of organizing banking systems, the worst is the one that we have now. And in fact, as a brief outline, the way that it's taught in economics textbooks is that banks lend out depositors' money. So someone deposits their money in a bank, the bank essentially is an intermediary. They lend that out to someone else for their mortgage. That's in fact not how it works. When a bank makes a loan, it creates money out of thin air. It expands both sides of its balance sheet. And so if we look at the current system, first of all, that's highly pro-cyclical. So when you have bubbles, they tend to get out of control. There's nothing restraining them. Banks will create more and more money. So the book that I mentioned that we published this year, we looked at, for instance, in America, the quantity of corporate debt from the early 1980s to now has gone up by a factor of 26. It's huge. So we are in a massive debt bubble. So that is something to be said for central bank digital currencies. That it likely would not be a system where commercial banks would be creating money out of thin air when they want to.
But hang on. At the moment, we have something called fractional banking. Surely, if I could deposit my cash with the Bank of England, then HSBC, Lloyds, NatWest, whoever I bank with, they couldn't just magic money, and therefore it would be very difficult to get debt, therefore interest rates potentially would go up, therefore the economy would struggle. The whole idea of fractional banking was to enable economies to grow. So are we just shooting ourselves in the foot?
Yeah, that is in fact one of the things that's been discussed a lot within these institutions, which is if you can just deposit, or us can deposit our money effectively with a central bank, then what is the purpose of commercial banks? And
well, a lot of people ask that in any case,
exactly.
Don't they?
I mean, they are, of course, very corrupt for the most part. And one of the benefits of a central bank digital currency, at least theoretically, is this idea that money would actually be something clearly defined from the central bank on down. It wouldn't just be pure credit money created by banks. There's also the moral issue to this system, which is that, for instance, if you get a mortgage to buy a house, for £500,000, the bank will create that money out of thin air when it's loaned to you. You then spend the next 30 years or so paying interest on that money that's been created out of thin air. And if you happen to get into difficulties, the bank can then take your house off you. So it's quite an extraordinary system, really, extraordinarily bad. So that is the potential benefit of a central bank digital currency over this. But we would have to see, and of course, the downsides are also very significant, as we've seen. A huge greater potential for surveillance and damaging forms of monetary policy.
Okay, but Jana, if you look at, there's 1.8 billion according to the World Economic Forum that people are not part of the financial system. They're excluded from the financial system. If we look at the poorest members in our community, and you're going to see it more and more on the press, they're having to go on paying for mobile phones and utility bills by putting in, I was going to say 50p coins, but it's probably £1 or £2 coins. They seem to be penalised, the very people that probably need the help. Wouldn't a digital currency help those people? Or is it just going to run into this problem, which I mentioned before, about fractional banking, and would you consider a collapse in the commercial banks?
Well, we're talking about so many different things here right now. And probably I should say here that many of the things I'll say probably don't represent the DPF, but are my own opinion. So fractional reserve banking system, and whether or not this is good for society as a whole. Personally, I'm kind of with Max on this.
The current situation's broken?
The current situation's broken. Having economies that are fueled entirely by debt is not sustainable. I don't think that this is outside the mainstream now, this whole thought that, you know, we are too fueled by debt and things like that. But as to the relevance of this to central bank digital currency, or even, you know, some of Jasmine's concerns about the type of money that people use and things like that, I don't necessarily think they have anything to do with CBDC, because many of those things can be changed without a CBDC. The introduction of so a CBDC is just a different channel of accessing money. At the moment, we have different types of money that we use. We have publicly issued money in the form of cash, which is central bank money that we use day to day, or central bank reserves held by commercial banks at the central bank. But most of us don't access that day to day, so that's not our thing. But cash, when you use cash, that is a liability in the central bank. And we have privately issued money, which is your commercial bank money. So everything that you hold in a bank is commercial bank money, and that's created through the fractional reserve banking system, which has its own issues as well. And when we talk about the future of digital money, to some extent, it's a continuation of that. So what type of public money will we have in the future? Well, that would be CBDC in whatever flavor it comes. And what sort of private money will we have in the future? And there's lots of scope there, because it doesn't actually have to just be tokenized commercial bank money. It can be other things as well. It can be different flavors of stable coins and things like that. And the question is, how are they structured and how are they regulated? So in terms of financial inclusion, going back to your original question, Johnny, financial inclusion is a great use case for new forms of digital money. But to say that financial inclusion is a natural consequence of introducing any of them, whether they're CBDCs or privately issued, would be false. Something has to be designed with financial inclusion in mind. And different jurisdictions are introducing CBDCs in particular for different reasons. So in many developing economies, it is for financial inclusion. It's for leapfrogging the need for, online banks and things like that. It is to enable access to public money by individuals wherever they may be. In other jurisdictions, like the EU, for example, there's a very different driver there, which is further greater market integration. The UK is still looking for its why. The US will probably be because it wants to retain its dominant position currency-wise on the global stage. So everyone has different reasons. And to say that it's all because they all want control, or it's all because they all want to be able to control various aspects of monetary policy, wouldn't necessarily be accurate. Some of them have very valid use cases as well. So for example, the Bahamas, 700 odd islands, really difficult to distribute, to fill up ATMs, especially during a pandemic. So digital currency seems like the logical solution. Cambodia, monetary sovereignty, so they're a heavily dollarized economy. They actually wanted people to use their own currency, so they introduced the Bakong for that reason. So yes, you can build in financial inclusion, but actually, if you're going to do that with a CBDC, you need to rethink how you offer services to people. If you just keep it within the same kind of banking system and infrastructure, you're going to exclude people for the same reasons they're excluded today. They are not going to pass AML checks and stuff like that, so you have to rethink the whole system. Digital identity ties into this as well.
Okay, you raised the point America has different reasons for that, and I'm interested because we're talking about the future of money. I can't help but ask you about the dollar, Max, as the world reserve currency. As you say, loads of debt. Our Yankee Doodle friends have got loads of that stuff. According to some sites, there's only 5 or 6 companies in the whole of the S&P 500 who are net cash positive, because executives have been encouraged to leverage up, do share buybacks, and keep their EPS, and therefore keep their options live. Do you think the world reserve currency, i.e. the US dollar, has its time come as we're talking about the future of money?
I think that's the case. I don't think it'll happen quickly. I think it will be diluted over time. But the end of the Bretton Woods system which came about due to the exorbitant privilege, as it was called, of the dollar being the world's reserve currency. That privilege is now even more exorbitant. So what that means is if the dollar is the world's reserve currency, because central banks around the world hold dollars, the US can essentially print money digitally to pay for things, and it won't be inflationary because there's so many dollars held around the world. Whereas we saw what happened recently when Liz Truss and the government here tried to pursue essentially Reaganite policies of unfunded tax cuts. So yes, I think this period will come to an end. I doubt whether the Chinese currency will replace it or any other national currency. I think it will be diluted more and more over time. And I think touching on crypto and some of the different use cases we've heard about today, a concept that's talked about in the Austrian school from someone called Fritz Machlup, one of the top economists, is the idea of moneyness. That is the idea that different types of money have different usefulness in different scenarios. The classic cases like cigarettes in a prison, where they're used for money, but obviously not elsewhere. Now, if you think about some of the use cases like decentralized file storage, which I'm sure you're familiar with. So concepts like Filecoin and these types of ideas, those tokens have their use case and they have a degree of moneyness. But obviously you wouldn't walk into a coffee shop and buy a coffee with Filecoin. So I think that will be one of the things that will happen over the next few years and over the next generation. This moneyness aspect, the dollar reserve currency status will also be diluted by these specific tokens with specific use cases.
Okay, Jasmine, you run something called Money Magpie. Is it going to be renamed Moneyness Magpie?
It's a good one.
Do you think is the US dollar here and we're stuck with it, or do you think the future of money, we're going to see less reliance on it?
Yeah, I think we will. I mean, I agree with Max that it's not going to be overnight. It's going to take a while. But my feeling, as you know, one of the beliefs at the moment, and I kind of subscribe to it, is that we may, instead of having one single reserve currency, we may go into a sort of two-party state where you've got the West having whatever it's going to have, maybe continue with the dollar going down and down. But then you've got the BRICS countries that are setting up their own thing. And honestly, my money would be on the BRICS countries. Again, you're looking at the ruble, which is massively backed by solid, huge gold reserves, huge commodities. It looks like the Middle East, the Arabian countries are looking towards Russia as well. Russia and China together would be a phenomenal power economically. So it kind of makes sense to me that we could bifurcate and have two reserve currencies ultimately.
Well, I think that's the word for today, bifurcate. People, I know you haven't been here all day, but a word that keeps coming up. Jana, the decline of the US dollar, the future of money, are we going to see the Chinese, or are we going to see some asset-backed currency, do you think, coming to be more dominant?
I don't think I could possibly speculate on what will replace the US dollar, but I do believe that the US dollar will lose its significance over the coming years, and that's for a number of reasons. I mean, the political situation in the US and its likely impact on the value of the dollar, because it's all very well the dollar being widely in circulation, but it's only as good as its exchange rate, right? And as soon as that starts tanking, there's all sorts of issues in store. But also, I mean, I do think that the introduction of digital currencies and the utility of digital currencies will have an impact on the hegemony of the US dollar as well. And whatever form those are in, if people find more utility in other means of exchange, then they will shift towards using those. And that's particularly relevant in cross-border payments and in international trade as well. If there is no digital dollar, for example, then as trade becomes more digitized, the case for retaining the dollar as the global means of exchange becomes a lot weaker.
Right. And in terms of the future of money, we touched on interest rates. What's your? We've only got a couple of minutes to go, but just be interested, each one of you, your thoughts on interest rates over the next 12, 18 months? What was that game? We said higher, lower.
Yeah. So as I said, I think for the last 40 years, each recession has been responded to by creating an even larger debt bubble. And so I suspect after a decade of 0% interest rates, this is going to burst that bubble, and they'll have to come right back down. Once the debt liquidations start, they'll have a choice between either a 2008 style scenario or coming right back down to 0% interest rates, and potentially even, as I said, trying to implement negative interest rates.
Okay, Jasmine?
Yeah, I agree. I think it's going to go up and then down. And in fact, as you say, I do moneymagpie.com, so I talk to consumers a lot. And I've been saying about mortgage rates that they're likely to come down, so it's almost worth waiting. I feel almost that the government has, or the central...
So you think we're almost peaking as far as mortgage rates go?
Not quite, but well, actually, we may be. But I suspect they're going to continue to go up a bit, but then they will come down. And I do feel the central bank is giving itself the potential to a bit of wiggle room. Put them up so that later on, when everything goes pear-shaped, go, oh, we'll bring them down again. A bit of wiggle room. So I suspect, the same as Max.
Okay. Jana, any thoughts on that? Bear in mind, in theory, interest rates sort of what supports people's confidence that they can earn a return in cash and therefore money.
Well, I mean, you don't earn a return on cash. That's the whole point of cash is bearing.
You get an interest.
Technically. Well, no, if you just hold cash, you're not going to get any interest. But you mean money held in a commercial bank, yeah. Okay, so I think there's two things at play here. There's interest rates as set by central banks, and then there's the interest rates that are actually charged to consumers outside of mortgage rates. And mortgage rates, obviously, in most cases, track the Bank of England or other central bank rate. And so I think that central bank interest rates will fall because central banks will, especially in the UK, we use it as a tool of monetary policy. And in this sort of environment, just as Max has explained, that it's inevitable that they are going to fall. Now, as to the extent to which those are going to be passed on to consumers, that's a different question entirely, because that's also dependent on the level of risk that banks see and the returns that they're hoping to get as well. And if you just look at the spread between, consumer interest rates and the Bank of England interest rate, it's like, nearly 20%. So it's the extent to which central bank interest rates will fall and that will affect the wider economy is, I think, more debatable at the moment because we're in this kind of debt-fueled economy.
Okay, and I just perhaps like to leave you one final thought. A lot of people talk about central bank digital currencies, and talk about the infrastructure isn't necessarily there. And it was interesting to see a recent statement from SWIFT, and it was in relation to ISO 20022, which is a really snappy title. And essentially, it's the ability for them to be able to transfer information, transfer data that's much richer, got much more detail. And they claimed that their rails, their system, their infrastructure could indeed handle central bank digital currencies and all digital assets. Now, if that is indeed true, they look after, or their 11,000 members look after 4.5 billion bank accounts. So I should imagine everyone in this room, that potentially impacts you. So I think that's worth bearing in mind. You could suddenly see central banks, for a variety of reasons, as we've touched on here, actually introduce a central bank digital currency or some form of digital currency, and the systems and procedures are already in place, in theory, according to SWIFT. But as they say, that's a story for another day. Thank you very much, Max. Thanks you, Jasmine. Thank you, Jana, for joining us. And yeah, if we're around for the rest of the day. If anyone's got any queries or questions, please feel free to come and have a chat. Darren.
Cracker from Johnny Fry, thank you. Right, we've got two more sessions coming up today, and they're both absolute belters. So to get back on schedule, what we're going to do is we'll take a small break now, but if I could ask if you could be back in here for 5 to 5 for two brilliant sessions. I promise you, the quality of these two are just wondrous. But yeah, if you could be back in here for 5 to 5, grab whoever you can off the street, bring them in, gather them round, and let's have a really good finish for the day. So enjoy your break. You, okay.
Ladies and gentlemen, please take your seats.
Of this afternoon, I've promised you a couple of absolute beauties. And this first one genuinely is, because it's headed up by the amazing Charlie Kerrigan, who has never disappointed me throughout the time I've known him.
Sure about that? What was that today?
Yeah, I've only just met him. The second panel after this, by the way, there is a change to the running order. We've got a great surprise for you. It was going to be the future of crypto payments with Mark Scarpa. We've upgraded that panel. It's going to be about the media, friend or foe to crypto. It's going to be a beauty. It's going to be Mark Scarpa, James Bowater, and myself. However, regulation it is, and I'll leave it to Charlie to introduce his guests. Thank you.
Terrific, thank you. Well, we're a panel is short, but let's hand over. So we'll introduce ourselves. I'm a lawyer. I got a background in corporate finance, in tech and fintech and deep tech, and that brought me naturally, in some ways, to crypto about 4 or 5 years ago. It's a fantastic market to work in as a lawyer. Lawyers generally are doing things that are repetitive. You don't see much novelty. It obviously couldn't be more different in crypto. We've all had to reinvent ourselves many times over as the market evolves and changes. And I'm joined on stage by a couple of special guests. We're going to talk through the topic of the day. I know we've covered it from a number of different angles already, but we're going to have a go looking at international regulation. So first, the introductions.
Thank you. My name is Anna Timon. I'm MLRO for SG Veteris. And well, I guess my background, I worked for the FCA in cryptocurrency division, SEC in the United States. I've always been in legal compliance world, financial crime, AML, and Forex, banking, asset management. And so here I am in cryptocurrency.
Hi, well, you're probably fed up with me by now. I'm a viticulturalist and part-time lawyer, here to help with this regulatory debate.
Right, so SBF told us that he wanted crypto to be regulated, and he's going to get his wish, right? Where do we go from here?
Okay, I guess I'll start. Thank you. Well, I'm not against cryptocurrency not being regulated as far as Bitcoin and all the currencies. I do support companies being more regulated, especially with FTX. We had a scandal now came out, and as we discussed earlier, there was a lot of mismanagement in the company, a lot of negligence, and it's a fine line between negligence, incompetency, and fraud. So I think companies should definitely fall under more scrutiny and regulation as opposed to maybe different entire cryptocurrency, which didn't take, the price movement didn't take FTX down. It's the company mismanagement themselves. So I think I see more on regulation and coming on a different aspect outside of not just money laundering and financial crime, but also, you know, custody, CAS rules, conflict of interest, transparency, disclosures, and so forth. So I would see this going forward towards more companies and actors.
Yeah, I think where we go from here is going to be driven to a significant extent by the US in response to FTX, for obvious reasons. Yeah. And I don't think we touched too much on where we think that is going to go. The US is unusual because there is quite a hot debate there as to whether crypto should be regulated as a security and the SEC should have prime responsibility, or whether it is property or an asset class in its own right, in which case it may not be the SEC. At the moment, looking at what people like Gary Gensler are saying, I think the US is likely to treat it as a financial instrument of some kind. I don't think they'll treat it as a conventional security. But with that will come all of the corporate governance, oversight, and regulation that goes with US-traded financial instruments. I think that's where we're going. And I think FTX will significantly shape where we go. The US has always been a key jurisdiction for enforcement of all kinds, because classically it has the long-arm jurisdiction. It can basically assert authority to prosecute and recover assets which have involved any kind of dollar counterparty trade. And at some point, that will always be the case with crypto assets, either in the way in or the way out. Or payment for services connected with crypto asset trading. If any of that is in a dollar trade, the US will say, we have jurisdiction. And then we've got their catch-all, which is wire fraud. And wire fraud, it's I wish we had that as a prosecutor in this jurisdiction. It's very, very easy to commit that offence if you're involved in any kind of wrongdoing of a general nature. So I think the US will come in heavily, and whatever we might want in Europe, the UK, Singapore, elsewhere, the dollar-backed financial markets will determine the US as, I think, the major regulatory player.
So I think we're going to do our first poll of the evening. It's an analog poll, because we didn't rehearse this. In the room, raise your hand if you feel like you have a pretty good understanding of how crypto is currently regulated. Raise your hand. So I was expecting more hands, because I think what we're saying up here is relatively few of the rules are directly related to crypto. Looking at the UK, we've got money laundering licensing requirements for onshore entities that exchange or custody crypto. But everything else are the traditional rules. And you can, we write textbooks about them, but you can summarize them really succinctly around not facilitating financial crime and not issuing securities without a prospectus, so an investor protection theme around that. And one of the things that I think is most important for the industry and for regulators is, if we're going to put power in the hands of consumers, then we always talk about the education piece, and education on regulation has got to be part of it. We're going to look forward to where regulation goes from here, and we started touching on that. I think we said we try and keep it practical. The hardest point, I think, in crypto is these are by nature international businesses, although we'd like to be international. And it's a very expensive task to comply with international rules. So you're complying with 100-odd sets of rules, all of which are subtly different. Each of you, what's your practical thoughts around how companies can think about that regulatory environment? How do you go about trying to be compliant in that context?
It has to be a global regulation, for sure, across all jurisdictions, and with the same requirements. Otherwise, it almost becomes impossible, even more costly, to comply as well. And technology, and we're talking about KYC documents. Some providers can work with European documents, but not in Asian and Middle Eastern, different names, different characters. So you have to have different service provider, and it goes across the different services. So yeah, it becomes challenging. If the regulation would be global, it would be much simpler, of course. Naturally, United States, Europe, and other parts of the world.
I mean, to answer that question, you've got to realize where we are. There's a brilliant study which is available online by the Cambridge University Judge Business School, which is the crypto asset regulatory landscape. And it's a world survey, and it has a long appendix with every single major economy and what they're doing with crypto assets in terms of regulation. And you only have to read that to realize that there is absolutely no consensus at all, and really no prospect of that. So we're never going to get, in my view, in the next 3 to 5 years, to the position we had before we left Europe, where we had financial instrument passporting with Europe, so we could simply trade instruments backwards and forwards without any kind of regulatory border between them. So if that's where we are, what's the answer to the question? The answer to the question is with great difficulty, because in my view, all that you can do, if you want practical advice as a compliance officer, is make sure that your onboarding's right, your documentation has the right jurisdiction, as I indicated this morning, so you've got some legal certainty, so there's a decent legal system sitting behind your transactions. Get your KYC right, and do your due diligence on your clients. And I think if you get that basic framework, that basic corporate governance framework in place for your business, then you don't solve the problem, because the problem isn't going to go away, but you mitigate the risk of doing international business, because there's less chance of a wire fraud charge from the US, there's less chance of regulatory blowback from a European country, for example. So it's not an easy place to be for an in-house regulatory lawyer at the moment, in my view. And I just think you go back to basics, get the basic structure, governance and oversight right, and cross your fingers.
Is FTX going to make businesses more cautious? So I think we've all seen, even some of the largest businesses have used regulatory arbitrage to access customers in the UK from .com addresses outside the UK. Does FTX make that more difficult because the customers are likely to be more accepting of it? So is this a lesson to businesses that's going to be learnt from customer behavior changing as a result of what's just happened?
I think it's going to be a lesson for everyone, investors, companies, regulators as well. In 2008, we had that Dodd-Frank Act coming after the crisis that kind of put the same regulation, addressed financial crisis. So I think we'll see the same, and probably from the United States, I agree with you, and other jurisdictions would comply. But yes, it would make companies cautious of what needs to be done internally. Mm-hmm.
Yeah, Charlie, I think you're right. I think one good thing that might come out of FTX is that I think customer counterparties are going to be much more questioning about exchanges or platforms they invest into or they entrust with their assets. And so that kind of due diligence is going to be two ways. I mean, I don't think that's just retail clients. I think that's going to be all clients. And that's going to have quite a significant effect. So yeah, I think there'll be a cultural change, at least for a while. I mean, memories are short, sadly. And, the market, all you need is a bull market, and everyone gets, carried away with that. And all of this disappears again. But I think for the time being, you're right.
Shall we go to the room? Tell me if this has been done before. Who uses centralized exchanges? And before last week, since last week, have you become more aware of the regulatory status of the exchanges that you use? People have checked that to some extent since then. What does that mean for regulators? Can they do something with this potential change in customer behavior, or does it not affect the way that they have to look at the market?
I think there is a focus on regulators. Investors and companies expect for something to be done, for kind of regulatory scrutiny more. So yes, I think they would have to follow up on it, and address it. So would be more attention on regulators.
Yeah, I mean, it's a hunch, but I suspect that regulators may be contacted to verify or to check. I mean, we know in the UK they're not particularly communicative or helpful. I remember when crypto was first used to take wealth out of China, for example, and invest in London property. That was done to a lot of unregulated FX traders, or they purported to be FX traders, some of whom also purported to be regulated by the FCA. And the reason that all came to light is that people in the FCA in Canary Wharf got calls saying, have you heard of these guys? They've got an FCA registration number, is that right? And they say they're on your website. and they weren't. And so, yeah, that was customer due diligence in reverse, if you like. So I think that could happen, but I mean, that's very episodic and it's very anecdotal. I'd like to think people are going to be much more cautious about who they deal with as a consequence of FTX, and I think that will engage regulators. The problem we've got in the UK, and I'm not an FCA basher, is that the culture of regulators generally in the UK is not ready to engage. Whereas in the US, if you're dealing with, for example, OFAC on sanctions, you can have a really meaningful conversation with these people. You'd never get that from the OFSI in this country, for example. And so it's not a criticism just of crypto financial regulation, it's across the board. It's just our civil service culture. But I'd like to think that they will step up in the way I suggested this morning, like everyone else needs to sort this out.
Get some views on DeFi. Will it be regulated?
God, I'm gonna go first and say, I'd stick my neck right out there and say no, because I just think it's gonna move to the next shadow. There'll always be an element of the market that will see regulation coming. They'll see the bright light of regulation, and they'll just move to the next shadow, the next shadow, the next shadow. So probably the better answer is yes and no, which is a great lawyer's answer. I think parts of the DeFi sector will accept regulation, but I think a significant part of it never will. And because it sees lack of regulation as its essence, as its raison d'etre.
So that compliant bit is, compliant DeFi is something like DeFi with KYC. Is that probably what you think?
Yeah, I think so. Or what the European Union have in mind in MiCA, which is essentially asset or currency-backed tokens, where you're pretty much latched onto the conventional financial system. But the whole point about the purest part of this sector is that that's what you're not, and it's that part of the sector that I don't think are going to accept regulation. I think the only regulation they could possibly accept is the very basic level of money laundering compliance, know your client, the sort of basic stuff that people have to comply with at the very lower levels of what HMRC require in this country to stop basic money laundering and terrorist financing. But above that, I think they'll just keep, as I say, jumping to the next shadow. These are smart people. They'll stay ahead of the regulators. They're better resourced and they're, generally speaking, smarter. So I think they'll always stay ahead of it.
And that's kind of the point of the whole cryptocurrency DeFi, not to be regulated. So I agree, there's going to be some level, minimum level regulation, but generally I think it will keep moving to keep the same characteristics.
Views on the UK? So I think my sense is that our new rules won't follow MiCA, so there'll be a deliberate divergence, and the policy of being a global hub for crypto assets has been restated with Sunak and John Glenn back. What do you reckon the chances are?
Yeah, I think we're going to try and go much lighter touch than Europe, which isn't surprising. The paper I sat and dutifully read last Sunday is pretty heavyweight. I mean, there's quite a lot of detail in that. And if that were translated into legislation, it would be quite onerous. And all the signals we're getting, not just John Glenn, but the head of civil litigation in the UK, Geoffrey Voss, the first sort of senior civil judge in England to be a true techie, he understands the market, he understands how it works. And I think he's surprisingly light touch, and he is a real evangelist for London as a centre for crypto contracts and crypto litigation. So I think they'll try and be as light touch as possible. I don't think we're going to get that three-stage categorization that we see in MiCA, because actually you're either looking effectively at currency or asset-backed tokens and then the rest, and I think Europe will treat the West as the Wild West, and I think they're going to treat that with great hostility, and I think that's going to be the big difference. So the non-asset-backed tokens, I don't think will be treated by hostility in the UK, and I think that's right. If you're going to embrace the sector, embrace the sector. Don't make it into sort of quasi money.
think more for practical point of view for compliance. I see FCA applying the rest of FCA handbook to cryptocurrency and making it a license regime and not just registration, and applying kind of regulated finance principles and regulation to cryptocurrency on a whole scale, and to make it more compliant for companies.
Yeah. So I'm going to count us down and make sure that we're not late for James and Darren and the media panel, and also give an opportunity for people to get some free legal advice. So get ready, prepare some questions. Before we get to that, so I'm going to just return to the practical bit for a couple of final questions. What do your clients come to you most consistently doing wrong that wouldn't be difficult to do right?
I would say that the key characteristic I've seen which leads people into trouble is a really unusual informality in their dealings with contractual counterparties, which you would never see outside this sector. And something about this sector does that to people who would ordinarily want everything documented and they'd want to do their due diligence. Something about crypto assets just switches that switch off in a lot of people's brains, and everything's done at an informal level. I'm not going to call it naivety, because it isn't, because these are smart people and they know what they're doing, but they're prepared to accept a level of informality that you wouldn't accept outside this sector. That's the one predominant characteristic I've seen leading to car crashes for people.
This is a hard question to answer. Is that in any way the shape of things to come? So is that going to bleed out of crypto into other areas of life, or you think that is a crypto thing and it'll slowly become more normal?
No, I don't think it is, actually, because one of the reasons we're all here is that the mainstream banking system has undoubtedly failed, not just the people that the crypto sphere say they're here to save, but actually a lot of the mainstream commercial market. It's very difficult in London at the moment to get finance for a commercial development. So peer-to-peer lending has essentially stepped in to take over from conventional retail and commercial bank lending. And I've seen the same thing in peer-to-peer lending. You're not dealing with a bank with a compliance officer and a guy with a spreadsheet who's working out returns. You're dealing with a guy in jeans, chinos, and he's fairly chilled, and you're chatting to him in a coffee shop, and he might be dressed like James Bowater. And you think, you drop your guard, as we all do. So I don't think it's a crypto thing. I just think it's just not mainstream, and people think, oh, this isn't mainstream, I'm going to treat it differently.
Yeah, you're making me think, certainly in fintech, there's never the piece of paper. So if you're doing banking work and you say to the bank, we need the piece of paper, the license, or whatever it is, somewhere or other they've always got the piece of paper. The fintechs never have the piece of paper. And sometimes they know they should have it, and sometimes they don't know. So yeah, crypto and fintech, maybe you've got something in common there. Anna?
Yes, I basically completely agree with you that it's a growing industry. I think clients and companies are more used to being compliant, especially when they apply for registration, for licensing in other jurisdictions. Most of them have KYC, onboarding process, transaction monitoring, fiat monitoring. There are lots of already service providers that can help with that process. Policies, procedures, so it's growing. So I think they're more used to becoming regulated.
I think I'd see that as well. If any client or contact that's come from a regulated background is not surprised by the difficulties of getting a license and what's required to comply with it. So we said that we'd go to the floor and answer legal questions to the extent people have them. Here's the first one.
Thanks, Corby. Hi everyone. This question is a little bit techie as well as legal. So as per the white paper written for Bitcoin, it was a parallel financial industry. Now we are trying to regulate this. Now with this regulations coming in, I'm pro regulations, by the way. I worked in the bank for 12 years, was in regulatory projects, etc., etc. So we are trying to regulate this now. So there might be someone else who might come up with new financial system in future. Now, what's happening today is there are a lot of industries that have mushroomed around these regulations. For example, the crypto lawyers and other things. And they are milking money like anything on the fear of unknown. If you go on to HMRC or whatever, FCS website and read about the regulations or the guidelines that have been given over there, it's pretty straightforward at the moment, though there are a lot of, it's not very clear. But when you go and speak to any law firm in the UK, they will ask you for at least £25,000 to just, you need FCA registration. So it's pretty standard. So what's the reason for such high pricing by these law firms when things have not been clearly defined yet? I can go and read it myself. Yeah. So what's the value addition or the fear of unknown that these legal firms are working on right now, and when the prices will come down?
Well, defending lawyers' fees, that's I can feel the ice creaking under my shoes as I speak. Hey, I think there's two parts to the answer. The first is that, as somebody joked earlier, with a lot of lawyers at the moment in this sector, you're paying for them to learn. And secondly, a lot of them actually just don't understand the sector or the regulation or absence of regulation that attaches to it. And like all lawyers, and I'd be the same. I'm not. I'm setting myself out as different. You're very cautious as a consequence, and so you want to cover all the bases, and you start looking in corners you don't really have to look in just to say I've looked in that corner. I think that's the reason. I think the legal market at the moment on advisory, as opposed to litigation, is very undeveloped and unsophisticated, and I think that does lead to some unrealistic demands for fees, and actually probably not great value for money when the advice arrives.
If there is no other question, can I ask a follow-up? So as legal industry, my parents are lawyers, both my mom and dad. If I wasn't doing what I'm doing right now, probably I would have been a lawyer myself. So is this not our duty towards the legal firm's duty to help and support this industry, the startups? If we are paying as a startup for somebody else's education, then does this not becomes the legal industry's responsibility to help and support and embrace this technology? There are many different ways to pay to these legal firms. So what's your take on that?
Yeah, I think the market has got to develop. It's a fair point. I think for startups, if you went to a firm in the City of London who could advise on this, you're looking at a relatively small number. Charlie's is one. And they're large city firms. So if you're a startup, that's a problem. I started a small, unusual legal practice recently, 2 years ago, and we couldn't really go to the big regulatory firms to get advice on what we shouldn't do in terms of our structure. So I get it for startups. The legal market is going to develop, and lawyers are very good at forming associations. There's lots of associations of lawyers. Isn't that right, Charlie? And there is actually an association of regulatory lawyers. And I know what they're doing at the moment is looking to pull in a lot of the in-house expertise, because in my view, apart from honourable exceptions like Charlie and his firm, there isn't a great deal of mainstream expertise out there on non-contentious. There's a lot of expertise in contentious, but not non-contentious, what you're talking about, startups. And they're looking to pull together that expertise from in-house, where there's some real skill, and resource this kind of advice for startups. Now, that's going to take time, and not many lawyers will want to do it for nothing. But I think there's a real gap in the market for a small, fleet-of-foot, innovative, relatively cost-effective, non-contentious boutique startup in the legal area who can give this kind of advice. But at the moment, probably right, there's no one out there, is there?
Yeah, so I think I can, I agree with everything that James is saying, and from my experience, so in our team, there are 7 of us doing this full-time, and I'm the only one who wasn't an in-house lawyer in a crypto firm. So we hired the in-house lawyers, just as you're saying, because by definition, they're interested in crypto. They are spending the discretionary time reading the white papers, staying up to date with the news, able to have a conversation. There's nothing more discouraging for a client than explaining the project by reference to things that are widely known in the market, and the person that as you say, you feel like you're paying a lot of money at hourly rates, saying to you, can you explain? So we have taken this particular approach. It sounds much more strategic than it ever was at the time. We just hired one and then another. And now there's a group of people who are essentially, we're all paid to do our hobby. And you get a different type of approach on the advisory from people who've worked in-house as well. Because you've got experience of the CEO standing over your shoulder and saying, I need you to tell me this is okay. And you saying, it's not really. And the CEO saying, well, we launched it 45 minutes ago, so you better find a way of making it all right. So there's just a way of, lawyers are notorious for taking their time, writing long memos, providing a lot of irrelevant and arcane advice. And there are normally justifications for doing that, but it still isn't what people want. I think in crypto, the nature of the clients is that they're generally not looking for legal advice. They want to be helped to launch the project in a safe and compliant way. So there's a change in mindset in lawyers that I think we'd all see. On the point, so most firms do have startup programs now. We've got a startup program, and most of our peers have. And the other thing that I think has been of great benefit to us is, well, one of the 7 isn't a lawyer. So there was no form to fill in my firm to hire someone who's not a lawyer into a legal fee earner group. It took me about a year. But it's been one of the best hires we ever made. Just we get a view of the industry, validation of clients, projects, someone watching our back, someone who's got a different perspective. And all of these things are pretty unusual. Law firms are conservative. They work on by reference to precedent. The law's built by reference to precedent. So what do you know? It's a bunch of fairly conservative people who like doing the same thing again and again and being paid for it. So crypto people are not natural lawyers. And I think what you've got to try and get in the industry is crypto people who are lawyers rather than lawyers who do crypto. My experience is quicker to teach the law to crypto people than it is to teach crypto to lawyers by a mile.
Yeah, yeah. I mean, the best lawyers give 2 kinds of advice. There's the black letter legal advice, what the law says, and then there's what I would call real world advice, which is a combination of that and what you think the client should really do. And sometimes that may diverge from black letter advice.
And that's not just a crypto thing. So I worked in one of the very well-known corporate finance firms, and the top corporate lawyers there were sort of the kings of the corporate jungle, and the very top people at the top of the profession were M&A takeover lawyers for the top projects. So they would walk from room to room, and the clients in those meeting rooms would kind of brief them and say, what should we do? And that person was a lawyer, would say, I would recommend you do this. And they wouldn't say it's kind of legal advice or this. So I think we know what clients want because they tell us and they vote with their feet. You just have to have a certain level of support from your organization and confidence and a good team around you to be able to do it.
Hi. My experience is there's a third type. There are a lot of lawyers that are looking at crypto as a major billing opportunity. And this billing opportunity leads them to ask themselves a question. What can't we do? What shouldn't we do? Right? And the one big thing we should not do is issue legal opinions. They carry unlimited liability. Yet, it takes the least amount of time to do. Legal memorandums, on the other hand, take the most amount of time to do. So we'll give you a legal memorandum which, as you know, couches existing law and shapes and supports an argument, the same way a motion for summary judgment would, right? But that doesn't protect the founder, right? Because it's speculative in nature.
Don't forget to ask a question.
I'm sorry, my
Sorry, we're not feeling a lot of love here, Jason.
It's not. It's present company excluded. My question is, what efforts is the legal community in the UK making to balance the integrity of the legal advice given to the startup community who's pursuing projects in crypto?
Yeah, I'll go first, because I think you've got bad actors and greedy actors in the legal profession like any other. But actually, ultimately, the London legal market has to be competitive. And actually, if they don't get their act together and give clear advice, which is value for money, and actually tells clients what they can and can't do, and then they're going to go somewhere else for that advice. Well, that could be the US, it could be Europe, could be Singapore, where the law is very similar. A lot of Singapore lawyers want to get in on this. So I think the market will drive that. And as I said earlier, I think there is the Regulatory Lawyers Association in London really looking to pool expertise in crypto and see how that can be used. And as I say, it is in-house. And I think, yeah, it's a question of giving that commercial advice as well as legal advice. I was talking to a regulatory lawyer just very quickly a couple of days ago. He said to me, look, honestly, would you have told a client to invest in FTX 12 months ago? Well, I think there were a few people right on the inside who knew what was going on, but most people didn't. So actually, the black letter legal answer was, yeah, probably would. But what would I actually have said to a client? Well, when you've got a 30-year-old sociopath who rocks up, who's not got a history of success in anything, and who likes to be called by his initials, probably don't do business with him. And that's the sort of real life, real world advice.
And you can be directive. You can say to law firms, because we get it all the time, here's the task, here's the budget. You can choose to take it on or not, and you can come back and say, look, for that budget, you're going to get a Mini, not a Rolls Royce, and the law firm will negotiate with you about what's out of scope, what they're not doing, what they're covering in less detail. But absolutely, there are very few of our clients that aren't directive about the budget for the tasks that they give us. And I think firms are, across the board now, more open to that. It's the model is to charge by the hour, but that's an internal metric. I think there's a price for the job, and that's set by the market and where people are in the market. The large crypto firms expect us to support the smaller crypto firms. So when we do the scorecards for them at the end of each year to say how we're doing, we got to fill in information about whether we supported their portfolio companies, whether we were getting involved in Web3 education, things like that. We're judged on that stuff as well.
One word. Where is the best jurisdiction to launch a token?
We get asked that more than any other question. So there is obviously no single answer. What's most conventional is use a BVI token issuance company. So BVI and Cayman Foundation BVI issuance company. That's what.
Even with the recent BVI rule changes?
Still currently, yeah, that's what everyone's doing.
I would agree with that.
Is this a good hint I'm dropping, by the way?
Yeah. we're not charging by the hour.
Do you want to actually move the chairs? Ladies and gentlemen, am I using the mic now? Where am I? Hello.
Are we dismissed?
Yes, I'm trying to. I'm here. That's weird. Right, thank you, Charlie. That was wonderful. I loved that. Who thought regulation could be so damned interesting? Right, there's a treat for you now because, like I said, we've upgraded what we were going to do, and this chat is going to be me, Mr. Mark Scarpa, please, and Mr. James Bowater. And we are talking about the media industry, and is it friend or foe? So, Mark, can you... I'm not on, am I?
Well, I'm glad some people stayed. And anyone who did stay can come to have a drink with me at the M Threadneedle Street.
Right. Before we start with questions, I'm going to add a little bit of context here. Because I've been in newspapers a ridiculous amount of time. I've been an editor for 26, 27 years, and the last 5 years as an editor in crypto. And throughout that entire time, there has been one theme that has run all the way through, and that has been that bad news sells. A few years ago, I was editing a daily paper where we had an interfering managing director. And this person was constantly bombarding me with, look, can you put some good news on the front page? And I said, if good news happens and it's a good story, yes. No, she said, can you purposely put good news on the front page? And this onslaught went on with such intensity that I eventually relented and said, okay, fine. Just to prove my point, we'll have a week of good news like you want, but I'm telling you now, it is suicide. Newspaper sales for that week fell by 30%. 30%, because we had all the fluffy, lovely, oh, hasn't he done well, stories on the front. So I'm hoping that that might set a little bit of context for what we're going to discuss here. So let's begin with the straight-up question, very briefly, where are we? Friend or foe? Mark.
That was a very inspirational question. I think, well, inspirational story that you said there. I remember reading at one point that, you know, the reason why bad news sells more than good news is because people are looking to have an escapism experience from their own miserable lives. So if that's the case, then we're all sort of, I guess I can, well, I was going to use a more vulgar word, but yes, yeah. None, no. You have to put out a tip jar, 1 Bitcoin for each curse word, right? I think that it's a very simple answer, really. We're both friend and foe.
James.
I'll actually second that. I mean, as you know, I'm not a journalist. I had an idea, and yes, I wrote, and I just thought it was possibly rude to say to my colleagues at City AM that I'm a journalist. I was very adamant, and I remain adamant that I'm not a journalist. However, I do have the ability to string a sentence together. I'm with you. It is a mixture, and I think the point is that the advent of the the 24-hour news cycle, and everything's repeated every 15 minutes. It's the same. It's like watching Teletubbies for news. There's a reason, it's like almost brainwashing style, and an ever more requirement for click through. So the phrase clickbait's coming. Fake news was coined actually by Big Donald, wasn't it? And that's become a term in the lexicon. And I think that it's and observationally. And again, because I'm not a journalist and I'm not going to offend anyone, it's fascinating to see, I'm on the cover of that magazine, and I'm on this, and I'm on that, and we all know damn well that that's been bought and paid for. Similarly, one of the reasons I've been adamant since day one with the Crypto AM Awards that the judging panel is independent. You and I don't know the results until the day. It means that, God willing, I mean, we don't always get it right, but God willing, no one has paid for an award, which means that the awards have meaning. And stories that are well reported and
investigated.
Thank you.
That's what I'm here for.
Well, my tongue got stuck. Has meaning. And the more and more we pander to, like your story, it diminishes the news, it diminishes reporting, it diminishes everything, and everything becomes beige, bland, and boring, which then takes you back to, well, how do we make it more exciting? But in terms of our industry, I don't think it's very different from any other industry. I think everyone craves the headlines, some more than others. Some go to vast lengths to engineer things. So it's very difficult to disseminate, I think, truth, trust, transparency, which was actually the three tenets of a plan that I had to build something interesting, something new, but with the market as is, I put it on the ice for the minute. But, you know, the Truth Treasury as a concept, I think has a lot of legs. And it was interesting listening to Matty, funny enough, earlier about the tokens, you know, being held, blah, 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 blah. So, I mean, I think there are ways and means that media can become disrupted in a way that, you know, like sort of almost inversion of the pyramid, so that everyone actually does, in a sense, everyone in a funny kind of way is a journalist in a sense. They have a story to tell. You know, if you've got a keypad and if you've got a platform, you can tell a story. The real question is what's the veracity of that story?
You've just hit something there. I'm going to tell you another story. January the 15th.
That's 6 inches.
Sorry? January the 15th, 2009. It was the same daily newspaper, and I was chairing a news conference. And we were discussing what we're going to put on the front page the next day. And someone put the TV on and said, "You've got to see this." And we looked up, and there's an aeroplane landing on the River Hudson, on the Hudson River. Captain Sully. And as we looked closer at this, it wasn't a live broadcast from a TV station. It was basically the TV station routing Twitter, videos from Twitter. That's right. The newspapers couldn't get to the river quickly enough. The TV stations and the radio stations couldn't get to the river quickly enough. And a couple of the guys in the news team said, "Oh, this is brilliant, isn't it?" And I looked up at the screen and said, "No, this is shit. We are screwed." Because everyone can be a journalist. If you've got a camera and a video on your phone, you can be a journalist. You can broadcast this news before a journalist can get to it to do that. My concern now is we've got another situation now, which I'm going to turn to you for. Elon Musk now is urging the whole of Twitter to become this citizen journalism platform. Are you concerned about that?
I love your story. Again, part two. I'm from New York originally, so I was there when that happened.
You're actually there on the scene?
Well, not on the scene, but in the city on the west side when that was going on. Let's take a step back before we get into the whole debate about Twitter and citizen journalism. I would not call those individuals journalists. They are providing source material video, which has been going back for years and years, going back to the home video camera. You know, you have storm footage from the 1980s, even the 1970s. These are people that are getting footage on VHS tape to the local news station, then it goes up. Doesn't make them a journalist, right? Let's just establish that. I don't necessarily consider myself a journalist either. I'm the CEO of a media company. We are broadcast, which is quite different than a publication. So all that said, you look at the backstory I want to get to is Twitter, when it was founded, had a department in Twitter. It was called Twitter TV, which is very different than what we now know of as Twitter TV. And this department at Twitter, their sole function was to integrate with all of the major media outlets domestically and internationally. And what they did was they created a methodology, a workflow, basically. They were allowing media organizations to have certain insights into metadata that they weren't giving out to the general public or even their advertisers. They were verifying certain people as trusted sources of news and information. This is before the blue check mark. And you'll remember at one point you started to see tweets, if you will, during live television broadcasts. That happened because a piece of hardware was created with a supplemental piece of software that allowed TV news stations to, in essence, take the tweets in real time and edit them, as well as filter through them to decide which ones were to be taken in, because there might be a subject, such as the plane landing, hundreds of thousands of tweets are going through, and they'll go through, and there'll be a filtration system that's already built ahead of time, and then boom. So Twitter, to my point, worked very, very, very hard and in unison with the media to become a trusted news source for global media. Now, no other social media company has done that. So Facebook certainly didn't do it. YouTube definitely didn't do it, right? So they're the only ones who went out of the way to do that. My background being in media my whole life and having worked really hard in an area called live participatory media, I don't necessarily call it citizen journalism. Again, sources. These are people that are submitting content in real time that then a group of professionals is looking at and saying, okay, this content and these shots merit to help us tell the story in real time of what's happening at a particular event that could be a world crisis or it could be something funny. It goes all the way across the board. To me, that is the ultimate form of participatory media because it is influencing the storyline, and everything is about story in real time. But not just, hi, I'm Kim Kardashian, and here's my story, and let me put it up on Instagram. It's group sourced from a large group of people. But still, there's a control room. There are still producers. There's still writers. And these things are all happening in real time. And they're all just trying to find as much information as possible to get it out there. Now, the hat trick on that, though, is you can start, now you're trusted. Now you can start to put media and information into the system where the system, this omnipresent media, I'm just talking broadcast again, on a global basis, doesn't check the source video. Now you have a piece of source video that appears to be real time from a certain location, but it's actually was shot 6 months ago, and or it's from a completely different place than where you think it's coming from. Because this content is not running through AP, it's not running through Reuters, it's not running through Getty, that breakdown in the checks and balances is becoming more and more widespread. However, the need for content in real time has become more paramount with the advent of CNN, for example. That really spurred all of that. This is clearly well before our handheld devices. So it's really a mixed bag. You have this mixed media experience that's happening now. We need platforms that are able to look at a piece of video, look at that metadata in that video that's come from a user, and be able to actually verify that if James says it came from this hotel on that moment in time, because there happens to be something very exciting going on here at the moment, like the Crypto AM conference, that it is absolutely true and it's verified, regardless of the source. That, I believe, is possible, and that technological solution is coming soon.
I think you've hit the nail on the head, though, with that last word, technology. We didn't touch on deep fake.
I love deep fakes. We have a virtual human as our news anchor. So
no, that I understand. But in terms of policing it, and also don't forget, for the most part, people watch what they want to see, but then the algorithms play to that. So we all know the whole situation where you're talking about going to Bali and then suddenly your phone inundates you with adverts for flights and holidays. And how the hell did they know that? Duh. And so technology, I think, is almost like a follow-on question, friend or foe for media, but technology, it's a race against time, isn't it? Always.
It is. And, if you think about the advent, again, of just media and broadcast, it was in my lifetime anyway, and this is me dating me, which is unfortunate, but, we had 13 channels on the TV to choose from, right, to reference Pink Floyd. And a lot of it was black and white.
I had black and white.
Yeah. So we've come quite a long way. and things will exponentially change. But in terms of checking and verifying media, I think you'll definitely see blockchain solutions that will be able to help that moving forward. And to me, that's promising, and we're looking at it. In the area of deepfakes, again, we looked at deepfakes and we said, okay, these can be used for a variety of things. In the beginning, people were terrified of deepfakes because they actually believed that they were real. But that's just good CGI. You know, if you go to any movie, you've got Princess Leia in a movie, and do you believe that she's still alive? So that's yes, of course. You know, it's just another example of it. But here, because it's on a YouTube channel, or somehow it seeps its way onto television, which is just a larger display device, sort of. That's a different conversation. You believe it more. But for us, I looked at it and I said, well, this is a solution. This is a way we can solve a problem. We're a startup broadcast media network. Yeah, we reach 100 million homes, but how am I going to have a television network with a virtual anchor? That's people, that's a studio, that's a venue, that's technology, that's, you know, a whole control room of people, even if it's just 2 or 3 and you're using, you know, OBS software or vMix and so on and so forth. It's still, they get sick, they complain, there's problems, there's this, there's that. And all I need them to do is just read the teleprompter. So let's do a motion capture of a person and create a virtual human that's AI powered that we can generate news stories from and take content from Reuters and Getty.
Language at the
well, we can do it in up, yeah, exactly. To that point, we were able to do it up to 80 different languages.
Only 80.
So far, yeah. We haven't gotten the boat water.
So behind the curve.
I know, exactly.
I think there's another issue forming as well, isn't there? In that, what we face in the crypto industry is we often feel there's a negativity from the media, from the press, towards what we do, and a lot of that is down to this idea of bad news sells. But I think there's another problem here, and it's a skills void. So when because I'm a freelance editor, and you know, so you have to grab whatever work comes your way. So 5 years ago, I got introduced.
Well, it's not to be that much freelance anymore. It's way too much for your time to
I got tempted into, you know, looking at crypto and becoming a crypto editor, and it took me a while to sort of pick that up and understand what I needed to do, what was going on, what it was about. And after 3 months, I was at a conference, and someone came up to me and said, "Oh, you're damn right, you're an editor." I said, "Yeah, that's right." And they said, "Oh, do you know you are probably the most senior journalist in cryptocurrency in the UK right now?" And I said, "I've been doing this for 3 months. That can't be possible." And
have you heard of blockchain? Yes.
I couldn't even spell Ethereum properly at that point.
Not many people do.
But one of the problems I have as well is in terms of recruitment. In 5 years, throughout that time, I've always been looking for good writers, good journalists in the crypto space. And in that time, hand on heart, I can count on one hand how many good journalists and writers I've found in this space. Yeah. And I think there's a massive problem there.
Yeah, I think that's super fair. You know, I've had this conversation with a colleague, Michael Casey, over at CoinDesk, and I respect tremendously what they do. They're not, you know...
Is that the one owned by DCG?
No comment. But yes, obviously. But the point is that he's made it a mission to go after people who have at least gone to journalism school. Obviously, it's a publication, and they're all about writing. They're getting into video a little bit. But broadcast is quite different than writing. You know, we have to put pictures to the story. So you're starting off with a story, and the whole point of broadcast, I think, is to make it a little bit more digestible. I was one of the founding producers of CNET, and we had there was the same problem back then in quote-unquote Web 1.0 era. You had publications, Wall Street Journal, New York Times, and so on and so forth. To be fair, elitist publications. These are not consumer publications. And they weren't getting it right. I mean, they laughed Jeff Bezos out of the room, thought he was crazy. They were wrong. So, you know, when you start to put pictures to things and you're able to see and hear the entrepreneur speak about their product and passionately speak about their product and show you their product, I think that that is a way to promote more, you know, it's just an easier way to facilitate adoption and have more mass adoption and global adoption. I think CNET was instrumental in helping the entire web movement early on because retail investors were starting to understand what, you know, these companies were, and they would go and buy their stocks and or they set up their own websites, and they just became part of the solution as opposed to trying to combat it and be a part of the problem.
I'm also including journalists who have gone through journalism school. One of the biggest problems I've got in the UK is the NCTJ, which is the National Council for the Training of Journalists. I went through an NCTJ course when I was very young. I studied for law for years, publishing law, highly trained. And then the NCTJ then became a profit-making organization. And they grab these kids and they stick them through the colleges. They churn them out. And every year since 2005, there were too many wannabe journalists and too few jobs for them.
Right.
There's a massive, massive problem with journalism in this country. So,
true, they're not
but
getting paid.
what are the answers, guys?
Thomas Power, I wanted to say something to you. 4 years ago, on the 18th of October, at the very first event, you said attention is the product. How do you feel about that now? Absolutely. Good night, mate. Thanks for coming.
So what's the answer?
I think the big problem is there's not a lot of jobs for journalists because it's not as appealing as a job and they're not getting paid. It's always been sort of a passion job, if you will. It's not a very, it used to be sensationalized and glamorized, especially, you know, starting with the Watergate, you know, scandal all the way through. You're just, you know, the gonzo journalist doesn't exist anymore, if you will, with the Hunter S. Thompson, this idea of these journalists that are larger than life, that are the heroes out there to save the world. So them as caricatures or characters of truth, justice, and, you know, the proper story with the proper facts doesn't really exist anymore. I would agree with you. There's probably a few handful that fit that position. Certainly in broadcast, there isn't a single one. That was predominantly the reason why we decided to create one. And, you know, we have actual legitimate writers who write those stories because that's key. But the delivery, we were like, well, let's create our own character for now. We still also have many, many people on the platform, but it's more of a talk show format, each of those shows. And that engagement, you can't really, that's a different format.
Interestingly, I mean, again, sort of contextualizing it to, you know, crypto, blockchain, blah, 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 blah. It's the recent phenomenon that Twitter have kind of released upon us, Twitter Spaces. And I'm certainly not going to mention any names on this one, but somebody managed to create this enormous effective live broadcast of more than 30,000 people that had literally the great and the good from every aspect of our industry commentating, and I think even Elon was on it. And yet, in that audience, and given the microphone, were well-known fraudsters and scammers and all the other sort of stuff. And I don't know. It's rife in our industry, and it comes back to, you know, I think that actually, you know what I was going to say is that audience actually reacted against seeing those people in there. They said, "Hang on a minute, he can't talk. He's a this. That guy's a that. He was jailed, for heaven's sake. Why is he on?" So in a funny kind of way, the town hall thing does work because it becomes self-policing. So I was more just really...
It's a court of public opinion.
Say what? I have no comment. I have no idea what you're talking about.
It's the court of public opinion. These town halls where there's where it's just a free-for-all. I'm still a big proponent of editorial when you're talking about media at the end of the day. It's great that Twitter Spaces exists, and they built that obviously to take out Clubhouse. That was the idea. Like, this is a good idea, great.
I think I've registered for Clubhouse. I don't think I've ever used it.
That's to the point. My prediction with Twitter is I think that everyone should keep a very keen eye out on a side project of Jack Dorsey's that he took with him when he left Twitter. It's called Blue Sky. And I think that you might be seeing Blue Sky acquired in the not-so-distant future.
And then also Stanny from Arve is doing Lens.
Exactly.
Which is the Web3 platform, I think.
Exactly. So I think that Twitter will potentially go into bankruptcy, but for good business sense, and reemerge with some new technologies, which, by the way, were things that the former leadership wanted to implement prior and didn't have the opportunity, so they left. Whether or not that leadership comes back remains to be seen, but I believe that those technologies will be implemented. And interestingly enough, they're not blockchain technologies. So if you look at Blue Sky, it is not that. But it is still in our world, and of course, digital payments, digital currencies will definitely proliferate on that platform at some point.
Yeah. Elon Musk seems quite hell-bent on driving Twitter towards bankruptcy by the look of things. One final question for you both, and we'll
Does
wrap
it go
up.
at ludicrous speed?
Possibly. Does cryptocurrency need the media to be friendly or not? Do we need it?
I'm a firm believer that good, solid projects will filter up to the surface. I'm wearing it on my heart.
I will sum this one up super easily. 2 words: Satoshi Nakamoto. Without that folklore and that story, we wouldn't be sitting here today. So it's all about storytelling, and it started with this imaginary character characters, however you want to, define it, and a script. Really, the white paper is just, here's an idea, and a bunch of people adopted it and went out, and here we are years later. So there would be no industry without media. Nothing happens without media. It's just the way people are wired. They want to hear stories, and it's so niche now.
Yeah, but it was friend or foe. I mean, I think you're absolutely right. Media is absolutely, here it will always be, always, obviously.
Whether the story's good or bad, it's just keep pumping it out, but ideally responsibly.
Yeah.
And can we find technologies to do that in a more efficient way, to at least fact check?
Yes, indeed, fact check.
And I think that is a ludicrously good place to wrap
go
this up.
to the
at Tabar
watering house.
Would you like to remind everyone again about where we're going?
Right, not too distant, walk away, follow the jacket. I'm going straight to M Threadneedle Street to have a libation. I'd like to thank everyone who stayed in the room. Amazing, thank you very much. I'd like to thank the live stream audience, if you're still there, and Minima for supporting the live stream. And I'd like to thank you, Darren, for an amazing job, Eric Van der Klee for an amazing job, and the whole team for an amazing job. And Mark, obviously, thank you.
Oh, thank you. Appreciate it. Thank you both very much indeed. We'll see you tomorrow.
Cheers. Bye-bye.
That was great.
And that's